So now let's get started with the next chapter, and which is nothing but your dividend decisions. Okay. Now see, whenever we deal with your dividend decisions, what is the first thing which comes to your mind whenever we are talking about dividends? Can I say equity dividend? Is it mandatory or it is voluntary? Right? But distribution of dividend, will it have any impact on the market price of an equity share? Come on, yes or no? Yes, sir. Okay. Now, let's say for example, if a company has equity share capital of 1 lakh rupees. Now, in the first year, with this 1 lakh rupees, they generate a profits of 10,000 rupees. Whose profits is this? This is nothing but net profits available for equity shareholders. Now, it depends whether the company wants to distribute this profits or not. Okay. Suppose the company knows that this profits can be reinvested and it can earn a return of equity which is 15%. What is the ROE this particular company can earn, beta? 15%. But suppose the expectation of equity shareholder is just 10%. So can I say that the R is greater than K? So if the company retains the profits with themselves, they can reinvest it and earn a return of what? 15%. But how much are the equity shareholders expecting from the company? 10%. So as a CFO of a company, what do you think you should do? Should you retain the money or should you distribute it? Retain, because that gives you higher return as compared to distribution of the dividend. So in this particular case, can I say the market price, which is called as P0, that is going to be maximum? Come on, yes or no? Yes, sir. But on the contrary, suppose your R is less than K. Suppose the returns generated, that is 5%, which is less than 10%. Then in that particular case, if the returns which you are generating, if that is less than the expectation of equity shareholders, then what do you think that the CFO of the company should do? It should distribute it. So in this particular case, can I say the market price is going to be maximum? So always remember that what is your optimum payout ratio? Your optimum means what's the best payout ratio? So if your R is greater than K, then what's your best payout ratio? 0. If the R is less than K, what's the best payout ratio? 100%. Don't even keep even a single rupee by the way of retention. Distribute 100%. And if your R is equal to K, then can I say any payout ratio is okay? Come on, yes or no? Yes, sir. Because the price is going to be constant. And this model is generated by James Walter. So that's why it's also called as your Walter's model. So Walter tells you that the price of the equity share is whatever is your dividend per share plus earning per share minus your dividend per share, which we have to multiply it by R upon K, and we capitalize that by K. Is this the formula as per your Walter's model? Come on, yes or no? Yes, sir. So what is the formula, beta? Dividend plus earnings minus dividends, which gives you your retention. You multiply that with what? R upon K, and we capitalize that with what? K. Will that give you your price of an equity share? Come on, yes or no? Yes, sir. So if your R is greater than K, then what should be your optimum payout ratio? Your dividend should be 0. Okay, so in that particular case, suppose your earning per share is 10 rupees. If your R is 15, your K is 10, you capitalize that by 10%. So this will be what? 10 into what is 15 divided by 10? 1.5. And we capitalize that by 10%. Can I say the market price is the best, which is at 150 rupees? But suppose you still decide, no, I want to distribute dividend. Then what do you think will happen to the market price of the share? Will it rise or it will fall? It will fall, because your best payout ratio was 0. But still, if you think, no, I want to still pay some dividend. Suppose you decide to give 2 rupees by the way of dividend. Then this will be what? 2 plus 10 minus 2. And we'll multiply that by 15 upon 10 and we'll capitalize that by 10%. So this will become what? 2 plus 10 minus 2 is 8. 8, you will multiply that by 1.5 and you will capitalize that by 10%. So what is 8 into 1.5? That will give you 12 plus 2, which is 14, and 14 if you capitalize it by 10%, it is 140. Don't you think that the market price has started falling? Come on, yes or no? Yes, sir. So in life, always remember that when your dividend is, when your R is greater than KE, then the best part is what? Don't even distribute even a single rupee by the way of dividend. So that's why this model is also called as all or nothing model. All or nothing. Either distribute all your dividends or distribute nothing. That will give you your maximum price of an equity share. Okay. Now, similar to this, there is one more model which we are going to learn, and that is called as what? Gordon's model. Now, Gordon's model, which you have already learned in your cost of capital, how do you calculate your KE, beta? Can I say D1 upon P0 into 100 plus G? Now, in this particular case, if I take KE minus G, that will be nothing but D1 upon P0 into 100, boss. And if I take my P0 here, can I say this will be nothing but D1 upon KE minus G? So can I also find out the price of an equity share based on the dividend distribution of the company? Come on, yes or no? Yes, sir. So this is nothing but your second model, which is your Gordon's model. But here the assumption is what? That your growth rate should be constant till perpetuity. Only if your growth rate is constant till perpetuity, can I say I can find out the current market price per share today? Come on, yes or no? Yes, sir. This is your second model. So what if the growth rate is different? Charan, what if the growth rate is different for different years? Then in that particular case, we'll be having something which is called as your two-stage growth model, three-stage growth model, etc. We will study that. So the first part, which is nothing but your what? Walter's model. Second part is your what? Gordon's model. Then, my dear students, we have something which is also called as Linter's model. Then we have Graham and Dodd model. And then we have, once again, approach. So in this entire dividend decisions, how many types of models do we have, beta? 5. The first one is your what? Walter. Second one is your what? Gordon. Third one is what? Linter, Graham and Dodd model. And the last one is your approach. So I'll explain you one by one when we'll be starting with the question that which all models are going to deal with. Okay. So I want you all to please come to your dividend decisions. And in this dividend decisions, I want you all to come to your first approach, your first question which they have told you, illustration 1. Okay. Now your illustration 1 deals with your approach. So I'm going to now start with the approach. Okay. Now what is your approach dealing with? Approach tells you that if you want to find out the value of company, then this value of the company is nothing but n plus change of n into P1 minus I plus E upon 1 plus KE. This is the formula to calculate what? This is the formula to calculate what should be your value of the firm, value of the company. So tells you if you want to find out value of the company, then this should be the formula. Where what is n? N is nothing but your existing number of equity shares. What is change in n? Change in n is nothing but your fresh issue or the new shares which we are supposed to issue. P1 is nothing but the market price of equity share at end of year 1. Whatever is the market price per share at the end of year 1. I represents your investments which is supposed to be made at the end of year 1, and E represents your earnings at end of year 1. So what does tells you? That if you want to find out the value of the company, now just check what is the existing number of equity shares. Suppose the existing number of equity shares is 10,000. Suppose at the end of year 1 you have to make a fresh issue of 5,000. Example. So can I say that now total number of equity shares is 15,000? We will multiply that with what is the market price of the equity share at the end of year 1. Suppose that is 150 rupees. Example. Plus your minus what is the investment which is supposed to be made at the end of year 1. Suppose my investments at the end of year 1 is 50 lakh rupees and my earnings is 10 lakh rupees. So minus whatever is the investments which are going, we subtracted, and the earnings we added. but all these things, can you see, is happening everywhere at the end of year 1. But we want the money which we are getting today. We want to find out the value of the firm which is today. So if you want to find out the value of the firm today, then what do you have to do? We have to discount it and bring it to the present value terms. And at what rate will you discount? So you will discount it at your KE. That's why we divide that with what, beta? We divide that by our 1 plus KE. Have you all understood this? Okay. So when we divide that by 1 plus KE, can I say what we get is nothing but the value of the company today? Come on, yes or no? Then the answer is yes. Suppose I tell you that at the end of year 1, your cash flows is 1 lakh. Please find out what is the cash flow at year 0. How will you do the cash flow at year 0? You will take 1 lakh rupees and you will discount it at whatever is the rate which is given to you. Come on, yes or no? Yes, sir. So suppose your discounting factor is 10%. So what you will do? You will take 1 divided by 1.10. So this is nothing but 1 lakh divided by 1.10. What you are going to get? 90,910. That is nothing but the value of the company today. So whenever you have to find out the value of the company today, can you find out the value of the company today by using this particular concept? Come on, yes or no? Yes, sir. Where we have to divide that by 1 plus KE. Okay. Now I'll explain you, I'll quickly revise what this model is all about. This model tells you that whether you declare the dividend or whether you don't declare the dividend, the value of the company is going to remain the same. So what does this model tell you? Whether you declare the dividend or whether you don't declare the dividend, what is going to happen to the value of the company? The value of the company is always going to remain the same. That's what this model tells you. Now you must be wondering, sir, how is it possible that the value of the company will remain the same? So for that, now understand something like this. Suppose you want to find out the price of the equity share today. Now what is the price? What is the value of something which is today? So that value is nothing but whatever is going to be your dividends and whatever is going to be the price at the end of year 1. What are we going to do? We will divide that by 1 plus KE. What we get is nothing but the price of the equity share today. What do I mean by this? See, understand like this. Suppose I tell you that let us invest in Reliance Industries Limited. What you will tell me, okay, what is the time horizon? Suppose I tell you the time horizon for investing in Reliance Industries Limited is 1 year. So can I say that at the end of year 1, we need to check how much dividend per share Reliance is giving and how much market price per share will be at the end of year 1. Suppose I tell you that the dividend which Reliance is going to give is 50 rupees at the end of year 1 and market price at the end of year 1 is going to be 1500. Please tell me all these 50 and 1500, this is nothing but the future value of cash inflows which you are going to receive at the end of year 1. If I ask you what is the present value today, what will you do? You will discount it at your expectation and you will be getting the present value today. Come on, yes or no? Yes. So value today is nothing but what? It is nothing but D1 plus P1. It means whatever is the cash flow you are going to get at the end of year 1, you divide that by 1 plus KE. Can I say you can get your P0? That is nothing but value of share today. Come on, yes or no? Yes, sir. So in this approach, the first formula which you should remember is this particular formula. That is value of the company is nothing but what? N plus change of N into P1 minus I plus E upon 1 plus K. That will give you value of the company. And the second formula which you should know is how do you calculate your price of the equity share today? What is the price of the equity share today? The future benefits which you are going to get at the end of year 1, you discount it and you bring it to the present value terms. That is nothing but the value today. So just imagine if you want to value a project today, if you want to find out the present value of the cash inflow today, how do you calculate the present value of the cash inflow today? You will be having at the end of year 1, suppose this 5 lakh rupees, 50,000 rupees is nothing but the cash inflow at the end of year 1. Scrap value is given to you as 5,000. Then how do you find out the PV of CI today? We discount it and we bring it to the present value terms. So what do you discount it and bring it to the present value terms? That's nothing but the present value of the project. So the same thing is also applicable when we will be taking into consideration what is going to be your value of an equity share. So value of an equity share today will be nothing but what? We have to take whatever is your D1 and P1 and we divide that by 1 plus K, can I say we can find out what is the value of the share today? Come on, yes or no? Yes, sir. Okay. But what do you deal with your change in N? What is the basic meaning of new number of equity shares which we are supposed to issue? Now this new number of equity shares which we are supposed to issue, that actually depends upon what is the investment which you are going to make at the end of year 1 and what is the retained earnings at the end of year 1. So this both put together will give you your fresh issue. Okay, I'll give you an example. Suppose you want to buy a car, okay, and the value of the car which you want to buy is 10 lakh rupees. Suppose you already have 3 lakh rupees with you. Then can you please tell me how much amount you have to arrange? 7 lakhs, right? Similarly, if the company wants to make investment at the end of year 1, which is 10 lakh rupees, but if they have retained earnings of 3 lakhs, then what is the fresh issue they have to make, beta? 7 lakhs. So for every company, whatever investments you have to make at the end of year 1 completely depends upon how much is going to be your investment amount, from which I will subtract something which is called as your retained earnings. Suppose your investment at the end of year 1 is 50 lakh rupees and you have already retained earnings of 20 lakhs. Then can I say the fresh issue or the new equity shares which is supposed to be issued, that will be what? 30 lakh rupees. And this 30 lakh rupees, I have to divide that by the price at the end of year 1 to actually get the new number of equity shares. Suppose my price at the end of year 1 is 200 rupees. Then 30 lakhs needs to be divided by what? 200. Then can I say I will come to know what are the new equity shares which I am supposed to issue? Come on, yes or no? Yes, sir. So whenever you want to find out the change in N or the new equity shares which are supposed to be issued, then what formula will you use, beta? Investments minus retained earnings. By simple logic, investment minus retained earnings. So I have to invest 10 lakh rupees. My retained earning is 3 lakh rupees. Then can I say the fresh issue of equity shares will become what? 7 lakhs, which I have to divide that by new shares, which is nothing but price at the end of year 1, that is nothing but P1, and that's how I'll be getting the fresh issue which is supposed to be made. So I'll give you some examples. Suppose your investment amount is 50 lakhs. Okay, and suppose your earnings is 30 lakhs, but out of this you decide to distribute a dividend of 20 lakhs. Can you please tell me what is the retained earnings? How much am I earning at the end of year 1? 30 lakhs. Out of that 30 lakhs, how much am I distributing by the way of dividends? 20 lakhs. So what is my retained earnings? My retained earning is 10 lakhs. So now can you give me fresh issue? Can I say my fresh issue will be investment minus retained earnings, and that will give me 40 lakhs. Suppose I have to invest 50 lakhs, my earnings is 30 lakhs and my dividend is also 30 lakhs. Can you all please give me my retained earnings? 0. So what will be my fresh issue? 50 lakhs. Suppose my investment is 50 lakhs, my earnings is 30 lakhs, and suppose I don't distribute any dividend. Can you please give me my retained earnings figure? Come on, 30 lakhs. And what is going to be my fresh issue? 20 lakhs. Are you guys trying to understand that my fresh issue is nothing but whatever is my investments minus whatever is my retained earnings, which I have to divide that by the price at the end of year 1. Suppose they give you price of the end of year 1 as 100 rupees. Suppose here they give you 120. Suppose here they give you 80 rupees. Can I say I can find out number of equity shares which is supposed to be issued? Come on, yes or no? Yes, sir. And that is actually called as your change in N. So in approach, these are the 3 formulas which you should know. First, what is the value of the company? Give me value of the company, guys. N plus change of N into what? P1. From this, what do I subtract? I plus what? E. And I have to divide that with what? 1 plus K. Because I want to find out the value of the company today. I want to find out the value of the company today. And all this is happening when? At the end of year 1. So don't you think I have to discount it and bring it today? Come on, yes or no? Yes, sir. Okay. If I ask you now, what should be your price of the equity share today? What is the price of the equity share today? Whatever is your dividend at the end of year 1 and price at the end of 1 year, you will divide that with what? 1 plus K. And if I ask you that what is the fresh issue of equity shares which you have to make, then it completely depends upon what is your investment. From this, what do you subtract? Your retained earnings and divide that with what? P1. So I'll be getting the new number of equity shares which are supposed to be issued. Have you guys understood this? But first of all tells you what? That, can I say value of the company is going to be dash? Same, irrespective of the fact whether can I say you distribute your dividend or you don't distribute the dividend. Can I say your value of the company is always going to remain the same? Come on, yes or no? Yes, sir. Okay. Now, this is something which we are going to understand with the help of your question number 1. AB Engineering belongs to a risk class in which the capitalization rate is 10%. Can you please tell me if the capitalization rate is 10%, this 10% is called as your what? KE. And it currently has outstanding how many number of equity shares, guys? 10,000. Can I say this 10,000 is nothing but the existing number of equity shares, that is nothing but your N? Solo yaar. So I'll be getting this as my 10. Come on, yes or no? Yes, sir. Just 1 second. Huh? Online students, you can see this properly? Online students, any problem? The screen is not blur, na? Just check and tell me. Okay, perfect. Okay. So in this particular case, I hope you all know that what is going to be my, what is the existing number of equity shares? N, that is 10,000. And this is selling at rupees 100 each. Can I say this is the current market price today? Come on, yes or no? Yes, sir. So what's my current market price, beta? My current market price is nothing but 100 rupees. The firm is contemplating declaration of dividend of rupees 5 at the end of current financial year, and it is expected that the net income is going to be how much? 1 lakh. So this is nothing but your earnings, and it has a proposal of making a new investment of rupees 2 lakhs. This is your investment. We are required to calculate the value of the firm when the dividends are not paid and when the dividends are paid. Okay. Now, this is something which we need to find out. Okay. Now see. The first thing, I want you all to do this question along with me. Okay. And in this illustration 1, which we are solving, everyone please tell me, do you have your KE? Okay, what's your KE, guys? 10%. Then, do you have existing number of equity shares? How much is that? 10,000 shares. Then, do you have the current market price per share? Yes. How much is that? 100. Then, what is the dividend which you are planning to declare? How much is the dividend which you are planning to declare? 5. And then, it is expected to have a net earnings of how much? 1 lakh. So what is your earnings at the end of year 1? 1 lakh. And then they have told you that you have to make a fresh investments. And what is the fresh investment amount which we have to make, beta? 2 lakhs. Hello? Okay. And after which we are required to calculate what should be the value of the firm when the dividends are paid and not paid. So we have to find out value of firm. Okay. What is the formula for value? Come on. N plus change in N into what? P1 minus I plus E upon 1 plus K. Now in this case, do you have N? Okay. Now I am taking the first option. That is when dividends are, in the first case, what have they mentioned? Dividends are not paid. When the dividends are not paid. Can you please tell me, do you have N available? Yes. How much is that? 10,000. Do you have change in N? No. Do you have I? 2 lakhs. Do you have E? 1 lakh. Do you have K? 1 plus 0.1. So basically you just have to calculate now 2 important things. And that is number 1, what is required to be calculated, beta? Change of N and P1. But first, I will first find out what is the P1. Now, which formula did I tell you for P1? P0 is equal to D1 plus P1 upon 1 plus KE. What's the current market price, boss? What's the current market price? 100. Now, if dividends are not paid, can I say my D1 will become 0? Solo yaar. If dividends are not paid, what's going to be my D1? 0. What's my P1, boss? x, and this is 1 plus 10%, which is 0.1. So what your x is going to be? Can I say your x is going to be 110? So now do I have my P1, which is 110? So I can write down here P1 110. 110 rupees. Can I write down that in the formula 110? Come on, yes or no? Yes, sir. Now let's talk about change of N. How did I explain you what is new shares which is supposed to be issued? Whatever is your investments, from that you subtract retained earnings and you divide that by P1. What was the amount of investment which you are supposed to make? 2 lakhs. What's the retained earnings? Retained earnings, can I say, is nothing but from your earnings, how much is your dividend which is distributed? What was your earnings, beta? 1 lakh. And what is your dividend which you are distributing? So there is no dividend which is being distributed, that is 0. And what's your P1 which you have got? 110. So now this will be 2 lakh minus 1 lakh, that is 1 lakh. And this 1 lakh, if I divide by 110, what is the answer which is going to come? So 1 lakh divided by 110. What is this going to come, beta? 909.09. So these are the number of equity shares which were supposed to be issued. Come on, yes or no? Yes, sir. So this is now going to be 909.09. So now can you please tell me what is the value of the company? Can I say value of the company will be 10,000 plus 909.09 into what? 110 minus what? 2 lakhs plus what? 1 lakh, which I will divide with what? 1.1. What is the value of the firm which you are getting? 10 lakh rupees. This is 10 lakhs. Now this is only under which situation, beta? When the dividends are not paid. First part was not paid. What will be the second part? When the dividends are paid. So can I say formula will be the same? So what is the value of the company? N. What is your N? 10,000. But I don't have my change in N. I don't have P1. But do I have I? Yes. Do I have E? Yes. So I have to calculate, divide that with what, beta? 1 plus 0.1. So now, my dear students, the objective is to find out dash and dash. What is the objective, beta? To find out your change of N and P1. So what did I first tell you? You have to calculate what? P1. So what's the formula? P0 is equal to what? D1 plus P1 upon 1 plus K. What's your P0? What's your current market price? 100. Now, are we paying dividends? What's your dividend? 5. So this is now going to be what? 5 plus, let the P1 be X upon 1 plus, what's your K? 0.1. Now, what is the price? What is the P1 which is coming? 105. And now, what is going to be your change of N? Can I say whatever is your investment, from that, we have to subtract retained earnings. Because from how much I invest, first I will see now what do I money I have. Only then the balance part will be your fresh issue. Divide that by your P1. What's your investment, guys? 2 lakhs. What's my retained earnings? 1 lakh minus dividend. Are we paying dividend? Come on. How much is the dividend which I'm paying? 5. On shares of what? 10,000. So can I say this is 0.5 lakhs? And divide that by P1, 105. So 2 lakh minus, can I say 1 minus 0.5? That is nothing but 0.5 lakhs. Divide that by 105. So can you please tell me 1,50,000, divide that by 105. How many shares is coming as? 1428.57. So I'll write down here 1428.57. What's your P1, guys? 105. Now let's check what's the value of the company. This plus 10,000 into 105 minus 2 lakh plus 1 lakh and divide that by 1.1. Are you all getting the answer, which is exactly 10 lakh rupees? So whether you declare the dividend or whether you don't declare the dividend, can I say that the value of the company is going to be dash same? Superb. Have you all understood this? Sure, confident, everyone's okay with this? Okay. Now, this is your first question. Value of the company is 10 lakhs. Now let us start with the next illustration. Illustration 2. Okay. Now this is regarding your Walter. XYZ owns how much rupees? 10 rupees per share. Capitalization rate which is given to you, that is nothing but 10%. And capitalization rate and return on investment. So capitalization rate, that is K, is 10. And what is this? Your R, which is nothing but your 12. Determine the optimum dividend payout ratio. Please tell me, is your R greater than KE? This 12 is what? Greater than 10. What do you think optimum payout ratio should be? 0. So based on this, you apply this in the formula. So because this is the first question, I'm solving it. Please tell me your P0 will be, what's your dividend? 0. What's your earning per share? 10. Minus dividend of 0. What's your R? 12. K is 10. Divide that by 10%. So this will be 10 into 1.2. Divide that by 10%. Everyone, can I say the answer is nothing but 120? Superb. Okay, no problem till here. Okay. Then illustration 3. Now see what is given to you in your illustration 3. The following figures are collected from the annual report of XYZ. Now in this, the net profit is given to you as 30 lakhs. Outstanding 12% preference shares is 100 lakhs. Can you please tell me what's the rate of dividend? 12%. So what is the dividend which you are paying? 12 lakhs. Now this net profits is always your net profits after tax. Okay, so net profits is always to be treated as what? Net profits after tax. So you have your net profits after tax, and how much is that? 30 lakhs. From that I have to pay what? Your preference dividend. So you'll be getting what? Net profit for equity shareholders. Do you have number of equity shares? Solo. What is your R? 20%. What's your KE? 16%. We are required to find out what should be the payout ratio so as to keep the share price of 42. Please give me the formula for Walter. Come on, yaar. What's your P0? 42. Now, I don't have the dividend per share, but it's okay. I can calculate it. What's my NPAT, guys? What's my NPAT? 30 lakhs. From NPAT, what do I subtract? Preference dividend, which is 12 lakhs. What will I get? Net profit for equity shareholders, which is 18 lakhs. I will divide that with what? Number of equity shares. Can you give me number of equity shares? Just look here and tell me. 3 lakhs. Can you please give me EPS? 6. Okay. And you are paying how much dividend? Have they given to you in the question? No. So this is X plus this is 6 minus X. What's your R? Your R is nothing but return on investment 20. And what's your K? 16. We capitalize that by 16%. Is this sufficient to get your dividend per share? Come on, yes or no? Yes, sir. So if you substitute, your dividend per share will be what? 3.12. And once I have dividend per share available, which is 3.12, what's my earning per share, which is 6. So guys, will I get my dividend payout ratio? Solo yaar. 3.12 upon 6 into 100. Can you give me the final answer? 3.12, divide that by 6 into 100. How much percentage is this? 52%. And just check, is this coming as your 52%? Come on, yes or no? Yes. Have you all understood this? Absolutely clear. Okay. Then which one is the next? Gordon's model. So Gordon's model, let us now solve this illustration 4. The following figures are collected from the annual report of XYZ. We have your net profits, which is nothing but NPAT. We have outstanding preference shares, number of equity shares, RK. Now the same question is there. They have told you that you are required to find out the price as per Gordon's model of dividend payout ratio is what? 25%. What was the EPS which I got? 6 rupees. Now there are 3 possibilities that your dividend payout ratio can be what? 25. Hello? It can be 50 or it can be 75. Can you please give me the 3 DPS? 6 into 25%. 1.5. This is 3 and this is 4.5. Now you are required to calculate using Gordon's model. Okay. Sorry? 100%. Oh, not 75. Sorry. This is 100. So 100 means what? 6 rupees. Okay. Now, what have they asked you to calculate? What should be as per your Gordon's model? Now, for Gordon's model, what is important that you should know what is your growth rate. Now, growth rate will be nothing but, can I say, retention into your ROE. Retention into ROE. So, retention is what? Can I say if this dividend paid is 25%, what is your retention? Can I say this retention is 75%? What's your ROE, return on investment? How much is your return on investment? 20%. So I'll multiply this by 20%. So what is this going to be? What is the first growth rate? Come on. 15%. What is the second growth rate? So this will be retention of 50% and your ROE is what? 20%. So this is going to be 10%. What's your third growth rate? Entire money is retained. So this will be nothing but what? 20%. Have I got the three growth rates? Okay, what's the formula for P0? I have explained you. What is this? D1 upon KE minus G. Right? So now just check. Do you have the dividends? Come on, yes or no? Yes, sir. Just check. What's the first dividend? 1.5. Are yaar 1.5 na, which we got it. So first dividend is 1.5. What's your KE, boss? Expectation of equity shareholders. What's the expectation of equity shareholders? That is 16%. And now have I got my growth rate? Come on, yes or no? Yes, sir. What's my growth rate? 15%. So this will give you 150. So this is your first answer, 150. Now you can have a doubt, sir, what if we can add, sorry, in the third part, what is your dividend? 6, na? Oh, retention is 0. Growth rate is 0. Sorry. I understood this, that there is no dividend and 100% retention. Sorry. There is no retention, 100% dividend payout rate. You are right. So growth rate should be what? 0. Okay. I think I'm hungry now. Okay. So we'll be getting now this particular part calculation. Come on, yes or no? Yes. So aapka, you'll get this, what is going to be your final answers. But here you should have a doubt, ki sir, what about in the last case, what about your growth? Why is the growth not added here? Why is the growth not added here? Okay, because growth can also be added here. Because this is dividend per share. So growth can also be added here. Now institute in dividend decisions, na, when they have asked Walter and Gordon both, or whenever they have given Gordon's model, when the payout ratio is just a percentage of EPS, na, they have not added growth anywhere. But I will always recommend you that whenever there is Gordon's model and if they give you EPS into payout ratio, na, always in that particular consider case, you have to consider growth rate and take that into consideration. Okay. But here, you know what is assumed, that even in Walter, earning per share was to be considered at the end of year 1. So that's why it's assumed like this, that this earnings is today's earning or this is at the end of year 1, at the end of year 1. So that's why the D1 is also to be considered at the end of year 1. Hence no growth rate. Okay. So you can do this and just write down a note on this, that alternatively we can also do it by adding growth rate to it. Okay. So on that basis you can complete it. Okay. Now come to your illustration 5. What is given to you? X Limited has no growth rate, pays a dividend of 5. If cost of capital is 10%, calculate the current market price. How do you calculate current market price, beta? Can I say your current market price when there is no growth rate, is nothing but your dividend per share, and we capitalize that by KE. So 5 upon 10%, that is nothing but 50 rupees. So that's your KE. Okay. Illustration 6. XYZ is having an equity share capital of what? 10 lakhs of rupees 10 each, and it distributed current dividend. Oh, now the word current is given to you. So now nothing to worry. Can I say this is nothing but your D0? So current dividend is 20% per annum. So that is nothing but 2 rupees. And the annual growth rate is nothing but G, which is 2%. And the expected ROE is nothing but what? 15%. We are required to calculate the share price. So can we calculate the share price? Come on, yes or no? Yes. So to this 2, you add the growth rate, which is 20% upon K is 15% minus, what's the growth rate? It is 2%. Okay. So this is 2%. So this will then give you the final answer, 15.69. Okay. Now let us start with your question number 7. A firm had just paid a dividend of rupees 2 per share last year. Tell me, what is this? D0. And the estimated growth rate of the company is what? 5%. Determine the market price per share if the growth rate rises to 8, falls to 3, and also find out what can be the market price of the share given the required rate of return is what? 15%. Can I put it like this? We just have to apply this in the formula. What's my existing growth rate, guys? 5%. So 2 into 1 plus 5%. Divide that by K is 15 minus 5. So that will give you 21 rupees. Basic question only. If the growth rate is going to be 8%, can I say I'll take 2 plus 8% upon KE minus G? This will give me my 30.86. And in the last case, if this is 3%, then can I say 2 plus 3% upon KE minus G? This is 17.17. So for different growth rates, we have to calculate it differently. Okay. Now this is miscellaneous illustration, illustration number 8. Now this is nothing but exactly your, which model beta? Your approach. RST has a capital of 10 lakhs in equity share of rupees 100 each. Chalo, fast, give me for your illustration number 8, what is your N? What is your N? Give me N. 10 lakh shares of rupees 100 each. What is the N? 10,000 shares. Okay. Then please tell me the shares are quoted at par. So what is the P0? 100. Then they have told you that it proposes to declare a dividend of rupees 10. What is your D1? 10. Then what is next? The capitalization rate for the risk class which is given to you, that is nothing but 12%. This is your KE. Then compute the market price if the dividend is not declared and if the dividend is declared. Assuming that the company pays dividend and has a net profits of what? 5 lakhs. What's your earnings? 5 lakhs. And then they have told you that it wants to make investments of what? 10 lakhs. And then we are required to calculate what is the new number of equity shares should be issued. It means in this particular question, there are two things which are required to be calculated. Okay. First, we are required to calculate what should be your P1 and what should be your change in N. Okay. How will you do this? How to calculate P1 and change in N? Can I say in this particular case, part 1, guys, if your dividends are, let us take dividends are, what is the first part they have told you? Not declared. If dividends are not declared, and here it will be what? Second part, that is dividends are declared. Can you please tell me what's the formula for P0? Fast. D1 plus P1 upon 1 plus K. Do you have P0? Yes. If dividends are not declared, can I say my D1 will become 0? Let the P1 be X. 1 plus 0.12. So can I say your P1 will become 112? And what will be change of N? It is nothing but, can I say, investments minus retained earnings upon P1. What's your investment, guys? Your investment is 10 lakhs. What's my retained earnings? If dividends are not declared, can I say entire earnings? 5 lakhs. And what's your P1? 112. Give me new number of equity shares. 5 lakh, divide that by 112. How much is that? 4464.29 shares. Here you don't have to calculate the value of the company. Here we just have to calculate what should be the P1 and your change. Okay. What about your dividends are declared? So this will become 100 is equal to 10 plus X upon 1 plus 0.12. So this will now become what? Can I say 112 minus 10 is equal to X? So what's your P1 going to be? 102. And here when I'm talking about change in N, can I say this will now become 10 lakh minus retained earnings will become 5 lakhs minus how much dividends are we declaring? 10 rupees on how much number of equity shares? 10,000 shares. So that is 1 lakh rupees. And divide that by what is going to be your price? 102. So this will now become 10 lakh minus 5 minus 1 is 4 lakhs upon 102. So 6 lakhs divided by 102. What is 6 lakh divided by 102? That will give you 5882.35 shares. So just check. This should be your answer. 5882.3. Illustration 9. Now this is Walter and Gordon both combined. We are required to find out the market value per share as per Walter's model. Guys, do you have R? Yes. Do you have K? Yes. You have earnings. If you multiply that by payout ratio, we'll be getting 3 lakhs as your dividend. Divide by number of equity shares 1 lakh. What is going to be my DPS? 3. What is my EPS? 5. I have EPS also, I have DPS also, I have R also, I have KE also. Can I substitute in the values and can I get the formula and apply it and get the Walters model P0? Come on, yes or no? Yes, sir. And what is the optimum payout ratio according to Walter? So what is your R? 15. What's your KE? 12. Is your R greater than KE? Yes. So what should be your optimum payout ratio? 0. Okay. And now your illustration 10. Okay. What is given to you in your illustration 10? Taking an example using 3 different forms, growth, normal and declining, calculate the share price as per Gordon's model. So guys, we have here R, we have KE, we have EPS, we have retained earnings, we have dividend payout ratio. Now this is so easy to calculate. Can I put it like this? What's your P0? D1 upon KE minus G. What's your dividends, guys? What's your dividends? Just check. Can I say your earning is 10 rupees and my dividend payout ratio is 0.4? Dividend payout ratio is 0.4. It means what? My dividend is nothing but 4. So this is 4 upon. What's your KE? Can I say your KE is nothing but 10%? And now I just have to calculate my growth rate. What is my growth rate? Retention into ROE. Can you please tell me what's my retention, beta? 0.6. Because growth is nothing but retention into ROE, na? B into R. What's my retention, guys? 0.6. And what is your R? 15%. So this is 0.6 into 15. How much is this? 0.9 means 9%. Hello? So this is going to be 9%. So finally the answer will be what? Rupees 400. And here anywhere you can just check, there is no growth rate which is added. So whenever the EPS is multiplied by the payout ratio, we assume that to be what? Your D1. So that's why we are not adding any growth rate to it. Okay. So in examination also you have to remember this. But if they use the word current dividend or last dividend, just like the previous question, then it has to be D0. Or else if EPS is a percentage of your dividend is a percentage of your EPS, then we will treat that particular dividend as your D1 and then solve it accordingly. Okay. Illustration 11. Again, in this particular case, we have EPS, we have capitalization rate KE, we have return on investment R, we have payout ratio. We are required to calculate as per Walter's model. Can you please tell me, guys, what is your earning per share? 60. What's your payout ratio? 30. Can I say in that particular case, your dividend per share will be dash 18? We have EPS, we have DPS, we have R, we have K. We just have to substitute that and we'll be getting the final answer. Okay. That's it. So after the break, now we will do all the other practical problems. Okay. So now it's already 2. I will see you like around 2:50 and then we will continue further. Okay. So take a break, relax. Okay. Take a break. Check, check. Okay. Shall we continue? Are you guys there? Let's do this. Now we are doing practical problems for dividend decisions. Okay. Chalo. So let's quickly start now with your practical problems. And we have practical problems. Let us first start with practical problem 1. Okay. Now see what is given to you, that M Limited belongs to a risk class for which capitalization rate is 10%. What is this called as, guys? Can I put it? This is nothing but your KE and it has 25,000 outstanding shares. Can I say this is nothing but your N existing number of equity shares? And the current market price is nothing but what? Rupees 100. So this is called as my P0. Okay. And it expects a net profit of 2,50,000 and the board is considering a dividend of rupees 5. M requires to raise rupees 5 lakhs for an approved investment. So this is your I. Illustrate how MM approach affects the value of if dividends are paid or not paid. Very quickly, we'll all do this together. Okay. Please open your notebooks. Now what is given to you? In the first question, do you have first your N available? Come on, yes or no? What is your N, everyone? 25,000 shares. Then please tell me after this, what's the current market price? 100 rupees. Can you please give me your KE? What's your KE? Your KE is nothing but 10%. And then just check and tell me that it expects a net profit of what? Rupees 2,50,000. So what's your earnings, guys? Rupees 2,50,000. And then they have told you that the current dividend per share is nothing but what, rupees 5. So what's the D0 guys? Sorry, D1, what is it? 5. Okay. And what is the amount of investments? What's your I? Rupees 5 lakhs. Okay. And then they have told you that we are required to find out the how does not have any impact on the value of the firm. Yeah, I told you how many formulas you have to recollect whenever we are doing your dividend decision. 3. What is the first formula? Everyone, please tell me. Value of the firm. Everyone will give the answer in one voice. How do we start? N plus change of N into P1 next minus I plus E, and this is something which you're going to divide with what? 1 plus K. Is this the formula? Solo, yes or no? Okay, so on this basis we can find out what can be the value of the firm. Now, how many options do we have? First, when dividends are, tell me what? When dividends are paid. When dividends are paid, now in this particular case, I have to calculate two important things. Okay, first I want to calculate my P1. Okay, and the next thing I have to calculate is change of N. Give me what is the formula for P0. Everyone, what's the formula for P0? D1 plus P1 upon 1 plus K. Now everyone please tell me what's your P0 guys? 100. What is your D1? If dividends are being paid, then they have told you that the dividend is nothing but 5. What's your P1? X. What's your K guys? Your K is given to you as 10%, which is nothing but 0.1. Can you calculate this now and tell me what is going to be the final answer? 105. Okay. Also at the same time now, how will you calculate your change in N? So for change in N, what it should be, can I say it should be fresh issue? How do you calculate fresh issue? I minus retained earnings, which you have to divide that with what? P1. Now, what is your investment which you are supposed to make? Please tell, what's the investment? 5 lakhs? Solo yaar. Now, what is your retained earnings? Now, your retained earnings is nothing but your earnings minus dividends which we are declaring, right? See, what is the basic meaning of the word retained earnings? Retained earnings means how much amount you have it with you after you pay the amount of the dividends. So please tell me, your earnings is how much guys? 2,50,000. Now, if we are declaring dividends, then what is your dividend per share? What are the number of equity shares? 25,000. So what's going to be your total dividend? 1,25,000. So from 2,50,000, which is my earnings, if I pay your dividends, can I say you'll be getting your retained earnings? Come on, yes or no? Yes, sir. And this is something which we need to divide by P1. And what's your P1, guys? 105. Can you please give me change in N? 3571.42. So can I write down this as 3572? Okay, let us write down this as 3572 shares. 3571.42 na? Arre yaar. Okay, fine, no problem. So this is coming as what? 3571.42 shares. Is this what you are getting as an answer? Come on, yes or no? Yes, sir. Now, what will be the value of the company? Guys, please tell me, what's your N, existing number of equity shares? 25,000. What's your fresh issue? 3571.42. What is your P1? What is your P1? 105. What's your I? 5 lakhs. What's your dividend per? What is your total dividends? What's your earnings? 2,50,000. And this is something which you're going to divide that by 1 plus, what is this beta? 0.10. Can I say I can get the value of the company? Come on, yes or no? Yes, sir. What will be the value of the company? Everyone please calculate this and tell me what's the value of the company. So you will come to know that the value of the company is nothing but 25,000 plus 3571.42. Multiply that by 105 minus 5 lakh plus 2,50,000. Divide that by 1.1. I am getting the answer as 25 lakhs. Hello? Are you all getting the answer as 25 lakhs? You can ask me, what happened? Arey, ask na. E is what? No, this is earnings, not retained earnings, beta. So earnings means what? How much profits am I generating at the end of year one? So I have to take into consideration earnings, and earnings is 2,50,000 only. I'm not taking in the numerator retained earnings. What I'm taking in the numerator is how much money which I've earned. So how much money which I've earned is, that is nothing but how much amount, beta? 2,50,000. Okay. So this value of the company is coming as 25 lakhs. Can you all try for me what should be if dividends are not paid? What will be the changes? Everyone please tell me when dividends are not paid. Can I say here instead of D1 it is going to be what? 0. Solo yaar. So your P1 is going to change. Come on, yes or no? Yes sir. Also at the same time, please tell me, will your change of N also change? I am asking you, will your change of N also change? Yes. Can I say instead of 1,25,000, this will be what? 0. And then you have to calculate the number of equity shares and then calculate the value of the company. Chalo, do it on your own and give me the answer. Fast. Start. Online students, you all can also solve this on your own. Come on, fast. Give me the answer, guys. When you will be taking into consideration when dividends are not paid, are you all getting the same answer, which is 25 lakhs? Can you please give me what's the P1 which you have got? 1, 10. And what's your change of N which you are getting? 2,000.73 shares. This should be your answer. Are you confident now with the approach? Now with approach, I don't think you all need any further help now. Any kind of question which will come, you will be able to find out the value of the company. Okay? Chalo, continuing further. Now I wanted to please come to your question number 2. The following information is supplied to you, in which we have total earnings which is 2 lakhs. Number of equity shares is 20,000. Everyone please tell me what's your EPS? 2 lakh divided by 20,000. What's your EPS? Why are you taking so much time? 10 rupees. What is your dividend paid? 1,50,000. We have to divide that by number of equity shares which is 20,000. Give me what's your DPS? 1,50,000. Divide that by 20,000. How much is that? 7.5. Is this your DPS? And this is your PE ratio. Applying Walter's model, analyze whether the following is an optimal dividend policy. Now in this particular case, we have EPS, we have DPS. Based on that, we need to check what is going to be your optimal dividend policy. Okay. Please tell me first of all, in your question number 2, to determine whether optimal policy or not, we need R and K. Do you have R in the question? No, we don't have R in the question. But at least I have total earnings and I also have my equity share capital. So R is nothing but what is my return on equity? How much return I'm generating on my equity shareholders funds. Now just check and tell me, the return on equity can be calculated by taking net profits available for equity shareholders divided by equity shareholders funds into 100. Solo, yes or no? Now what is the net profit which is available for equity shareholders? Just check. The net profit available for equity shareholder is 2 lakhs. Now what about the equity shareholders funds? Equity shareholders funds is 20,000 shares of rupees 100 each. So can you please tell me what is this going to be? 20 lakhs, you multiply this by 100. How much percent? 10%. So this is your R. But now let's also talk about your KE. Can I say KE is nothing but 1 upon PE ratio? Have you heard about this? KE is nothing but 1 upon PE ratio. This is also one of the formula on the basis of which you can calculate your KE. Now, what is your PE ratio which they have given to you? Just check and tell me. Is the PE ratio available? Yes. 12.5. Can you please give me your KE? 8%. Now, please tell me what's your R? 10. And what's your KE? 8. So, is your R greater than KE? So, what should be your optimal payout ratio? It should be 0. But is the company still declaring dividends? Yes. The company is still declaring the dividends. So is the company following optimal policy or company is not following optimal policy? Not following. Compute the P ratio at which dividend policy will have no effect in the value of the share. So what should be the P ratio when there is not going to be any impact on the value of the share. Now, what do I mean by this? Can I say that when R is equal to KE, can I say that any payout ratio which you give, value of the equity share is going to be constant? Come on, yes or no? Yes, sir. So when R is equal to KE, anything what you pay, it doesn't even matter. You know, your market price is going to be constant. It's going to be 0. Now, my dear students, just check and tell me what was your R. Your R was 10%. What's your KE? Your KE is 10%. So is your R is equal to KE first of all? Only when R is equal to KE can I say that the price will not be having any impact. Now, what is the formula for KE? Can I say that is nothing but 1 upon PE ratio? So what do you think will be your PE ratio? 1 upon KE? Hello? Now do I have the KE? Come on, yes or no? Yes, sir. My KE should be what? 10%. So 10% is 10 divided by 100. So that is 0.1. And if you solve this, then you'll be getting this as 10 times. So what is 10 times, guys? 10 times is nothing but that particular P ratio at which will there be any effect or there won't be any effect. There is not going to be effect on the value of the share. Did you guys get this? Okay. So this is your question number 2. Second part. Then what's the third part? Will your decision change if the P ratio is 8 instead of 12.5? Guys, if the P ratio is 8, can you please tell me what is going to be the new KE when the P ratio is 8? Very good. It is nothing but how much? 12.5. Now what's your R? Your R is 10%. Your K is 12.5%. Don't you think that your K is greater than R? Come on, yes or no? Yes, sir. And when your K is greater than R, can I say your optimum payout ratio should be what? 100%. So will your decision change? Yes. We want our payout ratio to be 100%. So this was your question number 2. Question number 3. With the help of the following figures, we are required to compute what is the market price of the share using Walter and using dividend growth model. Okay. Do we have EPS? Yes. DPS? Yes. KE, IRR and retention ratio. Okay. Now, if I talk about Walter, do you have R available? Come on, come on, come on. Internal rate of return on investments. It means how much return on investment we are generating. So do we have R available? Come on, yes or no? Yes, sir. Do you have KE available? Come on, yes or no? Yes, sir. Do you have EPS? Come on, yes or no? Yes, sir. We also have DPS. Do we have all the elements to calculate the price as per the Walters model? Come on, yes or no? Yes, sir. But what about dividend growth model? Now in dividend growth model, what we have to do, beta? We have to use Gordon's formula. So what is Gordon's formula, beta? Can I say your Gordon's formula is nothing but P0 is equal to what? D1 upon KE minus G. Now we already have the dividend per share. What is the dividend per share? 6 rupees. Okay, we have the dividend per share which is 6 rupees. But do I have my growth rate available? No. But do I have the ROE available? Yes. So can I say my G will be nothing but what? B into R. What is B? My retention. What is my retention? 40%. So this is 0.4. What's my R, everyone? My R is nothing but 25%. So what will this give you, beta? 10%. So do I have my growth rate which is 10%? Solo yaar. And what's your KE, everyone? Your KE is nothing but 20%. Is this data sufficient for you to calculate the answer? And this will be 60 rupees. Are you guys understanding this? Sure, confident? Okay. So this is nothing but your 60 rupees. Question number 3. You can just check. We'll be having this as 60 rupees. So institute also takes into consideration, as I told you, the dividend, which is nothing but the expected dividend at the end of year 1 and not your D0. Okay. Fine. Let us continue this further and let us come to your question number 4. The annual report of XYZ for the following information, provide the following information. You have net profits. Can I say this net profits is always called as what? Net profits after tax. Do you have any preference shares available? Come on, yes or no? Yes. How much is that? 100 lakhs. Now, what is your percentage of preference dividend? 15%. So can you all please give me the amount of preference dividend? What will be the amount of the preference dividend? Can I say 100 lakhs into 15%? That is nothing but what? 15 lakhs. We will have number of equity shares which is 5 lakhs. There is R which is return on investment and then there is KE which is 16%. And then what is required to be calculated? Calculate the price of Gordon's model using dividend payout ratio. Oh, can I say this is very similar to the question which we have just now solved in the illustration where I took 75%. Can you recollect that? So here in this particular case, we have to find out using which model? Gordon's. They have mentioned Gordon's. I don't think so. How have they solved this? Have they solved as per Gordon or Walter? They have solved as per Gordon only. Okay. So in Gordon's model, as you all know, that how are we going to approach this particular question? We have got NPAT minus preference dividend, net profit for equity shareholders. We divide that by number of equity shares, we get the EPS. Now see, what is your Gordon's model? Can I say, don't refer to this formula. This is D1 upon KE minus G. What is D1? Whatever is your earnings, multiplied that by payout ratio. This is KE. And what is G? Can I say B into R? So it's the same thing only, but they have presented like this. Okay. So do I have the earning per share? Yes, which is 7. What is the first payout ratio which is given to you in the question? 25%. So please take 7 and multiply that by 25%. We'll be getting this as 1.75. Do you have K in the question? Yes. Do you have growth rate in the question? Yes. Retention into ROE. So then eventually this price will become 175. This is just now what we did in the illustration, the same question. We have it. Okay, so this was your illustration number 4. Okay, now please come to illustration number 5. Now see, this question is important. What is given to you? A&R is a large multinational company which is listed in BSE with a face value of rupees 100 per share. The company is expected to grow at the rate of 15% per annum for the next 4 years and then 5% for indefinite period. So is it a one-stage growth model or there is a two-stage growth model? Two-stage. Because for year 1 to year 4, the growth rate is what? 15%. And from year 5 onwards, the growth rate is what? 5%. So don't you think that it is definitely your two-stage growth model? Now, whenever there is going to be a two-stage growth model, you always have to understand that in a two-stage growth model, we will have to find out the value of the share, not by using Gordon's formula, this is P0 is equal to D1 upon KE minus G. Because what does Gordon tells you? That if you are using my formula, P0 is equal to D1 upon KE minus G, if you want to find out what should be the price today, that is by taking D1 upon KE minus G, the most important part is you should know that the growth rate should be constant and it should be constant till perpetuity. Towards the life, this should be constant. But if it is not constant towards its perpetuity, I cannot use this Gordon's formula. So in that particular case, it is possible that my growth rate for the first 4 years is different. Now my growth rate from which year onwards is constant? 5th year onwards. Now in that particular case, can I calculate price at the end of the 4th year? I can calculate what? Price at the end of which year, beta? Price at the end of the 4th year. Because what's the formula for price at the end of the 4th year? D5 upon KE minus G. Did you realize this? See, if the growth rate is constant from year 1 onwards, what do I do? If the growth rate is constant from year 1 onwards, I can take D1 upon KE minus G. Example, if the growth rate is constant from 2nd year onwards. Can you now please tell me if the growth rate is constant from 2nd year onwards, what should I take here? P1 upon what? D2 upon KE minus G. Acha, if the growth rate is constant from 3rd year onwards, what should we take? Price at the end of the 2nd year upon D3 upon KE minus G. Are you guys understanding? If the growth rate is constant from 5th year onwards, then can I say I can calculate my P4, which is D5 upon KE minus G. So remember this concept that Gordon's model can only be applied when dash is constant, when growth rate is constant. If growth rate is constant from 5th year onwards, can I calculate the price at the end of the 4th year? Come on, yes or no? Yes, sir. Which will be nothing but D5 upon KE minus G. Everyone got it? Okay. Now just check what is given to you in the question. That the shareholders expect 20% of the return on investment. So that's nothing but their expectation, which is KE. Company paid a dividend of rupees 120 per share for the current financial year. Everyone please tell me, if the company paid a dividend per share of rupees 120, what will you treat this 120 as? Can I say I will treat this as D0? Come on, yes or no? Yes, sir. So my dividend per share for D0 was 120, but this is going to grow at what percentage rate? Can I say it is going to grow at the rate of 15%? So this I have to add it by 15%. Everyone, 120 plus 15%. Give me the answer. 138. Then what do I have to take? 138 plus 15%. Can you please give me what is this? 158.7. Can you please give me 158.7 plus 15%? 182.5. And then it will be what? 182.51 plus what? 15%. Add 15%. What is this? 209.88. Are you all convinced by this? Okay. But while calculating D5, this D4 dividend is growing at what percentage rate? Have they told you that they are going to grow at the rate of what? 5%. So I'll consider 5%. What's my KE? My KE is given to you as how much percentage, guys? My KE is given to you as 20%, which I need to subtract it by 5%. Can you give me the answer now? How much is this going to come? 1469.16. 1469.16. So this will now be, if I add 209.88, so this will be what? 1679.05. Okay. Now are all these my cash inflows at the end of year 1, at the end of year 2, at the end of year 3, at the end of year 4? Now if I want to find out the value today, you tell me what should I do? Very good. Can I say I should discount this at what percentage rate, beta? 20% rate. And can I say then I'll be getting the present value? Come on, yes or no? Yes, sir. So in the question, see, they have asked you that only. What have they asked you? That the shares are currently traded at. This is the market price. We are not worried about the market price. You are required to find out the intrinsic value per share. So can I find out the intrinsic value per share by taking this stream of cash flows and then discounting it and then bringing it to present value terms? Come on, yes or no? Yes, sir. So what's the final answer which will come, beta? Can I say then I will discount it 1 divided by 1.2 with 138, 158, etc. I'll divide it. And then ultimately I'll be getting what is my intrinsic value. Have you all understood this? Okay. So this is called as which model, beta? Two-stage growth model. Okay. Any doubts? Okay. So in a two-stage growth model, what do we need to do, guys? Can I say we have to first of all find out what? In a two-stage growth model, what do we have to do? We have to find out D1, D2, D3, D4 till the time when the growth rate is constant. Once we have calculated that, then after that we have to calculate what should be the price at the end of the 4th year. It is also called as terminal value. What is it called as, guys? Terminal. It's called as a terminal value. And all these series of cash flows, we will discount it at what percentage rate, beta? 20%, which is your K, to get the present value. So just check the solution. Here you will come to know that we will be doing all those things and then the present value will be available. So as you all can see, can you just check? We all have discounted all these cash flows. And then ultimately we'll be getting the present value, which is coming as 1140.51. Now please tell me, my dear students, if the intrinsic value is 1140.51, what is the actual market price? Can you please give me the actual market price in the question? The actual market price is 3122. Now this is the intrinsic value. Actual market price is 3122. What do you think you all are going to do? If this is the intrinsic value and if this is the actual market price, should you purchase or you should not purchase? What do you think you should do? You should purchase or you should not purchase? Answer is don't purchase. Why? Because what's the worth according to your calculation? According to your calculation, the worth is what? 1140.51. But as per the market, what is the worth? 3122. Don't you think it is overpriced? Come on, yes or no? Yes, sir. And if it is overpriced, we will not make investments. Okay. Chalo, question number 6. In the month of May, the current financial year, the shares of RT was sold for rupees 1460. Everyone, please tell me what is going to be your market price. Your P0 is available as 1460 solo, yes or no? Yes. Okay. And the long-term growth rate is 7.5%. So this is your G, which is 7.5%. And it paid a dividend of rupees 20 per share. So this is your D0, which is nothing but rupees 20. Okay. Calculate the rate of return for an investor which can expect to on assuming that the dividends will grow at a constant rate of 7.5%. Now, how do you calculate your KE? D1 upon P0 into 100 plus G. Now, can I say your D0 was 20? Come on, yaar. And what's your growth rate? 7.5%. What's your P0? 1460 into 100 plus 7.5%. Can you give me the answer? So this will be 20 plus 7.5%. Divide that by 1460 into 100 plus 7.5. You should all get the KE, which is nothing but 8.97%. Are you guys trying to understand? So this is coming as 8.97%. Okay. What's the second part? It is expected that RT will earn how much? 10% and on retained earnings and shall retain 60% of the earnings. Can I say in this particular case, will your growth rate change? This is B into R. What is your retention, guys? 0.6. And how much are you going to earn on that? 10%. So what should this be? 6%. Now, in my opinion, Institute has solved wrongly for the second part, because they have considered this D0 as something else. They have reversed the calculation and then they have done it. But this, what I'm solving it on the screen, is the correct solution, where what is need to be done in this particular case, whether there should be any change in the growth rate or cost of equity. So is there any change of growth rate? Yes. And what is going to be the cost of equity? D1 upon P0 into 100 plus G. Now please tell me, do you have last year dividend given to you? Come on, yes or no? Is the last year dividend which is given to you? Come on, yes or no? Yes. How much is that? 20 rupees. Now what is the new growth rate, guys? 6%. What's your P0? 1460. Come on, yaar. Into 100 plus what's your growth rate? 6%. Can you give me the answer for this? $20 plus 6%. We have to divide that with what? 1460 into 100 plus 6. So this should be coming as 7.45%. So whenever there is last year dividend paid, now we have to interpret that as D0 only. There should not be any other interpretation regarding the same. Okay. So that's why please follow this particular solution. Okay. When you are solving it. You want to copy this down, just copy this down. This much part. Copy this down. Okay. Just complete this. Or else you'll be confused when you will see ICAI answer. Now see, I'll explain you this two-stage growth model once again. See what happens in two-stage growth model. Okay. Now let's say, for example, understand something like this, that suppose your last year dividend is 10 rupees. Okay. What's your last year dividend? 10 rupees. Now this dividend is growing at the rate of 10%. Okay. For first 3 years. This dividend is growing at the rate of 10% for first 3 years. And after that, your growth rate is nothing but 5%, which is constant from 4th year onwards till perpetuity. Okay. And the D0 is given to you as this, and your KE is available as 15%. Now, if you want to find out what should be the price today, so I cannot use the formula P0 is equal to D1 upon KE minus G. I cannot use this formula. Ask me why. Because can I put it like this, that in this particular case, the growth rate is not constant towards perpetuity. There are two stages of growth. When does the growth rate becomes constant, beta? Can I say the growth rate becomes constant from which year onwards? 4th year onwards. So can I put it like this? Year 0, 1, 2, 3. From 4th year onwards, it becomes constant. So when this year onwards, the growth rate becomes constant after the end of 3rd year, right? 4th year onwards, it becomes constant. So then in this particular case, what should I do? I can calculate the price at the end of 3rd year. Can I calculate price at the end of the 3rd year? Yes or no? Yes. So what will be the formula for the same? D4 upon KE minus G. Because when we are calculating P0, we are taking D1. We take next year's dividend. So when we are calculating price at the end of the 3rd year, we should take what? D4 upon KE minus G. So then I'll be getting the price at the end of third year. Now I want to find out the value of something today. What is the value of something today? I will see over the 3 years what is going to be my dividend per share and what is going to be the market price per share. And once I know these are the cash flows which I'm going to receive, all this dividend per share, market price per share, all this is nothing but your what? The cash flows which you are going to receive. Can I say these cash flows which you receive, if you discount it at a particular percentage, will I be getting the present value? Come on, yes or no? Yes, sir. Understood this? So that is why it is important for you to first understand that what should be your future value of cash flows, which we have to discount it, we have to bring it to the present value terms. Got it? Okay. Now come to question number 7. Akash Limited has 10 lakh equity shares outstanding at the start of the accounting year. The existing market price is 150. Okay, everyone, please tell me, question number 7. What's your existing number of equity shares? Come on, 10 lakhs. Then please continue further and tell me, what's the P0? How much is it? Rupees 150. Expected dividend is what? 8%. 8 per share. So your D1 is nothing but what? Rupees 8. The rate of capitalization rate for which the company belongs is 10%. This is your KE. You are required to calculate the market price per share when dividends are not declared and declared based on your approach. Come on here. Now can you calculate P1? Come on, yes or no? Yes, sir. We have done many questions of the same type. How will you calculate P1? We have to take P0 is equal to D1 plus P1 upon what? 1 plus K. And on this basis, can I say we can find out your P1? Come on, yes or no? Yes, sir. First part. Second, calculate the number of shares to be issued. The same thing which we did it in the illustration. We have to find out now change in N. How will you calculate change in N? From your I, you subtract what? Retained earnings. And we divide that with what? P1. Can I say you will be getting the number of equity shares? Come on, yes or no? Yes, sir. Where your earning is 3 and your I is 6. Dividends are declared and dividends are not declared. Okay. And proof that the market value of the shares at the end of the accounting year will remain unchanged when the dividend. So this is nothing but the value of the company which I told you. So you can use your value of the company and based on that we can do the necessary calculation. Okay. So this question is a good question. If you want to practice, you can practice it. Question number 7. Same process is there. Okay. Chalo, question number 8. What is given to you? Mr. H holding 1 lakh shares of HM Limited and currently the share of HM is trading on Bombay Stock Exchange for rupees 50 per share. Everyone please tell me what's your N? What is your N? Hello? What Mr. H is holding how many number of equity shares? 1 lakh shares. Matlab you are holding 1 lakh shares. Come on, yes or no? Yes, sir. And what is the current market price of the equity share? Huh? 50. Mr. A have a policy to reinvest the amount of any dividends received into the share back again of HM Limited. So whatever dividend you are going to receive, what are we going to do? We will buy the shares of HM only. If HM has declared a dividend of rupees 10 per share, please determine then the number of shares that Mr. A would hold after he reinvests. This was asked recently in Jan 26 only, or probably one attempt before that. Okay, the same concept, the same question was asked. What are the number of shares you are going to repurchase it? Please tell me what is your 1 lakh shares? 1 lakh shares, this is nothing but what you are holding. Solo yaar. What is the dividend? Come on. Dividend is 10. Can you please tell me what's the total dividend? Can I say total dividend is nothing but 10 lakhs? Okay, but what Mr. H is going to do? He is going to purchase the shares. And what is the share price? But here we just have to pay attention that this is rupees 50, which is called as your cum dividend price. But after the dividend has been declared, don't you think that your share will become what? X dividend. So then we have to purchase this at 50 rupees or we have to purchase this at X dividend price. X dividend price, that is nothing but 40 rupees. So then you have to take this 10 lakh and divide that. You will be getting the final answer, which is nothing but how much? You take 10 lakh and divide by 40. How many number of shares? 25,000. So what was the old shares? 1 lakh. Divide by 25. 1,25,000. You all can just check this out here. 1,25,000. Understood this? Okay. Very easy. Okay. What's the next question? Question number 9. See what is given to you. From the following information of DG Limited, what do you have? Number of equity shares is what? 1 lakh. Earning per share is what? 25. PE ratio is what? 20. And book value per share is what? 400. If the company decides to repurchase 25,000 shares, do you know this repurchase of equity shares is also called as what? Buyback. At the prevailing market price, what is the resulting book value per share after the repurchase? So we have to find out what is the book value per share after the repurchase. Okay. Please tell me guys, what is the total equity shareholders funds right now? Just check. There is 400 rupees per share and there is 1 lakh shares. Okay. So that is nothing but what is going to be your equity shareholders fund. So how do we approach this? See, current market price is 20 into 25. That is nothing but 500 per share. Because we have the EPS, we have the PE ratio, we can get the current market price, which is nothing but 500. Book value of the company is what? 400 into 1 lakh. That is nothing but 4 crores. Now we are purchasing 25,000 shares for 500 rupees. So don't you think that after this, the book value will become what? 2.75. Because you had equity shareholder fund of 4 crore. Na? From that 4 crore, are we repurchasing 1.25 crore? So you will be left with what? 2.75 crores. And what are the number of equity shares? 75,000. So if you divide this by 75,000, you will be getting what? Book value per share, which is 367. Because what is book value per share? Equity shareholder funds, which is something which you have to divide by number of equity shares. So that will give you the final answer. And with this, my dear students, we are done with your dividend decisions. Okay. Now, my dear students, we are starting with a new chapter, and that is called as your investment decisions. Okay. Now, in this investment decisions chapter, first we will do all the types of methods and we'll be covering all questions of all the types of methods. Okay. But just make sure that you practice more questions from a study module regarding the same, because everything will not be covered. So we'll try to do as much as possible regarding your investment decisions. Okay. See, first of all, my dear students, whenever we deal with your investment decisions, what do you mean by this? Okay, sir, when we are making an investment in a particular project, then that project needs to be evaluated by so many multiple parameters. Now you just can't make investment in a project looking at only one parameter, right? We have to consider different type of parameters for the purpose of making analysis in the project. Now, in this particular case, what can be the different types of parameters for the purpose of making evaluation of a project? So in all, in investment decisions, there are 7 main methods. How many main methods are there, guys? 7. The first one, which is called as your net present value method. Okay, something which you already know. NPV method. This is also called as DCF technique, discounted cash flow method technique. The second method which we have is called as your internal rate of return, or also known as your IRR. The third one, we call it as your profitability index method. And this profitability index method is nothing but the extended version of your NPV method. Then we have something which is called as your payback period method. After payback period, then we have something which is called as your discounted payback period method. Then we have something which is called as average or accounting rate of return. And towards the last, we have something which is called as your modified internal rate of return, MIRR. So these are the 7 important methods on the basis of which we evaluate a particular project. 7 methods: NPV, IRR, profitability index, PBP, matlab payback period, DPBP means discounted payback period, then your ARR or average or accounting rate of return, and then there is something which is called as MIRR, which is modified or internal rate of return. Now, my dear students, before we start with even any of those methods, you all should be aware about the distinguish between book profits versus your cash inflows. Okay. Now, are you all aware about the fact that we start with the income statement where we start with what? Sales. From sales, what do you subtract? Variable cost. That's what you all have learned, na? In leverage is sales less variable cost. What do you get? Contribution less fixed cost. What do you get? Net profit before interest and tax, EBIT. But I will write down here net profit before interest, depreciation and tax. Now from NPB IDT, interest, depreciation, tax, the first thing I should subtract is my interest. So what will I get? Net profit before depreciation and tax. Then if I subtract the amount of depreciation, then what we get is called as net profit before tax. Then what do we have to pay, beta? Tax. So what will we get? Net profits after tax. But this net profit after tax, don't you think has depreciation subtracted in it? But please tell me, is depreciation a cash expenditure or it's a non-cash expenditure? So you don't pay the amount of the depreciation, but you definitely debit in the books of accounts. So in this particular case, your profits gets reduced and your tax got saved. But this NPAT, I have to again add the amount of depreciation to get something which is called as your cash inflows. So in investment decisions, what do you think should be the format of your entire income statement? We start with what, everyone? Sales. From sales, what do you subtract? Come on. Variable cost. What do you get? Contribution. Then from contribution, what do you subtract? Fixed cost. What do you get, guys? Net profit before interest, depreciation and tax. Now see here, I will specifically subtract depreciation and then add back the amount of depreciation. Because depreciation debited in the P&L account reduces the amount of the profits and it will help you to save your tax. But that money is not going away from you. So that's why when calculation of cash inflows is going to be there, what do you think will you do with the amount of the depreciation, beta? You're definitely going to add it and ultimately you'll be getting something which is called as your cash inflows. Are you understanding this? Okay. So do you recollect in ratios our income statement format was different? Solo yaar. There we were taking COGS. In leverages, don't you think we were taking variable cost and contribution and fixed cost, EBIT? In capital structure, we started our income statement only with EBIT. Can you recollect all these things? So here in investment decisions, we are starting with the income statement from what? Sales. Then variable cost, contribution, fixed cost. But here special emphasis should be done on what? Depreciation. That's why we first subtract depreciation. Then we add it back. So depreciation has a special role in your investment decision because it helps you to calculate your cash inflows. You guys got this? Okay. Now all these cash inflows, year 1, 2, 3, 4, 5, whatever are the cash inflows which are there, are these cash inflows in present value terms or these are in future value terms? Future value terms. If these are in future value terms, what do you think we have to do with the same beta? We have to discount it and then we have to convert that into what? Present value of cash inflow. So this is called as the value of the project or PV of CI. And present value of cash inflows, you will have to subtract it with something which is called as what? Present value of cash outflows to ultimately get something which we call it as NPV, also known as net present value. Okay. So apparently what we have to do, we have to first learn how to calculate your cash flows. Now, my dear students, whenever we are making investment in the project now, then there are two main types of cash outflows which are possible. How many main types of cash outflows, guys? Solo yaar, how many main types of cash outflows? Two types of cash outflows. First, we call it as initial investment. And second, we call it as investment in working capital. Okay, so whenever you want to make investment in a project, can I say that first thing is required is what? Can I say investment in fixed assets of the company? But also at the same time, can I say we also have to keep some amount by the way of working capital for its smooth functioning? Come on, yes or no? Yes, sir. So that's why we have initial investment and we have investment in working capital. But when do you make such investments? Do you make the investment in future or you make the investments today? We make the investments today. We make the investments right now. And we make the investments right now. It means that we need to multiply it with what, guys? We need to multiply it by 1. And that's how we will be getting the present value of cash outflows. So to calculate the present value of the cash outflows, what we have to do, guys? We will take initial investment. We will take investment in working capital. We will multiply that by what? 1. Why 1? Because today, value of 1 rupee is 1 rupee itself. Right? Don't you think in future the value of 1 rupee is going to change? Come on, yes or no? Yes, sir. So that's why it's important that we convert that into present value. But today, when we make investment at year 0, what is the value of 1 rupee? That continues to be what? 1 rupee only. So that's why all these initial investments and all these investments in working capital we multiplied by what? 1 to get something which is called as your present value of cash outflow. Are you guys understanding this? Okay. Then my dear students, we are having something which is called as your cash inflows. Now, how many main types of cash inflows are there? So there are 3 main types of cash inflows. When we invest in a project, Shri, when we invest in a project, what is the cash inflow which gets generated? Can I say cash inflows from the projects will be generated? Come on, yes or no? Yes, sir. So the first part is, what is the cash inflow from projects? First, we have to check that out. Okay. How much money the cash inflows we are getting generated from the project. Then after that, the money which is generated from the project, also at the same time, when the project life is over, the fixed assets will be sold. So can I say we will be getting something which is called as your salvage, residual value, scrap value? Come on, yes or no? Yes, sir. I will call this as what? Salvage. And whatever working capital, guys, you invest, what do you think happens to the working capital? Don't you think it will be recovered at the end of the project? Come on, yes or no? Yes, sir. So this is called as my recovery of working capital. What is it called as, everyone? Recovery of working capital. So always remember, my dear students, these cash inflows are of how many types, beta? 3 types. Number 1, cash inflow from projects. Number 2, salvage. Number 3, recovery of working capital. Now please tell me, salvage and recovery of working capital, when is it going to happen? Will it happen now or it will happen at the end of the project? So that's why we need to multiply this with what? We will multiply this by with whatever is the PV factor at end of the project. Come on, yaar. Are you guys understanding? And this cash inflows from project. Whatever cash inflows which is getting generated from the project. Can I say this can be constant or this can be not constant? Now when I say that the cash inflows per annum are constant, it means every year it is same. Then I can use the concept of PVAF, present value annuity factor, to calculate its present value. And when the cash inflows per annum is not constant, then we have to compulsorily prepare the table and then do it. So if I tell you that here 1, 2, 3, suppose cash inflows are 1 lakh, 1 lakh, 1 lakh. Can you please tell me, are these constant? So instead of taking 1 divided by 1.1, which is 0.9091, 0.8264, 0.7513, what we will do, we will take the total of this. And this total will be called as your present value annuity factor. And this PVF, we need to multiply it with what? 1 lakh. So if I take 1 lakh and multiply that by PVAF, what do I get, beta? Can I say present value of cash inflow? Come on, yes or no? Yes, sir. So cash inflow from projects formula is what? Whatever is your cash inflow per annum, you multiply that with what, beta? PVAF. Will be getting the PV of CI. Come on, yes or no? Yes, sir. Okay. And working capital and recovery and your salvage, when does that happen, beta? That always happens towards the end. So that's why we always multiply that with what? PV factor towards the end of the project. Are you guys okay with this? Okay. Right. Very good. So basically, whenever we are calculating NPV, then for purpose of calculation of NPV, we will have some steps. So apparently there are 3 steps to calculate the NPV. How many steps are there, beta? 3 steps. The first step is, how do we calculate NPV? By taking PV of CI minus what? PV of CO. Will this give you NPV? Come on, yes or no? Yes, sir. The second step is that we are required to calculate what is your PV of CO. So how many types of COs are there, everyone? Come on here, we just now discussed how many types of COs. 2 types. First one, initial investment, and second one, investment in working capital. We need to multiply it by 1. Can I say we'll be getting the present value of cash outflow? Come on, yes or no? Yes, sir. And guys, what is the third part? The third step is nothing but PV of CI. Can you please tell me how many types of CIs are there? 3 types. So then we need to check what is project, what is salvage, what is recovery, calculate its present value, add it up. And that will be PV of CI. Then substitute that PV of CI, PV of CO, we get NPV. Understood, everyone? NPV. NPV should be lower the better or NPV should be higher the better? Lower or higher, everyone? NPV should always be higher the better. Then my dear students, we have something which is also called as your IRR method. What is the second type, guys? IRR. Now what is IRR? IRR is your internal rate of return. What is it, everyone? Internal rate of return. It is nothing but a discounting factor at which your PV of CI is equal to PV of CO. What is IRR, beta? It's a discounting factor at which what is equal to what, beta? PV of CI is equal to your PV of CO. Are you understanding this? PV of CI, PV of CO, both should be your same. So it all depends on what is going to be your PV of CI and PV of CO. So how will you do this? So for that, it is very important for you to first understand that suppose your cash inflows for the 3 year is, example, 1,50,000 and 1,25,000. Okay. Suppose there is some salvage also. So should I add the salvage? Yes. Suppose there is any recovery of working capital. So should I add the recovery of working capital? Yes. So whatever is the series of cash inflows, now this needs to be discounted at a particular rate that your PV of CI should be what? Equal to your PV of CO. Both these things should be the same. If both these things are same, nothing like it. If your PV of CI is equal to what? Your PV of CO, nothing you have to worry about. Can I say that you will be okay with anything and you can definitely make that will be treated as your IRR. But guys, if your PV of CI is greater than PV of CO, then can I say, what do you think we have to do with the discounting factor? Can I say your discounting factor needs to enhance? We have to increase the discounting factor in such a way that my PV of CI becomes what? Less than PV of CO, and then we will have a range available. And once the range will be available, can I say we can use interpolation to calculate what should be your NPV. Of course, we'll be solving all these things. Okay, but for the timing, you all should know what is IRR. IRR is that particular dash, discounting factor, at which dash is equal to dash. PV of CI is equal to PV of CO. At IRR, NPV should always be dash. 0. Okay. What do you think, guys? IRR should be lower the better or higher the better? Lower or higher? Higher. It's a rate of return. It should always be higher the better. And we always compare IRR with cost of capital. Suppose your cost of capital is 15% and your IRR is 20%. Everyone in one voice, is your IRR greater than your cost of capital? If your IRR is greater than the cost of the capital, then can I say we should invest in the project? Come on, yes or no? Yes, sir. And if your IRR is 10% and the cost of capital is 15%, should you make investment in the project? Then the answer is no, because your NPV will turn out to be negative. NPV, guys, should always be lower the better or higher the better. And if there is one single project, NPV should be negative or NPV should be positive? Positive. Okay. So you all are aware about all these things. How do we calculate IRR? By using trial and error method. Then my dear students, the third method which I have written is your profitability index method. Now under NPV decision, what do you do, beta? Under NPV, what do? You take PV of CI and you subtract PV of CO. So yaar, we get NPV. But in profitability index, index means a ratio. So in that particular case, what do you think we should do? PV of CI, divide that by PV of CO. Will that give you profitability index? Come on, yes or no? Yes, sir. Guys, what do you think your profitability index? Should it be lower the better or PI should be higher the better? Profitability index, lower the better or higher the better? Always remember that my profitability index should be higher the better. Because higher the profitability index, it will give you a better 1 rupee of cash outflow compared with 1 rupee. We will get a better PV of CI as compared to 1 rupee of your PV of CO. So for example, there are two projects. One has a profitability index 2.5:1. One has 1.5:1. Which project will you select? Project A. Why? Because here the profitability index is higher. At IRR, profitability index should always be dash. Very good. At IRR, PI should always be what? 1. Why PI should be 1? Because at IRR, can I say PV of CI is equal to what? PV of CO. If PV of CI is equal to your PV of CO, then can I put it like this, that the profitability index has to be dash? Can I say profitability index has to be 1? Come on, yes or no? Yes, sir. Solo here. Okay. Now, profitability index. Then the fourth method is your payback period method. Now, what is payback period method? Payback period method actually tells you the time period in which whatever investments you make, you are going to recover that. That is called as your payback period. What is payback period, everyone? The time period in which the investments made will be recovered. Now, there are two possibilities in the payback period. When the cash inflows are constant, and when the cash inflows are not constant. Now imagine something like this. Suppose you are investing in a project and every year you are receiving 10,000, 10,000, 10,000 per annum. And you have invested in the project 50,000 rupees. Can you give me the payback period? What's the payback period, guys? Can I say it's nothing but 5 years? So how did you get this particular 5 years? You took your cash outflow and you divided that by your cash inflow per annum. Will you get your payback period, which will be nothing but 5 years? Come on, yes or no? Yes, sir. Acha, when the cash inflows are not constant, then you'll be having year 1, 2, 3, 4, 5. You'll be having the cash inflows. Let's say 10,000, 15,000, 5,000, 20,000, 5,000. Then can we put it like this? We have to calculate now cumulative cash inflows. What do we need to calculate, guys? Cumulative. So what is cumulative cash inflows? If this is 10,000, this will also be 10. 10 plus 15, everyone, 25. 25 plus 5, everyone, 30. 30 plus 20, everyone, 50. And 50 plus 5, how much? 55. Now suppose I have invested 50,000 rupees. Then please tell me in which year are we recovering that 50,000 rupees? At the end of the 4th year. And just in case, if I had invested 40,000 rupees. Then can I say this 40,000 rupees would have come between what? 3rd and 4th year. Then we would have taken 3 years plus something and calculated the payback period on proportionate basis. Okay. Payback period, what do you think? Should it be higher the better or should be lower the better? Because we always want lower the better, because we always want the time period in which we are recovering the investments, that time period should be higher or the time period should be lower better. Lower the time period, better it is for you. Okay. So this is your payback period. So there are two possibilities. Cash inflows are constant, cash inflows are not constant. Whenever the cash inflows are constant, simply use this formula. What is the formula? Initial investment, divide that by cash inflow per annum. And when they are not constant, what are we going to do? Cumulative cash inflows. On that basis, we are going to calculate it. Then, my dear students, we have something which is also called as a discounted payback period. What's the name, guys? What's the name? Discounted payback period. Now, what is discounted payback period? Discounted payback period is an extended version of payback period. The only difference is, are we going to take future value of cash inflows or we are going to take the present value of cash inflows? So we'll be taking the present value. Suppose year 1, 2, 3, your cash inflows, though it is constant, 1 lakh, 1 lakh, 1 lakh. But do you think its present value is going to be constant? I'm asking you something. Do you think the present value is going to be constant? No. Then I will discount it at particular percentage. I'll be getting the present value. So you guys can just check. Suppose your discounting factor is 10%. So this will be 0.9091. This will be 0.8264. This will be 0.7513. So then we'll be getting 90,910, 82,640, 75,130. Are these my present value of cash inflows? Come on, yes or no? Yes, sir. Then what do we need to do with the same? This is the present value of cash inflows. Now we have to take cumulative cash inflows. What do we need to do, guys? Cumulative cash inflows. So then if this is 90,910, we will add this, and then we will see what's the PV of CO. And we will check between which 2 years we are recovering it. So in your discounted payback period, always remember that, should we take cash inflows cumulative or should we take present value of cash inflows cumulative? Then the answer is present value of cash inflows cumulative, we have to take it. This should also be higher the better or lower the better? Lower the better, okay? 6th, we have something which is called as average rate of return or average return or accounting rate of return. Now this is calculated by taking whatever is your average net profits after tax, we divide that by initial investment and we multiply that by 100, or we can also take average investments. So for average NPAT, upon what we have to take beta average or initial investments and multiply that by 100, this will give you your what? ARR. Okay. Now this is the only method in which are we using cash inflows or we are using book profits, everyone? What are we using? Come on, everyone, please tell me, cash profits or book profits? Then the answer is book profits. So in ARR, my dear students, you always have to remember, in your ARR method, you always have to remember that we are going to take cash inflows or we are going to take book profits, beta. Book profits. So what is going to be the formula for the same? Average NPAT upon average or initial investment. So what is your average investment? It will be original investment plus scrap, divide that by 2. So that is the formula for your average investment. If the scrap is given to you, what do we have to take? We have to take your original investments, and with your original investments, what will you add, beta? Scrap, and divide that by 2. You'll be getting your average investments. ARR, what do you think? Should it be higher the better, or ARR should be lower the better? Higher or lower, everyone? Higher the better, because higher the ARR, better it is. It's a rate of return. It should always be higher the better. So once again, I'm repeating, for your average rate of return or your accounting rate of return, what is the formula which you are going to use? Everyone, please tell me. Average NPAT upon what? Average or initial investment. But we will always prefer what? Average investment. And what is average investment? Original investment plus scrap divided by 2. If the scrap is not there, then what we will do? We will simply take original and divide that by 2. That will give you the final answer. Then the last method is your modified internal rate of return. This I'll teach you when we'll be doing the question. Okay. Chalo. So these were the methods. I briefed you about what the methods were. Shall we start with the practical problems? Okay. Chalo. Now let's get started. Now please tell me, guys, in your first practical problem. See what is given to you. Following data has been available for a capital project. Annual cash inflow is how much? 1 lakh. Can I say this is cash inflow per annum solo year? What is the useful life given to you? 4 years. Salvage is 0. And your rate is nothing but what? IRR is 12%. And the rate is what? 12%. And what is given to you? Profitability index. Okay. You are required to calculate what should be the cost of the project, cost of capital, NPV, and payback period. Okay. Now, my dear students, how are we going to approach the question? This is now solution to which question? Question number 1. Okay. See. Do you have cash inflow per annum, everyone? Okay. Then, do you have life? Yes. Do you have IRR? Yes. Now, what is cost of the project? Can I say cost of the project is nothing but your PV of CO? I'm asking you, hello. Is the cost of the project nothing but PV of CO? Solu, yes or no? Yes, sir. Give me what's the formula for your IRR. At IRR, what happens? At IRR, can I say PV of CI is equal to PV of CO? Do you all agree with this? Okay. Now, annual cash inflow is given to you as 1 lakh. Do I have IRR rate? So if I have cash inflow per annum and if I have the internal rate of return, can I calculate my dash? Present value of cash inflows. So now to calculate the present value of cash inflows, can I say I will take cash inflow per annum and multiply that with what? PVAF. Instead of preparing the table, cash inflows are constant, I just now taught you. Can I use annuity factor? Come on, yes or no? Yes, sir. So we can take PVF at what is the rate which is given to you? 12% for how many number of years? 4 years. Will that give me my PV of CI? Solu, yes or no? Okay. Everyone please tell me what is your cash inflow per annum? How much is it? 1 lakh. Also at the same time, what is the PVAF? Can I say PVAF at the rate of 12% for the period of 4 years? You can see this here, 12% for the period of 4 years. Can we add up this part and we'll be getting the present value annuity factor? Come on, yes or no? Yes, sir. Give me this total. 3.038. Now, do I have my 3.038, which is the PVAF? Come on, yes or no? Yes, sir. Can you all please give me what's the PV of CI? What's the PV of CI? Come on. 3,03,800. Okay. Now this is PV of CI. But at IRR, what is equal to what? PV of CI is equal to what? PV of CO. So what's the PV of CI? 3,03,800. So don't you think this is also going to be your PV of CO? Superb. So can I say we have already got your cost of the project? Come on, yes or no? Yes, sir. We have the cost of the project, which is nothing but 3,03,800. Are you all clear with the first part? What is the second part of the question? We are required to calculate what? Cost of capital. Now, what is cost of capital? It is that discounting factor. Now, we have to calculate cost of capital. But how will we do that? So, guys, just check. Do you have profitability index available? Now, if the profitability index would have been 1, can I say PV of CI is equal to PV of CO? My cost of capital is also nothing but my IRR rate. But because my profitability index is 1.064, it means what? Can I say that cost of capital is different from IRR? Okay, so have you understood this? Because its PI is 1.064. I just now taught you that at IRR, PI should always be dash 1. But because it is not 1, it is 1.064. What is the meaning of this? Can I say that there is some other discounting factor which is there in the question? Come on, yes or no? Yes, sir. Which is not equal to IRR. So now, my dear students, how will we find out that? PI formula, everyone. What is the formula for PI, everyone? PV of CI, which we divide that with what? PV of CO. Will that give you your profitability index? Come on, yes or no? Yes, sir. What is your PI, everyone? PI is what? 1.064. Let the PV of CI be X. What is the PV of CO? 3,03,800. Can I say this will give me my PV of CI? This will give me my PV of CI. Solo, yaar. What's the PV of CI? 3,03,800 multiplied by 1.064. What is this? 3,23,243. Is this my PV of CI? They have asked you what is the cost of capital. Okay, so it's okay. Cash inflow per annum into PVAF at some particular percentage will give you PV of CI. Arey, you already know this. Above also we use the same formula when IRR was given to you. Now we have to find out the discounting factor. When we have the PV of CI, what's the PV of CI which we have? 3,23,243. Do you have the cash inflow per annum? Come on, yes or no? Yes, sir. What's the cash inflow per annum? 1 lakh. So can I find out my PVAF? Which is 3.2324. This is not my discounting factor. This is PVAF. This is the annuity factor. This is the total. Are just like what we did here, 1 lakh into this will give you this. But I had PV of CI. I have cash inflow. Can I find out this PVAF? And what is the PVAF which I've just now got? 3.2324. Guys, what do you think now? You have to calculate the cost of capital. So you need to check this annuity factor is coming under which discounting factor. So just check. Do you have your 10, 11, 10, 9 different discounting factors? Come on, yes or no? Yes, sir. Can you please calculate and tell me what is 9% total? You will realize this is 3.239. And what did we get? 3.23. So don't you think ultimately what's your cost of capital? 9%. Did you realize this? So if I have the cash inflow, if I multiply that by PVF, then I get PV of CI. But if I have my PV of CI, which I've got it from where? Profitability index. That if I divide it with dash, cash inflow per annum, can I say I can get my annuity factor? Come on, yes or no? Yes, sir. Everyone got it? And that annuity factor has a discounting, this particular factor which is given to you. So based on that, we got this as 9%. Okay. This was your question number 2. And NPV now we have to calculate. How will you calculate NPV, guys? Come on, yaar. PV of CI minus PV of CO. Guys, please tell me, do you have PV of CI? How much did you get PV of CI? 3,03,800. Sorry, 3,23,243. What's the PV of CO? 3,03,800. What's the NPV? Sorry. 445. Is this your NPV? Come on, yes or no? Yes, sir. Now please tell me, is the NPV negative or is the NPV positive? If the NPV is positive, what do you think? You should accept the project or reject the project? Accept the project. Then check next. What is the last part? Now, how will you calculate your payback period? So I explained this to you. Payback period, if the cash inflows are constant, can I simply use that formula, yaar? Because even if I give you 1 lakh rupees per year, and if I tell you that cash outflow is 5 lakhs, then what is the answer which comes to your mind? 5 years. So what are you doing? We are taking cash inflow, we are taking cash outflow and dividing that with what? Cash inflow per annum. So what is your payback period, beta? Cash outflow upon cash inflow per annum. What's my cash outflow? 3,08,000. Right? And what is the cash inflow per annum? 1 lakh. So what is this? 3.03 years. Come on, yes or no? Okay. So as you all can see, whatever is the PVF of IRR, just check this out here. Whatever is the PVF of IRR, can I say that is nothing but, whatever is the PVF of IRR, that is nothing but dash. Whatever is the PVF of IRR, what is that? Can I say PVF of IRR is nothing but your payback period, which you just now got, which is 3.03 years. Are you guys understanding? Okay, so whatever is going to be your IRR's PVAF, whenever the cash inflows are constant, can I say that will be called as my dash? Payback period, come on, yes or no? Yes, sir. That will be called as my payback period. So this was your first question. Yeah, have you all understood this? Solu yaar? Sure? Okay. Fine. Now we'll be starting with question number 2. Okay. Check. Now let us start with your second question. Question number 2. Let's read this question. Let us start with your question number 2. Now see what is given to you. Lockwood wants to replace its old machine with what? New automatic machine. And 2 models A and B are available at the same cost of rupees 5 lakhs. Salvage value of the old machine is what? 1 lakh, and the utilities of the existing machine can be used if the company purchases model A. Additional cost of utilities to be purchased in this case will be rupees 1 lakh. And if the company purchases B, then all the existing utilities will be replaced with the new utilities costing rupees 2 lakhs. First of all, my dear students, what is the basic meaning of this utilities? Okay, so understand this concept. Now, let's say for example, see this is the split AC, right? I want to replace this by split AC only. So can I say that there is no need for making any changes here? There is no need for making any changes. You don't have to make any changes here. You don't have to make any changes relating to the structure of the premises. It can easily be replaced here. Come on, yes or no? Yes. So we can use your old utilities. All the old setup can be used. But suppose if I want to remove this and put a box AC, okay, that square AC if I want to put, window AC, then can I say in that particular case, I have to cut the entire structure? So now my old utilities will be helpful, or should I replace it with new utilities? New utilities, right? So old utilities need to be scrapped away and new utilities should be taken into consideration. So are you understanding that it is always not necessary that whatever is going to be your existing utilities, that will only be continued in future? It is possible that sometimes we have to replace this old utilities with the new one also. Okay, so we have to check that what is going to be the total cost. So for that, now let's read the question. Just check. There are two machines, machine A, machine B. Solo yaar. Okay, now please give me what's the cost of the machine A. It is 5 lakhs. What is the PV of CO for the new machine also? Both of them are 5 lakhs here. Come on here. Okay, and after that you all can just check what's the salvage value of the old machine. 1 lakh. So if you replace old with machine A or if you replace old with machine B, don't you think 1 lakh is nothing but by the way of salvage? So then in that particular case, your investment will become how much amount? Can I say it is going to be 4 lakhs? Solo yaar. The utilities of the existing machine can be used if the company purchases model A. Okay. An additional cost of utilities to be purchased in this case will be rupees 1 lakh. So are we going to use the utilities of the existing machine? Come on, yes or no? Yes, sir. Okay. And what is the additional cost of the utilities in this particular case? 1 lakh. So we just have to spend 1 lakh rupees more, so 5 lakhs. But what have they mentioned further? If the company purchases B, then all the existing utilities will be replaced with new, costing what? Rupees 2 lakhs, and the salvage value of the old machine old utility will be what? 0.2. So please tell me what is the cost of the new utility? 2 lakhs, and from that 2 lakhs, can I say old utilities will be sold? Are we receiving some scrap? Come on. How much scrap are we receiving? 20,000. Can you please tell me it means that how much amount am I going to spend? 1,80,000. So can you please tell me 4 lakh plus 1,80,000, how much is this going to be? 5,80,000. And we have to spend this today itself. So you have to multiply this by 1. So this will be 5 lakhs and this will be 5,80,000. Are you guys okay with this? Okay. Now continuing further, what have they told you that cash inflows are given to you? Guys, if the cash inflows are given to you, what we have to do? Simply discount it at what? 15% rate. Will I be getting the PV of CI? Come on, yes or no? Yes, sir. Cash inflows are B are also given to you. We are going to discount that with the same. Now this is the salvage value. Don't you think it will be multiplied by the PV factor at the end of the 5th year? And that's how we'll be getting PV of CI. And from PV of CI, what do we have to subtract? PV of CO. Ultimately, what will we get, beta? We'll be getting the NPV. And we will select the project in which the NPV should be lower or higher? Higher. Okay. Come to question number 3. What is given to you? Let's read this. Liver is considering a new product line to supplement its range of products. It is anticipated that the new product line will involve cash involvements of how much amount? Rupees 7 lakh at time 0 and 10 lakh at the end of year 1. Okay. So please tell me, my dear students, when we are talking about your new machine, okay, then this new product line will involve how much amount, beta? If I'm talking about PV of CO at year 0, are we spending something? Come on, yaar, are we spending something at year 0? How much is that? 7 lakhs. But this 7 lakh will be spent when? Will it be spent today itself? Come on, yes or no? Yes, sir. So we need to multiply it with what? 1. So this will be 7 lakhs. Also at the same time, just check how much are we spending at the end of year 1? 10 lakhs. So can I say at year 1 we are spending 10 lakhs? But this 10 lakhs, should I multiply it by 1 or should I multiply by the PV factor? PV factor for first year to get the present value. Okay. So this is what my PV of CO will look like. Okay. We will check what's the discounting factor. Continuing further, after tax cash inflows of 2,50,000 are expected to be in year 2. Now have you started receiving PV of CI? Come on, yaar. So this project requires at year 0 some amount, at year 1 end some amount, and then from year 2 onwards, are we going to receive some cash inflows? Come on, yes or no? Yes, sir. So please tell me what is going to be your year 2? Year 2. Can I say we'll be receiving the cash inflows, which is nothing but something which you'll be receiving at year 2, year 3, then year 4, and then what have they told you? That year 2, how much is the cash inflows which are expected, beta? 2,50,000. Solo yaar. And then at the end of year 3, how much is it expected? 3 lakhs. And after that, what have they told you? That 3,50,000 is in year 4. And after which they have specified that, and 4 lakh each year thereafter through year 10. So can I say from year 5 to year 10, what is the cash inflow which we are receiving? 4 lakhs. Are you guys trying to understand this? Okay. So all this is nothing but my cash inflows, which I need to what? Discount it. So ultimately get what? Present value of cash inflows. Okay. Now what is the rate of return which they have given to you? The rate of return which they have given to you is nothing but how much percentage? 15%. So if I have my discounting factor at 15%, will I be getting the PV of CI? Come on, yes or no? Yes, sir. So I'll be getting PV of CI, and this PV of CI, my dear students, if I subtract it by PV of CO, ultimately what will I get, beta? NPV. Okay. Now please tell me, if the required rate of return is 15%, what is the PV factor at the end of year 1? How will you do it? 1 divided by 1.15. Everyone please tell me how much is that? Very good. It is coming as 0.8696. Okay. And that is something which I multiplied by 10 lakhs. So can I say this will be 8,69,565? With this, if I add 7 lakh rupees, can I say now my present value of cash inflow will be what? 15,69,565. Are you all convinced by this? Okay. And after that, do I have the cash inflows available? Hello? What to do with this cash inflows? I have to discount it at the end of year 2, at the end of year 3, at the end of year 4. Then from year 5 to year 10, ultimately, can I say I'll be getting the present value? Come on, yes or no? Yes, sir. Clear? Okay. Then this is PV of CI. Then what will be the NPV? From PV of CI, I'll subtract PV of CO, I will be getting the NPV. There is no salvage, there is no recovery of working capital. Okay. Second part is, analyze what would be the case if the required rate of return is 10%. So can I say everything now will be discounted at what percentage? 10% rate. Okay. So same process will be repeated, but the only thing is, instead of 15% here, what should I take the rate? 10%. Here instead of 15%, what should I take? 10%. Then I'll be getting my PV of C and I'll be getting my PV of CO. Okay. So please tell me now, at 15%, what is your NPV? And at 10%, what is your NPV? Okay. So you guys can just check at 15% now. What is the NPV which we are getting? Let us just check. At 15%, this is which question? Question number 4, na? 3. Okay. What is the NPV at 15%? It is coming negative. Can you just check? 1,18,200. Is this negative? Solu yaar, yes or no? 1,18,200. At 10%, what is the NPV which is coming? 2,51,450. Now, my dear students, if they ask you what is going to be your IRR, if they ask you what is going to be your IRR, then can I put it like this? IRR is about 10, but less than 15. Is the IRR going to be more than 10%? Come on, yes or no? Yes, sir. But it is going to be less than 15. More than 10, but less than 15. Are you guys trying to understand this? So is it going to be more than 10? Come on, yes or no? Yes. But it's going to be less than 15. So how are we going to do the calculation? So can I say, what is the difference between 10 and 15? The difference is 5. And in this 5%, can I say that from 2,51,040, I have reached negative 1,18,200. So in that particular case, how much discounting I have done? 251,450 plus 118,200. 369,650. Can I say I have discounted 369,650? Come on, yaar, yes or no? Yes, sir. But my dear students, I don't have to go from 251,450 to negative 1,18,200. I have to go up to the extent of what? 0. Because I want the IRR to be what? I want to calculate IRR. So at IRR, my NPV should be what, beta? NPV should be 0. So I have to bring from 2,51,450 to what? 0. But at 10%, it's again going down. So that's why we have discounted in a total of 369,650. But I don't have to discount 369,650. How much should I discount, beta? From 251,450, I just have to reach 0. So in that particular case, at 251,450, this should be how much? You cross multiply. You cross multiply, you will come to know what is going to be the answer. What is the answer, guys? 3.401. So can I say this is nothing but 3.401? So this is nothing but 13.401%. Is this my IRR? Come on, yes or no? Yes, sir. So did you guys understand how do we solve this? Okay. So this is nothing but 13.40. Superb. Everyone's okay with this? Okay. Then after this, what's your next part? What's the last part of the question? We are required to calculate what? Payback period. Now to calculate the payback period, what do we have to do? Can I say we have to take series of cash inflows? Okay. But here remember that the first series of cash inflows is coming at the end of which year? Second year. So second, third, fourth, fifth, sixth, seventh, eighth, ninth, 10th. Do I have the series of cash inflows? Come on, yes or no? Yes, sir. What are the series of cash inflows, everyone? Can I say this is at the end of the second year? How much are we receiving? 2,50,000. Solo 3 lakhs. Then 350. Then 4 lakhs. Then 4 lakhs. Then 4 lakhs. Everywhere it's 4 lakhs. Okay. Now you have to calculate what? Cumulative cash inflows. So this 250 is going to be 250 only. But this will be what? 550. This 550, I have to add it with what? 350. So this will be what? 9 lakh. Then this will be what? 9 plus 4, 13 lakhs. Then it will be 13 plus 4 what? 17 lakhs. 17 plus 4 what? 21 lakhs. By the way, please tell me what's the cash outflow which we are incurring? 17? What's the cash outflow which we are incurring? In future value terms only. It is 17 lakhs. Come on, yes or no? So then what's the payback period? 6 years. Can you guys just check? My payback period is nothing but it's coming as 6 years. Purinjada. Have you understood this? Okay, how should we solve this particular part? Okay. Now, let us do the next question. Okay. Okay. Okay, fine, chalo. Now, after this, I want you to please come to the next question, which is your question number 4. Okay. Now, question number 4, what is given to you? Let's read this. Elite Cooker Company is evaluating 3 investment situations. Number 1 is produce a new line of aluminum skillets. Do you know what is an aluminum skillet? Means aluminum pan. Okay. So the first part is what? That we can make aluminum pans. That's the first part. Second, expand its existing cooker line to include several new sizes. Okay. That there can be several new sizes on the basis of which we have to just check okay, by what is going to be your second part. Okay. And then third is what? Develop a new high quality line of cookers. So guys, how many situations are there? 3 situations. First is what? We can produce new aluminum pans. That's the first part. Second is what? That we can expand the cooker line into different sizes. This is the second type of a project. And third is what? We can develop a high quality line of cookers. Okay. If only the project in the question is undertaken, the expected present value and the amounts of the investments required are, we have the investments required which is 2 lakh, 1 lakh 15 and 2 lakh 70, and then we also have the present value of cash inflows. We are very lucky. Can I say in this question we already have PV of CI and PV of CO? Come on, yes or no? Yes, sir. Can I say immediately we can calculate the NPV? Can we calculate the NPV? Okay, give me NPV, guys. What's the first NPV? 90. What's the second NPV? 70. And what's the third NPV? 1 lakh 30. If projects 1 and 2 are jointly undertaken, there will be no economies, and the investments required and the present value will simply be sum of the parts. Okay. Now in your question number 4, if you are taking project 1 and 2 together, so what is the cash outflow? Let's check that. What's the cash inflow? Let's check that. And what is going to be the NPV? So what is going to be the cash outflows? They have simply told you that it is nothing but what? Can I say sum of the parts? Means what? Can I put it like this, that we have to take into consideration what is going to be your PV of CO. Just check this out. If projects 1 and 2 are jointly taken, so what is this beta? 2 lakh plus 1 lakh 15. Can you please give me what is the answer for PV of CO? 3 lakh 15. So can I say 1 and 2 is jointly taken? It is 3 lakh 15. And what is your CI, guys? So for CI, I have to take the total of this two. 2 lakh 90 and 1 lakh 85. Can you give me 2 lakh 90 and 1 lakh 85? 4 lakh 75. So what is going to be my NPV? My NPV will be 4 lakh 75 minus 3 lakh 15. What is that? 1 lakh 60. Can I say if projects 1 and 2 are jointly undertaken, 1 lakh 60,000, this is going to be the NPV. Come on, yes or no? Yes, sir. Continuing further, if I take projects 1 and 3, if I take what? Projects 1 and 3, then economies are possible because one of the machines acquired can be used for both the production process. Wow. So what is happening is, if I'm taking project 1 and 3 now, then project 1 also requires some machine, project 3 also requires some machine. But if I take both the projects together now, then one machine is common. So if one machine is common, can I say my cash outflow will be cumulatively higher or lower? Lower, because one machine is common. So in that particular case, just check, if I take 1 and 3 together, what is the investment which you ideally should require? 2 lakh plus 2 lakh 70, that should be what? 4 lakh 70. But if you continue further, if you take 1 and 3 together, can I say that the total PV of CO is nothing but what? 4 lakh 40,000. So my simple question to you is, if I take 1 and 3 together, can I say my cash outflow should I write down as 4 lakh 70 or 4 lakh 40? 4 lakh 40,000. Also at the same time, what is going to be now my PV of CI? So PV of CI, it's going to be the same, which is 290 and 4 lakhs. What is 290 and 4 lakhs? 690. What is going to be the NPV? 2 lakh 50,000. Then if you continue further, you will come to know that if, my dear students, we are taking projects 2 and 3, which are undertaken, then the economies are to be achieved in marketing and producing the products, but not in investment. The expected present value of the future cash flows for 2 and 3 is what? 6 lakh 20. Are you understanding? Now in cash outflow, we are not saving. But can I say in cash inflow, are we saving? Come on, yes or no? Yes, sir. So if I am taking project 2 and 3, then please tell me what is the total of project 2 and 3 together? 5 lakh 85. But am I going to take 5 lakh 85 or will I now take 6 lakh 20? Because there is some marketing cost which will be saved. So because of that, now I will take into consideration 6 lakh 20,000. But will there be any economies in your cash outflows? No. So this total will be what? 1 lakh 15 plus 2 lakh 70. That's going to be 3 lakh 85. Now can you give me the NPV, guys? 6 lakh 20 minus 3 lakh 85. 2 lakh 35,000. Are you guys trying to understand this? So this is 2 lakh 35,000. Then, my dear students, if all the 3 projects are undertaken simultaneously, so if you are taking 1, 2 and 3, if you are taking all the 3 projects undertaken simultaneously, then can you please tell me what is happening? They have told you that all the economies will still hold good. It means what? Are we still going to get this benefits? Come on, yes or no? Yes, we are still going to get the benefits. And they have told you, but there is going to be 1,25,000 for extension of the plant that will be necessary. So if I am taking 1, 2 and 3 together, then please tell me in cash outflow, was there any economies between project 2 and project 1 and 3? Come on, yes or no? Okay, so where was the economies? The economies was there between project 1 and 3. What was the cash outflow? 4 lakh 40. But then this is project 1 and 3. But what about project 2? Project 2, how much are we investing? Project 2, we are investing 1 lakh 15. Okay. But there is also extension of the plant, which is 1 lakh 25,000. So then this is nothing but extension of the plant. So can you now please tell me what is going to be the final answer, beta? Can I say this is going to be 1,25,000? So the total is going to be what? 6,80,000. So is this going to be my CEO? Come on, yes or no? Yes, sir. Cash outflows is going to be 6,80,000. So 4,40,000 is nothing but project 1 and 3. Then if I'm taking project 2, so it's going to be 1,15,000. And then my dear students, there is extension of the plant, so that is going to be 1,25,000. So everything put together will now give you what? 6,80,000. Is this going to be your cash outflows? Come on, yes or no? Yes, sir. Now what about your cash inflows? How will you take into consideration your cash inflows? So for your cash inflows now, what are you going to take into consideration, my dear students? Can I say for your cash inflows, now economies are still holding good. So economies are between what? Project 2 and 3. So then this cash inflow will be what? 6,20,000. But again, because I am taking 1, 2, 3 all together, will the cash inflows for project 1 also come? Come on, yes or no? Yes, sir. What is project 1 cash inflow? 4 lakh? No. Project 1 cash inflow is 2,90,000. So I will take 2,90,000. Now can you please tell me what is this, beta? 9,10,000. So this is my CI, 9,10,000. Now can you give me the NPV? 9,10,000 minus 6,80,000. 2,30,000. Now please tell me, if I go with only single project 1, what's my NPV? 90. If I only go with your single project 2, what's my NPV? If I only go with my single project 3, what's my NPV? 1,30,000. But if I go with 1 and 2, what's my NPV? 160. With 1 and 3, what's my NPV? 250. Here, what's the NPV? 235. And this is 230. Which project will I select? 1 and 3, because NPV is maximum. Did you guys understand this? So if I'm taking 1, 2, 3 together now, then we should check that what is going to be the economies of scale between 1 and 3, because this is going to be operational. But then only thing is what? That we have to take into consideration what? We have to take into consideration project 2 separately. So that will also come. And then extension of the plant of 1,25,000, that will also come. So this will eventually bought. Okay. So this is nothing but 6,80,000. And this is 9,10,000. So eventually you will be getting your final answer. Okay. Okay. Which will be nothing but your 2,50,000. Are you all okay with this much? Sure? Confident? Okay. Now, my dear students, this was your question number 4. Now, let us do your question number 5. Shall we start? Okay. Okay. Cello Limited is considering buying a new machine which has a useful life of 5 years and a cost of what? 1,25,000 and a scrap value of what? 30,000, with 80% of the cost being payable at the start of the project and 20% is payable at the end of the project. This is very similar to what we just did right now. Previous to previous question, where the cash outflows will be for how many number of years? 1 year or 2 years? 2 years. So in this particular case, we have your question number 5, PV of CO. We have year 1, year 2. What's your CO, guys? Just check. What's the cost, beta? 1,25,000. But the cost is 1,25,000. How much are we paying at year 0? Year 0 and year 1. How much are we paying? 1,25,000 multiplied by how much percent? 80%. So how much are we paying at year 0? 1 lakh. How much are we paying at the end of year 1? 25,000, right? Because that is 1,25,000 into 20%. So that is 25. This will be multiplied by 1. But will this be multiplied by the PV factor? Come on, yes or no? Yes, sir. Okay. Continuing further. The machine would produce how many number of units? 50,000. For a new product with an estimated selling price of what? 3. Direct cost would be what? 1.75. And annual fixed cost including depreciation is calculated on what? Straight line basis. So guys, now you all know that if you want to prepare your PV of CI, then can I say there is sales? From sales, what are you going to subtract? Variable cost. So here, sales less variable cost, and then they have told you that there is some annual fixed cost also, including the depreciation. This is including the depreciation, okay? And that would be nothing but 40,000. So then we are going to subtract fixed cost, including your depreciation, okay? After this, they have told you in the first and the second year, special sales promotion expenditure, not included in the above cost, would be how much? 10,000 and 15,000. So is there any special expenses also? Come on, yes or no? Yes, sir. We are required to calculate the NPV, assuming that the cost of capital is 10%. Guys, can I say that what's the life of the project? What is the life of the project? 5 years, okay. So it's going to be 1, 2, 3, 4, 5. But please tell me, special expenses, where is it going to come, beta? Can I say it will only come in your year 1 and year 2? Okay, so this will only come here. Okay, now this total sales less variable cost, fixed cost less special expenses, what is this called as? Can I say this will be called as NPBT, net profit before tax? So you must be wondering, sir, you taught us net profit before depreciation and tax, but this will be net profit before tax. Why? Because don't you think that this fixed cost is what? Including depreciation. So this has to be what? Net profit before tax. From this, what do I subtract, guys? Tax. What will I get? Net profits after tax. What do I add? Depreciation. What do I get? Cash inflows. Have you all understood this? Okay. Now just check. Question number 5, na? This is question number 5, right? So can you just check? 1,25,000. Okay. Now they have directly calculated contribution, which is 60 to 500. Okay. And based on this, we have got fixed cost. Okay. Which turns out to be what? 21,000. First of all, please tell me in this question, is there any tax rate which is given to you? There is no tax rate which is given to you. So if there is no tax rate which is given to you, can I put it like this, that the net profit before depreciation and tax, that itself is your cash inflows. So in this question, there is no tax. So though I have subtracted my fixed cost, there is no tax which is given to you. I add back the amount of depreciation. Can I say I'll be getting the cash inflows itself? Right? Because depreciation and the impact of tax savings will not come. So it's okay. Even if this fixed cost is including depreciation, let us subtract that. But then when it comes to adding the depreciation, can I say we will be getting the same cash inflows which is coming here? Come on, yes or no? Yes, sir. This will be the same cash inflows which will come. Okay, so they have not subtracted the depreciation only so that they don't have to add it back. That's what they have done in the question. But if we follow our format and if the tax rate is not given to you, we'll put tax rate as nil. Okay, so NPBT minus tax, there is no tax, so that itself is your NPAT. And we add the amount of the depreciation. Ultimately, what are we going to get, beta? Can I say we'll be getting the cash inflows? Come on, yes or no? Yes, sir. Are you guys understanding this? Okay. And then will there be any scrap value? Come on, yes or no? Yes. In this question, is there any scrap? Have they told you, is there any scrap? That is 30,000. When are we going to receive this? At the end of the project. How will you calculate your depreciation, guys? How will you calculate your depreciation? Just check. What is the cost of the machine? 125. What is the scrap? 30,000. So take 125 minus 30. What's the life? 5 years. So 125 minus 30 divided by 5. How much is it? 19,000. So that is nothing but the amount of depreciation. So you know what they have done? From 40,000 they have subtracted 19,000. So 40 minus 19 will give you what? 21. So they have started only the question with your, just check, 21,000. But it's okay. You can do 40,000 and then add back the amount of 19,000. Don't you think your answer is going to be the same only? Okay. So you take directly subtract 21 or you subtract 40 and add 19. Don't you think it's going to be the same part only, because there's no tax rate which is given to you. Okay. Yeah, understood this now? Sure. Okay. So this is your question number 5, in which is there any tax or there is no tax? There is no tax. Okay. Question number 6. Let's start. What is given to you in your question number 6? Are you guys ready? Okay. You guys are there with me? Are you all tired? Tired? You want to sleep for some time? You want coffee? Or something else? No, last bench. Everything all right? Sure. Okay, let's do this. Next question. Come on. Question number 6. See what is given to you in this particular question. ABC is planning to invest in machinery, for which it has to make a choice between two identical machines in capacity X and capacity Y. Despite being designed differently, both machines have the same job, have to do the same job. Further details for both the machines are given to you. Machine X, machine Y, we have purchase cost, we have live, we have running cost. Then they have told you that the opportunity cost is 9%. You are required to check that which machine should you buy, and the PV factors are given to you. Guys, please just check and tell me, in this question, anywhere can you find cash inflow from the projects? Can you find out cash inflow from the projects? We have purchase cost, we have running cost, we have life. Anywhere can you find out cash inflow from the project? If the cash inflow from the project is not given to you, then I cannot use NPV decisions. Because for NPV, I need PV of CI minus PV of CO. But here in this particular question, there is no cash inflow from the projects which is given to you. So in this particular case, what do you think I should do? Then in that particular case, we have to take into consideration your, because cash inflow from the projects is not given to you, then we should take into consideration a method which is called as net cash outflow method. What is the name of the method, guys? Net cash outflow method. It is called as NCO method. Now what is NCO method? NCO method first of all should be used under what situation? When what is not given to you in the question? When dash is not available. What is not given to you? Cash inflow from the projects is not available. So guys, when cash inflow from projects is not available, we use NCO method. Okay, I'll give you an example. See, listen, pay attention. Suppose you want to buy a car. Okay, now you want to buy a car and there are two options in front of you. Either you can buy, car A or car B. Car A will cost 10 lakhs, car B will cost 12 lakhs. Now, what are the different parameters you will see? You will see that what is going to be the mileage of the car. Arey yaar, hello, mileage, running cost, na? What is going to be the running cost of the car? You will check the mileage of the cost of the car. Then you will check what is the maintenance of the car. Then you will check what is the salvage of the car. You will check what is the life of the car, right? But will there be any cash inflow from projects? Will there be any cash in from your own car which you are buying? Will there be any cash inflow from project? Like whoever is sitting in your car, are you going to take money from that? Then the answer is absolutely no. So there is not going to be any cash inflow from project. So in such situation, can I put it like this? We should select the car on the basis of which method? NCO method. We should select the car on the basis of which method? NCO, net cash outflow method. And we should select the car in which your NCO should be higher the better or NCO should be lower the better. Answer should be lower the better. NCO lower, that's the best part. We should select that particular car. Purinjida. Okay. So whenever the cash inflow from the car is not available, which method? NCO. When the cash inflow from the project is not available, which method? NCO. And NCO should always be higher the better or NCO should always be lower the better? Because it's a cash outflow. It should always be lower the better. So you know what's the formula for NCO? NCO is A plus B minus C. So you must be wondering what is this formula? A plus B minus C. Where A stands for PV of initial investment. What is it called? PV of initial investment. You know what is B called as? PV of operating cost. And what is C called as? PV of salvage. Okay. So PV of initial investment, PV of operating cost, PV of salvage. We'll be calculating what is your NCO. And we will select the project in which the NCO should be maximum or it should be minimum. Now, in this particular question, now just read. Are you having, how many machines do you have? Come on, fast. Solo yaar. 2. What is A? PV of initial investment. Can you please give me what's your initial investment for machine X? 15 lakhs. What is the initial investment for machine Y? 10 lakhs. Now, can I say we are going to make the investment today? That's why it's always multiplied by 1 yaar. So this is going to be 15 lakh and 10 lakh. Do you all agree with this? Right? What is going to be your B part? Can I say it's going to be PV of running cost? Come on. Is it going to be PV of running cost? Operating cost? Now, is there any tax rate given to you in the question? No, there's no tax rate. But what is the running cost every year? Can I say it's 4 lakhs? Guys, if I want to calculate its present value, how will I calculate the present value? Into annuity factor, because every year it's going to be 4 lakh, 4 lakh, 4 lakh. So don't you think I will multiply that with what? Annuity factor. So I'll multiply that by annuity factor. So do I have the 3 factors? Come on, yes or no? So what will I do? I will take the total of this 0.917 plus 0.842 plus 0.772. Can you give me this? 2.531. And then if I take 4 lakh and multiply that by 2.531, what will I get, beta? 10 lakh 12,400. Everyone, is this the PV of running cost? Solu, yes or no? I've got PV of running cost. And what is the C part? PV of salvage. Do you have PV of salvage? Do you have PV of salvage? No. So guys, what is going to be my NCO? Can I say this is A plus B minus C? So now to this, if I add 15 lakhs, what's the answer, guys? 25 lakh 12,400. But what about Y? For Y, what is the life? 2 years. What's the running cost? 6 lakhs. So I will take 6 lakhs and I will multiply that with what? Can I say this 2? 0.917 plus 0.842. Can you give me this? 1.759. Multiply this. What will be this? This is nothing but 10 lakh 55,400. Is there any PV of salvage? No. You add both these things. What is this going to be? 20 lakh 55,400. But can I directly compare both these things? Then the answer is no. Because one is having a life of 3 years. One is having a life of 2 years. So we have to calculate NCO per annum. So don't divide by 3. Don't divide by 2. Because if I want to calculate NCO or NPV or on per annum basis, I always divide that by the PVAF factor. I should divide it with what, beta? PVAF. Are you aware about this? We have to divide that by present value annuity factor. We just can't divide by 3 and 2. We have to divide that by present value annuity factor. You want to know the reason of this? Yeah, I'll tell you. How does NPV comes? PV of CI minus PV of CO. How does NCO comes? PV of initial investment plus PV of running cost, right? So whenever we are calculating present values, don't you think that the cash flows are multiplied that by annuity factor? Or cash flows are multiplied by discounting factor. So this is a product. And whenever you calculate the average of a product, we don't divide that by simply number of years. We divide that by sum of weights. You have learned this in math. Sum of weights. Whenever we are calculating weighted average, how do you calculate weighted average? It is sum of product divided by sum of weights. Similarly, whenever we are calculating the average on NCO per annum, can I say this is itself is a product which is a present value? So when you want to calculate this on per annum basis, I just can't divide this by 3 because this is come after a product. So that's why we have to divide that by what? Sum of weights. And what is sum of weights? Your annuity factor, which is 2.531. 9,87,928. And this is 20,55,400, which I will divide it with what? 1.759. How much is this coming? 11,60,000. 68. 11,68,504. Now can you please tell me where the per annum is lower? Where the per annum is lower, A or B? This is 9 lakh, this is 11 lakh. Where is it lower? A. So no doubt here this was coming higher, but per annum is coming lower. So which machine should you select? Machine A. First machine should be selected. 9 lakh 92, 11 lakh 68. Machine X should be selected. Have you all understood this? So this is NCO on per annum basis. Everyone understood? Sure, you are understanding this, na guys? Are you getting the hold of this? Sure, confident? Okay. Question number 7. See, we will do up to question number 9 also. We can do 9. Okay, we'll do up to question number 9, okay? Okay? Looking at your faces, I think 9 is okay. Because I just said now, we should do at your, someone just said, let us do up to next question. So I think he just said question number 7 or 6, I don't know what. Are you all tired? You all want to relax for 5 minutes? No, sir. We just want to complete and go home. Okay? You are there, na? I'm really worried about you. I think now he has so much of FM in his mind. Are you okay? Sure. Okay. And he is exactly sitting behind the camera, so that I cannot see his face only, whether he is paying attention or not. If I want to see him, then I have to look like this. But he was also chatting in between. I don't know with whom. No? Not now. Okay. Fine. Shall we start? Okay. Come on, let's do this, yaar. I want you all to get 50 on 15 FM. Arre? Seriously, I told you yesterday also, right? Minimum you should get 50 in FM. At least you should get 50. I don't know other things. 50 is the starting point. Only in FM, huh? Shall we? Let's do this. Question number 7. Ali Private Limited is planning to invest in a machinery that would cost 1 lakh at the beginning of year 1. Hey guys, what is beginning of year 1? Is it at the end of year 1 or is beginning of year 1? Beginning of year 1 means what? Can I say year 0 itself, yaar? So can I say at year 0 how much is it going to cost? 1 lakh. This is solution to which question? 7. At year 0, what are you investing? Come on, fast. 1 lakh. Right? Continuing further. Net cash flows from the operations have been estimated at 36,000 per annum for 3 years. Okay, so can I say at year 1, year 2, year 3, what is the cash inflows which I am getting? 36,000. Solo yaar. 36, 36, 36. Then what have they specified? The company has 2 options for smooth functioning of the machinery. One is service and another is replacement of its part. If the company opts to service a part of the machine at the end of year 1 at rupees 20,000, in such a case, the scrap value at the end of third year will be 25,000. So there are 2 options. You know what are the 2 options? Option number 1 is that you service the part. Now, if you service the part, is the servicing going to be free of cost? Or there will be some cost for the same cost? What is the servicing cost? Everyone, come on, fast. What's the servicing cost? What's the servicing cost? And at the end of year 1, it's given to you now. What's the servicing cost? 20,000. 20,000. Money va, money po. Money will come or money will go? Come on. If there is some servicing cost, please tell me money va, money po. I am trying to teach you in little bit of your language so that you understand. Okay? Huh? Huh? So whenever you service something, yaar, whenever you service the part of the machine, Va po. Po. So what is that po amount? Can you please tell me what is the amount? 20,000. So this is going to be 20,000. So can you please tell me from cash inflows 36,000, if I spend 20,000, what is the amount beta? 16,000. Okay. And at the end of the third year, they have also told you that there is going to be some scrap. What is the scrap value which will be receiving? 25,000. So can I say this is my series of cash inflows? Yeah. So now this 16,036 and the total of this 36 plus 25, how much is this? 61. Can I say all these things will be discounted at some particular percentage? Will be getting the PV of CI solo, yes or no? And from this PV of CI, what will you subtract? PV of CO. So what will you get? NPV. Okay. However, if the company decides not to service the part, then it will be replaced at the end of year 2 at what price? 30,800. And in this case, the machinery will be working for 4th year also and get the additional cash inflow of 36,000. Now, if you don't service the part, then what is the consequence? We have to replace that part. See, many times in real life also you must have faced this situation. Suppose in your home, your refrigerator, for example, is not working, or AC is not working, or washing machine is not working. So there is one part. Okay, so your mechanic will come and will tell you, either you service this part, or else if you don't service this part, let it work, but at the end of 2 years, then you have to replace this part. Are you understanding this? But if you replace this part, don't you think life of the machine will enhance? Or if you replace the part, don't you think life of the machine will enhance? So in this particular case, in option 2, year 1, year 2, year 3, year 4. And what is the cash inflow series? 36, 36, 36, 36. And at the end of the 4th year, what is the scrap? 18,000. Can I say this is the scrap? Solo yaar. Now please tell me, at the end of 4th year, how much amount are we receiving? 36 plus 18, how much is that? 54. But please tell me everyone, are we replacing the part of the machine at the end of dash year? 2nd year. And when we are replacing the machine, part of the machine at the end of the 2nd year, money po. Vapo. Can I say the money is going to go? Come on, yes or no? Yes, sir. What is this cost? Can you please tell me what's the cost? 30,800. Can I say now this 36,000, if I subtract that by 30,800, will I be getting this 5,200 yaar? Okay, and then all this will be discounted and will be getting the present value. This will be your PV of CI. And from this PV of CI, what will you subtract? PV of CO. Will you get your NPV? Come on, yes or no? Yes, sir. Purinjita. But please tell me, first option, machine life is dash. Second option, machine life is dash. Is the life same or the life is different? And when the life is different, can I say we have to calculate NPV on per annum basis? Come on, yes or no? Yes, sir. Continue further. What is given to you? Institute has not considered NPV per annum. Okay, they have just considered normal only, because first option it will be negative, second it will be positive. So that is why we will always select positive. There is no need to calculate NPV per annum. Okay, so ICAI has not done that. Okay, now if the supplier gives a discount of 10,000 for the purchase, what will be your decision? Now if the supplier gives a discount, then what will be your decision? Now please tell me what was the original PV of CO. It's there on your screen. What is the original PV of CO? Come on, yaar. 1 lakh. But if the supplier is going to give you a discount of 10,000, from your pocket, how much money will go? 90,000 will go. So now there is no need to again do all the calculations. But don't you think that when there is a discount of 10,000, your money which will be going out, that is under both the options, can I say it will be reduced by 10,000, 10,000? So when the money PV of CO is going to be reduced by 10,000, don't you think that the NPV will increase by 10,000? So we will simply increase the NPV under both the situations by 10,000. Okay, and then we will see what decision you need to make. Okay, now let us come to question number 8. Are you all ready? He is telling no, not ready. You to anyway came late also today. Shri is sitting since 10:30 in the morning. Yeah, he's sitting since 10:30 in the morning. But he's just sitting only. So there's a difference. And Shri at 11:30 slept for 2 minutes also. But I let him sleep. It's okay. And Shri, after lunch also, attention po. Sleep wa. Shri, are you okay? Fine. Chalo. Let's do this. Come on, yaar. Okay. Question number 8. See what is given to you. Naujeevan Hospital is considering to purchase a machine for medical projectional radiography which is priced at rupees 2 lakhs. All these wordings are not required. Okay. You just have to take into consideration only one cash outflow. What's the cash outflow, my dear students? 2 lakhs. Okay. So this is nothing but, come on, tell me, what is this? PV of CO. The project life of the machine is how many number of years? 8 years. What's the salvage? 18,000. At the end of which year? 8th year. The annual operating machine cost is what? 22,500. And what is the revenue which is generated? 1,20,000. For how many number of years? 8 years. Presently, the hospital has been outsourcing the radiography work to the neighbor test center and is earning a commission of what? 36,000 net of taxes. We are required to calculate whether the hospital should purchase the machine or not. Give NPV and profitability index. Do you understand this question? What happened? Suppose you are a doctor. Okay. And you are having your own hospital. If any patient comes to you and you always tell them, you know, Arey, you have to do this test. And you tell them, do this test. You write that and you will tell them, okay, do this test. They will obviously ask you from where to do test. So you will tell, go there only. Okay, do the test there only. So you will be like such a kind doctor. You know, he is telling us also from where to do the test. But he has a tie-up with that center. I hope you are understanding. So when someone will go there for the test, can I say doctor will get dash? Commission. Now doctor decides, why should I take this into consideration? Let me have my own machine where I can do the test. Now if you want to have your own machine where you can do the test, the first thing which comes to your mind is your commission income will be stopped. This is called as opportunity cost. Very good. Don't you think that the commission income will be stopped? Come on, yaar. An opportunity cost, money, money po. Matlab basically this is your one type of your income or expense. Expense. Because it's your cost, na? So you have to subtract it. But then don't you think that if you have your own machine, now you will charge your patients directly. So now will you generate some revenue? Come on, yes or no? Yes, sir. So now we have to decide whether we should purchase the own machine or not. So what is going to be now the format of the income of the statement? Can you please tell me in this particular question, what are we going to do? Now we will be preparing what? Income statement. Income statement, guys, how do you start? Sales. Sales, can I say we can write down this as revenue? Come on, yaar. How much revenue are they generating? Arey, what? 36,000. You expect to generate a revenue of 1,20,000. Come on, yaar. 1,20,000, na? 1,20,000. Solu, yaar. 1,20,000. What is the operating cost of the machine? 22,500. Come on. Operating cost is what? 22,500. So from revenue, I have to subtract what? Operating cost. Okay. Then, is there any other cost apart from this? Which is there? No. So can I say this will be called as your NPBDT? Don't forget, there is tax in this question. Hey, don't forget, there is dash in the question. Tax. And if there is tax, are we going to subtract depreciation? Yes or no, sir? We have to subtract depreciation. So once we subtract depreciation, what do you get? Net profit before tax. From that, what do you subtract? Tax. What do you get? Net profits after tax. What do you do? Add depreciation. What will be getting? Cash inflows. And then, my dear students, are we losing commission income? And this commission income, they have told you that is 36,000. That is net of taxes. Net of taxes means what? After tax. So don't you think this 36,000, I have to subtract it here. If it would have been mentioned it is before tax, then this 36,000 will be subtracted from NPBT. But because it is after tax, I can directly subtract it from your cash inflow. Solu yaar. Okay, can you please give me now what is your NPBT? 97 500. Depreciation SLM WDV. SLM, what's the original cost of the machine? 2 lakhs. What's your salvage? How much is that? 18. So 2 lakh minus 18. What's the life? Give me depreciation. 20. 750. Can I say I'll be getting NPBT? I don't want NPBT. Tax, NPAT, 22,750. Will I get cash inflow? From that, if I subtract commission income, will I get my final net cash inflow per annum? Come on, yes or no? And will this be constant for 8 years? And so if it is constant for 8 years, with what I should multiply it? PVAF. I should multiply this by PVF. Then can I say I'll be getting my PV of CI? Right? And this is PV of CI only from project. Don't forget there is also going to be PV of CI from salvage. Arey, hello, there is going to be salvage also. Come on, yes or no? Yes, sir. There is going to be salvage also. So there is going to be PV of CI from salvage. So whatever is your salvage, what's your salvage amount, guys? How much is your salvage? 18. Yes, 18. And that will be multiplied by the PV factor. And that's how you have to solve it. Can you just check this out? Exactly what we have discussed. Commission is 36,000. Subtracted now already here, yaar. How many times you want to subtract? See, less commission income. After your cash inflows, you are subtracting that commission income. Come on. Then this is add salvage and then we'll be getting the final NPV. And then profitability index is what? PV of CI upon PV of CO. Ultimately, this will be 1.084. Okay. Everything is fine. Okay. Are you in the condition to solve one more question? Yes. It's okay. We can do this tomorrow. No problem. So tomorrow for the first 10:30 to 12:30 around, we'll be completing your investment decisions. And then we'll be starting with your working capital questions. All estimation, receivable, cash management, everything we'll do it together. Perfect. So tomorrow, be ready to sit till 6:15. Okay. I'll not trouble you more, but around 6:15. And we'll start tomorrow at 10:30. I hope you all are coming tomorrow. College. Sir, you will also come tomorrow. You are also late today. You will come tomorrow, 10:30 sharp. Get your friend also tomorrow. He went. Okay, but wah. Tell him wah. Okay. So tomorrow it's important. Okay. That's it. Should we wind up? Bye guys. Take care. See you. Bye. See you tomorrow. Ready? Sure. Shall we start? Okay, very good, amazing, superb. So now, my dear students, we are doing your investment decisions. All my online students, are you guys there? Please give me the answer in the chat box. Come on. Fast. Good morning, everyone. Are you guys practicing revision with me? Yes, Gautam, very good. Where is Alia Ram, Avantika, Suji, Netaji, very good. Good morning. Good morning. Okay. Yesterday we were doing investment decisions and we completed some practical problems. How many practical problems did we complete? 8. Today we're going to start with the 9th question. It's going to be amazing. Okay. So let's do this together. How many methods are there in your investment decision? Come on, fast, everyone. 7 methods. The first one, NPV. NPV formula. Solo, what is the formula? PV of CI minus PV of CO. Give me how many types of cash outflows are there? Cash outflows. Hey, cash outflows were of two types. Whenever we invest in your fixed assets and whenever we invest in your working capital. Two types of investment which we do at the beginning of the year. We always multiply that by 1 until unless specifically mentioned that there are some there are some payments which is to be done after some period of time. So that's why accordingly we adjust it, right? How many types of cash inflows are there, guys? 3 types. Everyone, first, cash inflow from projects. Second, salvage. Third, recovery of working capital. And cash inflow from the projects, it can be constant also and it can be variable also, different also. If it is constant, can I use present value annuity factor? And when it is variable, we have to prepare what? A table. And then whatever is your working capital recovery and the salvage, when are we going to receive recovery of working capital and the salvage? Can I say we are going to recover that at the end of the project? Right? And NPV should always be lower the better, higher the better. And if the NPV is positive, should we invest in that particular project? Come on, yes or no? Yes, sir. Then the second method, IRR. What is IRR? One particular discounting factor at which dash is equal to dash. PV of CI is equal to PV of CO, right? And IRR should always be higher the better, and IRR should be greater than cost of capital. We always calculate IRR by using trial and error method, where we create a range. Come on, yes or no? Where one PV of CI should be greater than PV of CO and one PV of CI should be less than the PV of CO. We create a range and then we use interpolation method. Solo yaar. After that, then we also did something with regards to your third method, which was profitability index. Because it's an index, can I say we have to take dash upon dash? PV of CI upon PV of CO. At IRR, PI should always be 1. But if it is greater than 1, then we learned how to calculate PV of CI, and with that we learned also how to calculate your cost of capital, our very first question which we did. And then we also understood the next method, which was payback period. What was payback period? That particular time period in which your investments were getting recovered, right? Payback period, it can be calculated in 2 ways. It can be calculated either in the form of cash inflows which were constant. So we use the formula. What is the formula? Cash outflows upon cash inflows per annum. There is no need to remember this formula. It's very simple. That whenever the cash inflows per annum are same, suppose 1 lakh, 1 lakh, 1 lakh, 1 lakh, every year it is same. Then can I say we have to take 10 lakhs and divide that by 1 lakh? Can I say we will get the payback period? Come on, yes or no? Yes, sir. And guys, whenever cash inflows are not constant, we have to compulsory prepare one table in which we have to use what? Cumulative cash inflows. And then cumulative cash inflows, we have to take into consideration CCI method. Between two cumulative cash inflows, we will be getting your payback period. Discounted payback period. Are we going to take cash inflows or we are going to take present value of the cash inflows? Present value. And then we are going to do CCI, and based on that, we are going to do the calculations. And then after that, payback period and discounted payback period. Lower the better, higher the better. Come on, come on, come on. Lower the better. Because if it is lower, it means your investments are getting recovered as fast as possible. And then we had something which was called as MIRR. Okay. ARR also, you always know what is ARR beta. Average NPAT upon average investment into 100. Okay. Now let us start with the next question. We are now going to do question number 4 is done, 5 is done, 6 is done, 7 is done. Oh, question number 9. Chalo, let's get started with this question. XYZ is planning to introduce a new product with a project life of 8 years. Initial equipment cost will be what? 3.5 crores. Additional equipment cost will be what? 25 lakhs. And it will be purchased at the end of the 3rd year from the cash inflow of this year. Hey, are we purchasing 2 machines? Come on, yes or no? Solo yaar. The first machine which we are purchasing is nothing but at the beginning, at year 0. Can I say the second machine which we are purchasing, that is at the end of 3rd year? But we have to understand that we have to purchase that machine from the cash inflows which will be generated at the end of the 3rd year. So whatever is your 3rd year cash inflows, from that can I say we can purchase that particular additional equipment? Come on, yes or no? Yes, sir. Okay. So will it be forming part of the cash outflow, or will you subtract it from the cash inflow? Subtract it from the cash inflow, because that is something which is specifically given to you. Then at the end of 8 years, original equipment will have no resale value, but additional equipment can be sold for what? 2,50,000. So in this particular case, can I say that are we going to have your salvage value also come on? Yes or no? Yes, sir. So there is going to be some salvage also. Okay. 1 second. Huh? Okay. So then we are going to have some salvage also, and salvage will be pertaining to your which machine, beta? Your salvage will be pertaining to your addition. Okay. And then a working capital of how much will be required, beta? 40 lakhs will be needed, and it will be released at the end of the 8th year. Even if they would not have mentioned, can I say we always release the working capital at the end of which year? At the end of 8th year. Are you guys trying to understand this? Then the project will be financed with sufficient amount of equity capital. The sales volume over the 8 years is given to you from year 1, year 2, year 3, year 4 to 5, year 6 to 8. We have units per year which is given to you. A sale price of rupees 240 per unit is expected, and the variable expenses will amount to what? 60% of the sales revenue. Fixed cash operating cost will amount to what? 36 lakhs. And the loss of any year will be set off from the profits of the subsequent 2 years. And the company is subject to what? 30% per tax, percent tax rate, and considers 12% to be your appropriate after tax cost of capital for this project. And the company follows which method of depreciation, beta? Straight line method of depreciation. We are required to calculate the NPV of the project and advise the management to take appropriate decision. Okay. How should you approach the question? In this question, my dear students, which method are we going to follow? NPV method. We will select the project in which the NPV should be higher the better, lower the better. Higher the better. In this, there is only one project. If the NPV is positive, can I say we will select this particular project? Come on, yes or no? Yes, sir. What should be your approach to the question? Everyone. This is now solution to which question? Question number 9. Please tell me, NPV can be calculated in how many steps? 3 steps. What is your first step? Calculation of NPV. Formula, Solu. PV of CI. From this, what do we subtract? PV of CO. Will we be getting the NPV? Come on, yes or no? Yes, sir. What is your step 2? Your step 2 is nothing but PV of CO. Can you please tell me how many types of COs are there in this question? 2. First is what? Initial investment. Are you understanding the flow of the question? Second is what? Investment in working capital. Now, if you are wondering, sir, what about your additional equipment? Will the additional equipment come here, or the additional equipment will be subtracted from the cash inflows? It will be subtracted from the cash inflow, so we don't have to touch it right now. Okay. Give me initial investment, guys. Come on, yaar. What is your initial investment? 3 crore 50 lakhs. Okay. And what is your working capital, everyone? 40 lakhs. Can I say this both will be incurred today itself, so it should be multiplied by 1. So that is why this will be now 3.5 crores. This will be 0.4. So ultimately, what is your final answer? Can I say 3 crore 90 lakhs? Is this nothing but the PV of CO? Come on, yes or no? Yes, sir. After this, then the next step, third part, is nothing but your PV of CI. Can you please tell me how many types of CIs are there? 3 types of CIs are there. First, what is the first type of the CI? Can I say cash inflow from project? What is the second type? Cash inflow, salvage. And third is what? Release of working capital. In this question, do we have all the 3 types of cash inflows? Come on, yes or no? Yes, sir. Okay. Please tell me, here there will be particulars, and here there is going to be year 1, year 2, year 3, and then can I say year 4 and 5, we are selling 2,70,000 units, 2,70,000 units. So don't you think cash inflows for year 4 and cash inflows for year 5 are both going to be the same? So instead of preparing 2 columns, can I just say if I only prepare 1 column, then that cash inflow is going to be constant for the 5th year also. Come on, yes or no? Yes, sir. So I will write down here 4 and 5. And the last one is what? 6 to 8. Have you understood this? Okay. Chalo, how do we start with the income statement, everyone? Sales. From sales, what do you subtract, guys? Variable cost, right? What do you get? Contribution. From contribution, what do you subtract? Fixed cost. Then what do you get? Here, but we have to write down NPBDT. What do you have to write down, beta? Net profit before interest, depreciation and tax, but interest is not there. So can I say it is going to be nothing but net profit before depreciation and tax? So there is going to be NPBDTR. And from this, what do I have to subtract? Depreciation. Can you please tell me what are the two types of depreciation which we are going to have? No, two types of depreciation. One is going to be on your initial investment and the second one is going to be your additional investment. So there is going to be initial also and there is going to be additional also, right? Then what are we going to get, guys, after this? Can you please tell me NPBT? From this, what do you subtract? Tax. Can you give me tax rate, everyone? What's the tax rate? 30%. So can you all please give me what is going to be this answer? Net profits after tax. To this, what do you add, guys? Depreciation. What are we going to get? Cash inflows. But be very careful that depreciation which we have to add, that also has to be for your initial equipment and that also has to be for your additional equipment. And then from the amount of the cash inflows, what are we going to do, beta? Can I say now we have to purchase some additional machinery? So then what we are going to do? We are going to purchase additional machinery. So this additional machinery will be subtracted. Come on, yes or no? Yes, sir. So ultimately what we will get is called as your adjusted cash inflow. And this additional machinery which we are going to purchase, are we going to purchase every year or only from the cash inflow at the end of the third year? Cash inflow at the end of the third year, because that is specifically given to you. Are you all okay with this income statement format? First tell me that. Fine, perfect, superb. Okay. Chalo. Everyone please tell me now how are we going to start? We'll start with what? Sales. Okay. Everyone please give me what is the amount of the sales? What is the amount of the sales? Guys, tell me, do you have quantity? Solo yaar, 72,000. What's the selling price per unit? 240. So can I say that my first will be 72,000 into what? 240. Can you give me what is this? 1 crore 72 lakh 80,000. What is the variable cost? Have they given you percentage? How much percentage have they given to you? 60%. So can I say this variable cost will become 60%? So I multiply this by 60%. I get 1 crore 3 lakh 68,000. So then I'll be getting your contribution, which is nothing but 69 lakh 12,000. Guys, what is the amount of the fixed cost? They have told you that the fixed cash operating cost. This 36 lakhs, does it include depreciation or it doesn't include depreciation? Because it is specifically mentioned fixed cash operating cost. Acha, even if they would have mentioned fixed operating cost also, na, we would have assumed that this is what excluding depreciation we would have written it, until unless specifically given. Do you remember in that Naujivan, in one of the questions they had specified that this fixed cost is what? Including your depreciation, right? So here it is what? Here there is no depreciation in it. Okay. What's the amount, guys? 36 lakhs. Hello? Acha, is there any other fixed cost? Just check. No. Okay. So now what is this going to be, everyone? Can I say this will be nothing but how much? 33 lakh 12,000. Are you all convinced by this? Okay. Now let's talk about the depreciation. Initial equipment, what's the cost? No, it is 3 crore 50 lakhs. It is 3 crore 50 lakhs. Do you have salvage for the initial equipment? Do you have salvage for the initial equipment? I'm asking you. There is no salvage. Do you have life? 8 years. So depreciation is 3 crore 50 lakhs minus salvage is 0. Life is 8. Can you give me? 43 lakhs 75,000. So is this going to be your depreciation? Come on, yes or no? Yes, sir. Okay, and additional depreciation, will it come up for year 1? Because we have not even purchased the machine, so it's not going to come here. Okay. After that, please tell me, guys. You will be having an NPBT. What is your amount of the NPBT, guys? Can I say there is a loss? What is the loss which you are getting? 10 lakh 63,000. Now, if there is a loss for the first year, will there be any tax or there won't be any tax? Of course, there is not going to be any tax, guys. So will there be tax or no tax, guys? No tax. So that is why there is not going to be any tax. So this will continue at what? 10 crore 63 lakhs. Right? And then we'll be adding what? Your initial depreciation, which is what? 43 lakh 75,000. Can I say there is no additional depreciation? Your cash inflow will be what? Can I say nothing but 33 lakh 12,000? Are we purchasing any machine at the end of the first year? No. So that is why this will be what? 33 lakh 12,000. Are you all convinced with this particular part? Solo yaar. So your first year depreciation will be what? It is going to be your 33 lakh 12,000. Which question are we doing? Question number 9. Okay. Can you see cash inflow for the first year is 33 lakh 12,000. Ours is also what? 33 lakh 12,000. Let's talk about the second year. Second year, do you have your quantity sold? How much is that? 1 lakh 8,000. Now take 1 lakh 8,000 and you multiply that by the selling price per unit. What is the selling price per unit? 240. What is your sales, guys? 2 crore 59 lakh 20,000. What is your variable cost? 60%. So this is going to be what, beta? 1 crore 55 lakhs 52,000. Come on, yaar. So now in this particular case, what's going to be my contribution? 1 crore 3 lakh 68,000. What's your fixed cost? 36 lakhs. Can you please give me what's going to be my NPBDT? 51 lakh 84,000. Is that the case? No, na? No, this. 1 crore 3 lakh 68,000 minus 36 lakhs. 67 lakh 68,000. Are we going to have initial depreciation? Initial depreciation 43 lakh 75. Are that will to come na? Are initial depreciation means depreciation on your initial machinery. Are that is going to come every year na? SLM method, will it be constant every year? Solo. Okay. So this is going to be 43 lakh 75,000. So this will be what? 23 lakh 93,000. Is there any tax? Yes. But here there is a twist. Because I want you to just read to this particular statement. The loss of any year will be set off from the profits for the subsequent 2 years. Please tell me, in your very first year, was there any loss? Are we going to pay tax on the same? No. But if there is a profits, are we going to set off the loss with that amount of the profits? Come on, yes or no? Yes, sir. So please tell me what was the profits here? 23 lakh 93,000. This was the profits. On that profits, first we have to set off the loss. What's the loss? 10 lakh 63,000. Everyone please tell me what is going to be now? What is going to be now? Your answer 13 lakh 30,000. Can I say this is nothing but the profits on which you have to pay the tax? Solo yaar. Now, what is the tax rate? 30%. So you have to pay tax at the rate of 30%. How much is that? 3 lakh 99,000. So make sure that your tax working is prepared properly and 3 lakh 99,000 needs to be subtracted. Purinjida? Okay. So from this now if I now subtract 23 lakh 93,000 and if I subtract 3 lakh 99,000, what is this answer going to be? 19 lakh 94,000. Okay. Then what is the initial depreciation? 43 lakh 75. So can I say to this I will add what? 43 lakh 75,000. What is the answer going to come? 63 lakh 69,000. Did you all realize this? Okay, 63 lakh 69,000. Did you understand this loss adjustment? And it will be allowed for set off for how many number of years? 2 years. Acha, if it is more than, if suppose your loss, it gets lapsed, 2 years is getting lapsed, then it is waive off. Okay, so there is no need for setting it off further. Okay. Third year. Everyone please tell me, third year, do you have your sales? Come on, yaar. How much is that? 2 lakh 60,000. So please tell me 2 lakh 60,000. You'll multiply that with what? 240. Everyone please tell me what's your sales? 6 crore 24 lakhs. What's your variable cost? I'll multiply that by 60%. So that will be 3 crore 74 lakh 40,000. Will I get my contribution? 2 crore 49 lakh 60,000. What's your fixed cost? 36 lakhs. What's your NPBDT? Hello? This is now going to be 2 crore 49 lakh 60,000 minus 36 lakhs. 2 crore 13 lakh 60,000. Okay. Initial depreciation will come? Yes, sir. Additional depreciation will come? No. Not yet. Why? Because additional depreciation should only be taken into consideration when we are at the end of the third year, we are purchasing a new machine. So only after that, can I say that the additional depreciation will come? Come on, yes or no? Yes, sir. So now from this, if I subtract 43 lakh 75,000, can you give me what is this? 1 crore 69 lakh 85,000. Is there any loss which is left to be set off? No. So that definitely on this entirely we have to pay the tax at the rate of what? 30%. How much is that? 50 lakh 95,500. So what is the NPAT going to be, beta? 1 crore 18 lakh 89,500. Correct? And then my dear students, what was your initial depreciation? 43 lakh 75,000. Will that be subtracted? Come on, yes or no? Yes, sir. 43 lakh 75,000. So if I subtract this, sorry, if I add this, 1 crore 88,9,500 add 43 lakh 75,000. How much is this coming, beta? 1 crore 62 lakh 64,500. But this is not my final cash flows. Are we purchasing some machine at the end of the third year? Hannah, how much machine, how much is the additional cost? Can you please tell me additional? Can I say that is nothing but what? 2 lakh 50,000. 25 lakhs. This is what? Yeah, it is here. 25 lakhs. So can I say we are going to now subtract what? 25 lakhs. So this should be coming as what? 1 crore 37 lakh 64,500. Are you guys trying to understand this? Okay. They have taken this year as the part of this particular part. As you can see now, they have considered year like this. Can you see this? They have done two separate calculations for the same. Okay. But if you just take this now, 162.645 minus 25, you will be getting, see, 137.645. Exactly what we have got. Okay. So they have taken two separate things. We have done it in one income statement only. Are you guys okay with this? Okay. And as I told you, the combination of this is nothing but what we have got here. Okay. Chalo. Next, now fourth and fifth year. Please tell me now, do I have to calculate for 2 years separately or 1 year will be sufficient, beta? 1 year is going to be sufficient, right? Because that will be constant for the fifth year also. Can you please tell me what is your sales for the fourth year? 2 lakh 70. Everyone in one voice, 2 lakh 70. What's the selling price per unit? 240. Right? So multiply this and give me what is this sales going to be? 6 crore 48 lakhs. What is the variable cost? 60%. So this will be what? 3 crore 88 lakh 80,000. Can you give me what is going to be your contribution? 2 crore 59 lakh 20,000. What is the fixed cost? 36 lakhs. No problem in this. So this will be what? If I subtract 36 lakhs, I'll be getting what? 2 crore 23 lakh 20,000. Okay, will my depreciation come? Come on, yes or no? Yes, sir. But now, my dear students, will the additional depreciation also come? So for additional depreciation now, please tell me what is the original cost of the additional machinery? Shri, how much is that? 25 lakhs. What is the salvage? 2 lakh 50. What's the life now? 5 years. Because are we purchasing at the end of the third year? So don't you think the remaining life is going to be for how many number of years? 5 years. So this is now going to be what? 25 lakh minus 2 lakh 50. Divide that by 5. That is nothing but what? 4 lakh 50,000. So this will be now what? 4 lakh 50. So now from 23 lakh 20,000, if I subtract 2 crore 23 lakh 20,000. Now I will subtract what? 43 lakh 75,000. And will I also subtract 4 lakh 50,000. So this is going to be what? 1 crore 74 lakh 95,000. Are you all okay? Now what's the tax rate? 30%. So this is 52 lakh 48 500. What is your NPAT, guys? 1 crore 22 lakh 46,500. Will the initial depreciation come? Yes. Will the additional depreciation come? Yes. And how much is the additional depreciation? 4 lakh 50,000. So this minus 43 lakh 75,000 plus 1 crore 22 lakh 46,500 plus 43 lakh 75,000 plus 4 lakh 50,000. How much is this coming? 1 crore 70 lakh 71,500. Is everyone okay with this? Sure, confident? Okay. Now please tell me, this is 170 71 500. Just check. Is this 170 71 500? Just check it out here. Yes, sir. Now please tell me, this 170 71 500. Is this going to be same for the 5th year also? Right? So again, do I have to prepare a column, or this is okay, beta? This is okay. Same, I will do it for 6th year also. So for 6, 7, 8, will I prepare 3 separate calculations, or 6th year is okay, beta? 6th year is okay. So I'll be getting this 1 crore 10 lakh 23,500. This is the answer which I'm going to get. Now, how will I do the calculations? So now just see, for PV of CI, I'll be having year 1. How many years do I have? Year 1, 2, 3, 4, 5, 6, 7, 8, 8, 8. I have written 1, 2, 3, 4, 5, 6, 7, 8, 8, 8, 8. Whose phone? Your phone. Okay. So these are 8 years. Can you please tell me now what is going to be the cash inflow, beta? Cash inflow for the first year. Just check. What is the cash inflow for the first year? 33 lakh 12,000. Okay, so first year cash inflow is 33 lakh 12,000. So will your cash inflow come here, which is 33 lakh 12,000? Solu yaar, what's your second year cash inflow? 63 lakh 69,000. What's your third year cash inflow? 1 crore 37 lakh 64,500. What is your fourth year cash inflow? Will your fourth year cash inflow be 1 crore 70 lakhs 71,500? Right? And what is your fifth year cash inflow? Can I say that will be 1 crore 70 lakhs 71,500? Yes or no? Yes, sir. My fifth year is also going to be the same. Arey Baba, fourth and fifth year cash flows are going to be the same, na yaar? So whatever is fourth year cash inflow, that has to be fifth year. What is your sixth year cash inflow? 1 crore 10 lakh 23,500. So can I say that will be for seventh year also? That will be for your eighth year also. Now at the end of eighth year, what is going to happen? Are we going to receive some salvage? Come on, yes or no? Yes, sir. What is the amount of the salvage, guys? 2,50,000. Are we also going to recover your working capital? Come on, yes or no? Yes, sir. What's the amount of the working capital? 40 lakhs. All these things, we are going to discount it at some particular percentage. How many percentage, beta? Then they have told you the percentage is 12%. Will I be getting the PV of CI? Come on, yes or no? Yes, sir. From this PV of CI, I subtract PV of CI, I'll be getting NPV. Did you guys understand this? You all understood the format? Hey, online students, please answer in the chat box. You all understood this? I would request if you all can respond today, it will be very nice. Everyone, okay? So this is going to be my PV of CI, okay? So in this particular question, we learned how are we going to do what? Set off of loss. How are we going to calculate the cash inflows when additional machinery is purchased? We have learned that how, if fourth and fifth the cash inflows are constant, what should be our approach? For 6, 7, 8, if the cash inflows are constant, what should be our approach? So all these things we have discussed here. Okay. Shall we continue this further? Okay. Now let us start with your question number 10. Now see question number 10, 10 and then, okay, fine, chalo, we'll do question number 10. This is a slightly lengthy question, okay. In examination, such kind of a question will be asked. That is, I think, I don't see such a huge question which can be asked, but part of it can be definitely asked, okay. So there is a shorter version of this question also, which is your question number 13, okay. This is very similar to your this question number 10, which we are going to do it, okay. Chalo, let us first read the question. What is given to you? A large profit making company is considering the installation of a machine to process the waste produced by one of its existing manufacturing process to be converted into a marketable product. At present, the waste is removed by a contractor for a disposal on payment by the company of 150 lakhs per annum for the next 4 years. See, what is happening is there is one chemical company. Okay, there is one company. Now this company now is generating some waste. Now you cannot dispose this waste normally on road. You have to dispose it somewhere else because it's a chemical waste. So you have appointed one contractor. Whom have you appointed, beta? Contractor. Now what is the contractor doing? Is it taking the waste and throwing it somewhere? Come on, yes or no? Yes, sir. Will he do this free of cost? Or will he charge you something? Tell me. He will charge. So how much is he charging? Just check. He is charging what? Can I say rupees 150 lakhs per annum? So he has told that 150 lakhs per annum is going to be his what? Contract charges. Acha, what is this contract charges for? Can I say to dispose the waste from the factory and throw it somewhere? Come on, yes or no? Yes, sir. But the management of the company now, they thought that we can process this waste further. So this waste, when we put it in a machine, we get a product. And we can sell this product in the market also. So what they are thinking, should we dispose the waste or should we process the waste? Process. So they are thinking, okay, let us process the waste. That's what they are thinking. Okay. And the contract can be terminated upon installation of the aforesaid machine on a payment of compensation of 90 lakhs before the processing operation starts. Now, yaar, if you want to purchase the machine and process the waste further, this contractor will no longer be required. So you have to terminate the contract. But if you terminate the contract, you have to pay some compensation charges also. So what is the compensation charges which you have to pay? So can I say the compensation charges will be nothing but what? Can I say that will be nothing but rupees 90 lakhs? Just check. There is compensation charges of what? Rupees 90 lakhs. Are you guys trying to understand? Okay. This compensation is not allowed as a deduction for tax purpose. It is not allowed for deduction of a tax purpose. So in this particular case, is this compensation debited in the P&L account? No. So there is no tax savings on the same 90 lakh rupees, you have to pay it. The machine required for carrying out the process and will cost how much? 600 lakh rupees. What is this? Money coming in or money going out? Going out. So this is nothing but cash inflow or outflow? Outflow. So this is your CO. At the end of the 4th year, the machine can be sold for 60 lakhs. Can I say this is nothing but your what? Salvage. And the cost of dismantling and removing the machine is rupees 45 lakhs. Can you all please tell me what's the salvage amount? 60 lakhs. The salvage is 60 lakhs. And please tell me what's the cost of dismantling the machine? 45 lakhs. So can I say from 60 lakhs, 45 lakh rupees will be for dismantling the machine. So in your hand, how much is the net salvage which you are going to receive? You are going to receive 15 lakhs. Purinjida? Okay. You are going to receive how much? 15 lakhs. Then this will be the salvage which will be received now, or it will be received at the end of the 4th year. At the end of the 4th year. Sales and direct cost of the product emerging from the waste processing for 4 years are estimated as follows. Just check. What do you have? You have sales, you have material consumption, you have wages, you have other expenses, you have factory overheads, you have depreciation as per income tax rules. And then they have told you that initial stock of materials required before commencement of processing of the operation is rupees 60 lakhs at the start of year 1. Can I say this is nothing but actually your working capital? Why do I say this is working capital? Because we require how much amount beta? 60 lakhs by the way of material at the beginning of year 1. So can I say this is actually nothing but your investment in working capital? Because what is working capital? Current assets minus current liabilities. And does current asset have this stock of material with them? Come on, yes or no? Yes, sir. So what is this amount beta? 60 lakhs. And this 60 lakhs is going to be at the beginning of the year 1. So this is nothing but, can I say, working capital at your year 0. Right? 60 lakh rupees will be required. The stock level of materials will be maintained at the end of year 1, year 2 and year 3, which will be what? 165 lakhs. So at the end of year 0, you need stock of 60 lakhs. So that is going to be your investment in working capital. At the end of year 1, you need a stock of how much amount? 165 lakhs. But please tell me, because you have already invested 60 lakhs, now you have to just maintain the stock level of 165 lakhs. Your investment in working capital at the end of year 1, is it going to be entire 165 lakhs or it's going to be the difference? Difference, because you already have a stock of dash 60 lakhs. You have to maintain the stock level of what? 165 lakhs. Please tell me, what is the additional amount which will be required? So can I say 165 minus 60, that is nothing but what? 105. So will 105 lakhs will be required at the end of year 1? Come on, yes or no? Yes, sir. And the stocks at the end of year 4 will be what? It will be nil. So this is the stocks at the end of 4th year. And that is going to be nil. The storage of materials will utilize space which would otherwise have been rented out at rupees 30 per lakhs per annum. Now please tell me, what is the basic meaning of this? The storage of material will utilize the space. So basically, first we were disposing the waste. So we had some empty premises which we were giving it on rent. But now, because we are manufacturing the waste, we have to store materials. So that empty premises is used by us. So now will we earn rent or we will not earn rent? We will earn rent or we will not earn rent? We will not earn rent. So don't you think, what is that beta? That is nothing but your opportunity cost. What is that? Opportunity cost, because that is your inflow avoided. Can I say that money which you are supposed to receive, but now you will receive or you will not receive, boss? You will not receive. So don't you think that is nothing but your opportunity cost? Come on, yes or no? Yes, sir. So what is the opportunity cost beta? 30 lakhs. So this is your opportunity cost. Labor cost include wages of 40 workers whose transfer to the process will reduce the ideal time payments of 45 lakh rupees in year 1 and 30 lakh rupees in year 2. Now what is the meaning of this? Okay, just pay attention. Labor cost here, just check in year 1, what was the labor cost, everyone? What was the labor cost? Wages means labor cost. Now what was the labor cost? 225. Now listen to this very carefully. It included wages of 40 workers for which we were giving them idle time payments of what? Rupees 45 lakhs. So this 225, does it included some idle time payment? I'm asking you, does this 225 included some idle time payment? Come on, yes or no? Yes, sir. What is the idle time payment beta? 45 lakhs. So can you please tell me, 225 minus 45, what is this balance part? 180. So this is idle time and this is additional wages. Now please tell me, should we consider idle time payments in your investment decisions, yes or no? Then the answer is no. Now I'm explaining you something very important, just pay attention. In your investment decisions now, we have to ignore 3 types of cost. We have to ignore how many types of cost? 3 types of cost. The first one is called as irrelevant cost. The second one will be called as your allocation. And third one is called as your historical cost. Okay. Now see, what is irrelevant cost? I will tell you. Irrelevant cost means the cost which you have to incur anyway. The cost which you have to incur, whether you take this decision or whether you don't make this investment decision, you have to incur that anyway. So that is called as your what? Irrelevant cost. And irrelevant cost we don't consider in your decision making, because this is nothing but the cost incurred anyway. Whether you make the decision or whether you don't make the decision, this is the cost incurred anyway. It is irrelevant cost. What do you mean by this? See, I'll explain you. Let's say, for example, you want to buy a car and there are two cars in front of you. Which all cost will you take into consideration? Can I say what is the initial investment of the car? You will take that into consideration. You will take into consideration what is going to be the mileage. You will take repairs and maintenance. Will you take salvage? Yes. But will you take driver's salary? For comparing which car you should buy. Will you take driver's salary for comparing which car should you buy? Come on, yes or no? No. Why? Because driver's salary has to be paid irrespective whether you take this or whether you take this. Have you understood this? So will you consider irrelevant cost for decision making? Come on, yes or no? Then the answer is no. Irrelevant cost, we ignore it. Allocation. Allocation means what? It is called as distribution of overheads. What is allocation called as, beta? Distribution of overheads. Now what do I mean by distribution of overheads? Now listen to this. What is distribution of overheads? Very simple concept. Distribution means what? Ki bhai, you had as a head office incurred a particular expenditure. Now because you are now starting with some different line of product, you distribute some type of cost to the different line of product also. But actually you don't have to additionally pay for it. So whether to produce that product or not, for that decision making, should you consider this distribution of expenses? Then the answer is no, because there is no additional outflow. There is no additional outflow. See, what is allocation of expenses? Allocation means what? That you allocate already the expenses incurred to different types of products. Now suppose the company was already manufacturing something. They were manufacturing two products. Suppose head office expenses was 1 crore. So it was getting distributed to two products at 50 lakhs, 50 lakhs. But now one more product we want to manufacture. Can I say now this head office expenses will be divided into three products? So that will be 33, 33, 33. But are we spending that additional 33 when we are manufacturing new product? Then the answer is no. We are just distributing that. So distribution of expenses or allocation of expenses, does it lead to any additional outflow? No. And if it does not lead to any additional outflow, will it be forming part of your decision making? No, it will not be forming. So my dear students, will we consider distribution of overheads or will we ignore it? We will ignore this particular part. Why? Because this is just distribution. It does not lead to any additional cash outflow. And then what is the third part? Historical cost. Historical cost means cost which is already incurred in past. Something which is already incurred in past. Whatever is already incurred in past, are we going to consider that in decision making or we are going to ignore that? We are going to ignore that. Because it's already done in past. Now, it does not have any impact in future. So, whether you make decision, you don't make the decision, is already incurred in past. So, do we consider it or we ignore it? We ignore it because this was incurred in past. This was incurred in past. Okay? Everyone understood this first. Okay? How many types of cost do we ignore in investment decision? Tell me. 3 types. First is what? Irrelevant means what? You have to pay whether you make the decision or whether you don't make the decision. This is irrelevant cost. Second is what? Allocation. Allocation means distribution of expenses. So there is no additional cash outflow. We are just distributing that. We ignore it. We just have to take into decision making those inflows and outflows which you have to actually pay or get. We'll only consider that. And what's the third part? Your third part is your historical cost, because this was your last cost already incurred in past. We don't take that into consideration for decision making. Purinjida? Okay. Now please tell me everyone. Now please tell me everyone. When I talk about idle time payments, have you heard about idle time payments? Worker getting idle time payments. Now what is the meaning of this? That, you know, there are some workers whom I have to compulsory make the payment, but they have free time available with them. But still I have to pay them because it's a minimum wages, I have to pay them. Right? So suppose, for example, I am paying 800 rupees to my labor who has to work for 8 hours. Right? But right now I only have work for him for just 5 hours. Example. So can I say this 3 hours is idle time payment? Matlab he has no work but still I have to pay. Right? Now I am manufacturing a new product. So can I say his 3 hours which is empty, I will use that? Hello? His 3 hours which is empty, I am going to use that. So if that 3 hours which is empty, I am going to use that. Everyone in one voice, please tell me, are we paying something extra? Should I consider that for decision making? Then the answer is absolutely no. Why? Because idle time payments, I was paying it anyway. Whether he is going to do the production or is not going to do the production, I have to pay him anyway. Are you guys trying to understand? So idle time payment, should I consider for decision making or I should ignore it? Consider or ignore it? Because I am not spending something extra out of my pocket. So please tell me here, as I told you, from your 225 lakhs, 45 was your idle time payments. Will it come in decision making or it will not come? Solu yaar, it will not come. Similarly, in the second part, this is 45 lakhs and second year it is 30 lakhs. So what is the second year? 225. Can you please tell me for the second year from 225, how much is my idle time payments? Come on. 30. So what is your remaining part? 225 minus 30. 195. So what will come in your decision making? 195. Have you understood this? And year 3, year 4, there is no idle time payment. So that will be as it is. Next, factory overheads include apportionment of general factory overheads except to the extent of insurance charges of rupees 90 lakh payable on this venture. Now what they have told, in factory overheads, there is apportionment of expenses. Can I say apportionment of expenses means allocation of expenses? Okay, it means distribution of expenses. So there is distribution of expenses in every year except for your insurance, which is amounting to rupees 90 lakhs. So this 165 has two proportions. Can I say there is allocation and there is insurance? How much is the insurance? 90. Can you all please tell me in one voice, should we consider in decision making allocation or should we only consider insurance? We should only consider your insurance. So only 90 should be taken into consideration. Have you all understood this? Because allocation is just distribution of expenses. And distribution of expenses, we don't consider that for your decision making. Got it? Next. Tax rate is 30%. Company's cost of capital is 14%. And then these are the 4 years. Advise whether we should take into consideration your this decision making or not. First, did you all understand this question? It's a very nice question. Okay. Now, please tell me, what is the cost of the new machine? Just check, what's the cost of the new machine? It's there now. The machine required carrying over will cost how much? 600 lakhs. So can I say the cost of the machine is 600 lakhs? Now see, can you just check statement of incremental cash flows? What is the cost of the new machine, beta? 600 lakhs. Money va, money po. Come on, yaar. Money va, money po. Money is going to go out, 600 lakhs. So this should be negative. Please tell me, are we also investment in working capital? Material stock, are we investing in working capital? How much are we investing in working capital at year 0? 60. And how much are we investing at the end of year 1? 105. I explained to you how this 105 has come. Because we are enhancing the stock level. So the differential part, 165 minus 60, that is 105. But guys, what is always our assumption? Whatever we invest in working capital, don't you think we recover at the end of the project? Solo yaar, we recover that at the end of the project. So how much was the total investment in working capital? 165. Are we recovering at the end of the project? Yes. So can I say that 165 is your money va, money po? Money va. Money is coming in. So this is nothing but cash inflows. So this has to be 165 lakhs. Right? Understood? Then how much is the compensation for the contract we are giving? 90 lakhs. We have to give that immediately. At 90 lakhs. And this is also money coming in or money going out, beta? Money going out. So this also has to be 90 lakhs. Okay. But will there be any tax benefit on the same? No. They have not specified any tax benefit. So there is no tax benefit. Beta. Okay. No tax savings on the same. Now, also at the same time, can you please tell me any outflow avoided is your dash? Inflow. It's your savings. Any outflow avoided is nothing but your savings. So when we remove the contractor, we tell him get out. Now every year that 150 which we were paying, now we have to pay or we don't have to pay. So that is your money va, money po. Money va. So money is coming in. That's your savings. So don't you think that should also be taken into consideration? Come on, yes or no? Yes. So that will be what? 150, 150, 150, 150. But when this savings will be there, don't you think that the savings will enhance the profits? Because first you were debiting in the P&L account 150, 150, 150. Now you are not debiting it. So don't you think your profits have increased? And if the profits have increased, what do you think? You have to pay tax on the same. Come on, yes or no? Yes, sir. So there is tax on contract payment. So this is tax paid. And as I told you, do you know, when we are doing Navjeevan question, that hospital question, loss of commission income, they have told you it was mentioned net of taxes. That's why we subtracted later. But I told you that if this was before taxes, then we would have subtracted it with your NPBT, right? So they are considering this as your savings 150 and then tax on payment, they are subtracting it here. Okay. Then we just have to check what is the incremental profits which we are going to get. Now for incremental profit, we will refer here. What is the incremental profit? Incremental profit means what is the profits which is generating because we are selling this number of units. Okay. Now what will be your sales? Have they given to you sales? Directly have they given to you? Solu yaar, have they given to you sales? Yes or no? Yes, sir. So I will take sales as it is 966, 966 and this too. From this sales, what do you have to subtract, beta? Material consumption. Now material consumption, how much is it available? 90, 120, 255, 255. So this will be 90, 120, 255, 255. What about your wages? Can I say this is 225, 225, 255, 300? But will I write down entire 255, 225? Or should I reduce idle time? Reduce idle time. So here, as you all can check, it is just 180. That is excluding idle time. Superb. Are you guys able to understand this? Okay. And then other expenses is as it is 120, 135, 162 as it is. So that will be as it is. Factory overheads only insurance because remaining is what? Apportionment of expenses. And what did I tell you? Apportionment of expenses, we have to ignore it. So that will be what? 90. Depreciation, they have mentioned in the question as per income tax rules, we will write down as it is. Now, the only mistake what ICAI have done here is just check and tell me, do you have any rent? That rent wala part, just check. What was the rent which was given to you here? The storage of materials, we utilize the space which would have been rented out at 30 lakhs per annum. Now, my dear students, in my opinion, this 30 lakh rupees is before tax. It is not net of taxes. Where have they mentioned this 30 lakh rupees is net of taxes? They have not mentioned this 30 lakh rupees is net of taxes. Ideally, this 30 lakh rupees would have been my income and I would have paid tax on it. So my net opportunity cost should be post tax. But here they have assumed that this 30 lakh rupees is after tax, and hence the same is subtracted directly after tax. Can you see that? The same they have subtracted it after tax. They have directly subtracted here. In my opinion, this should be coming here before tax, because this is not post tax. Where have they mentioned that this is after tax? This is before tax only. So that is why it should be coming here, but we'll follow what ICAI have done. So that is why we are going to assume this opportunity cost before tax or after tax, beta, after tax. Just like how that commission income was when we were diagnostic machine, we were buying it. Do you know they had specified that the commission income was net of taxes. So that's why we subtracted that after tax. But had it been your before net of taxes, before tax, then don't you think we would have adjusted, because this would have been gross and minus that tax would have been paid. But here we have to assume this as after tax, so we will do that accordingly. Okay. Then we'll be getting profits after tax and etc. We'll be getting, this is your finally, what is this beta? This is nothing but net profits after tax. And to this net profits, what are we going to do? We are going to add your what? We are going to add your depreciation. See, can you guys just check this out here? Can you just check this out here? This is what? 336, 312, 408, 336. All this is my incremental profit. Right? You add back the amount of the depreciation. We'll be getting tax on profits, which is this particular part. This is tax on profits. Okay. And then this is the total incremental value which we are going to get. Okay. And also at the same time we'll be discounting it, and then we'll be getting the final. Acha, by the way, this is also a salvage. So salvage should also be coming here. So I would prefer, you know what you should do? You have got this profits after tax 235, right? You have subtracted loss on rent. Hello? You have subtracted loss on rent, because this is nothing but what? The amount which you are not getting it. So that's why we have subtracted loss on rent. What you all should do is, what is the NPAT for the first year? Tell me. 235.2. Hello, everyone's okay with the NPAT? Till NPAT to everything is the same only, na yaar? Okay. Then you add depreciation to it. What is the depreciation? 150. Okay, you add the amount of the depreciation to it. So once you add the amount of depreciation to it, what is this going to be, beta? 235.2, you add depreciation 150. So that is going to be what? 385. Solu yaar. 385.2. Okay. And from this you subtract this 30. From this you subtract the 30. How much are you getting? You are getting 355.2, right? Are you getting that? Okay. So now, see what they have done is, they have taken all these things put together, and that's how they have got this total incremental cash flows, which is 385.2. Okay. But you do one thing. This is 355.2, right? And if you just check this out, 336 plus 150 minus 100.8. Okay. See this part, not this part. Okay, is nothing but what? Can I put it like this? NPAT plus depreciation minus whatever is your opportunity cost. What is your opportunity cost? 30. So you take 235.2, add 150, and you subtract 30. Achha, but they have not subtracted only 30 anywhere. They have not considered your opportunity cost only. And have they given any note for the same? Material cost, idle time, apportionment of factory, sale of machinery, and saving in contract payment and income tax. They have not considered opportunity cost. See, I'll tell you what we have to do. See. हाँ किधर है अबाव? अरे ऊपर ही है ना. But 1 second, wait now. See, are you all okay with this income statement first? What is your NPAT till now? 235.2. I'll tell you what is to be done. Okay. Your NPAT, what's your NPAT for year 1? How much is that, everyone? What is your NPAT which you have got? 235.2. You add what? Depreciation to it. What's the depreciation? Your depreciation is nothing but 150. This is 150. What is the amount of the cash flows which you have got? 235.2 add 150. What is this? 385.2. Okay. You know what they have considered here? Just check. 385.2. So apparently that has to be taken into consideration. But here they have taken into consideration how much, beta? They have just taken into consideration this 385.2. So ideally what should have been done, and this 385.2 is nothing but 235.2 plus 150 depreciation, that is 385.2. And when this rent is not received, don't you think when this rent is not received, this has to be subtracted 30 year, which we did it in hospital case. When that commission income was lost. So they have considered that in their income statement here. They have considered that in the income statement here. Here they have considered it. But then they have not considered it while calculating the cash flows. So that's why they have just taken how much amount, beta? They have just taken into consideration your, how much amount they have taken into consideration. Just check. It is nothing but this particular part. 385.2. Are you guys trying to understand this? Okay. So this 385.2 will be forming part of this. Okay. So now this will be 385.2. What is this part? 437.4. How will you get 437.4? Now I'll explain you this. What is your NPAT, guys? 218.4. What is your depreciation, everyone? How much is your depreciation? 114. You add 114 to it. So this is 332.4. Right? And anything else which is there? But here though there are other things also, na? Like 150, 45, etc. So all this calculation has been done. So they have taken the combination of this entire thing. See, take on your calci 105 negative, then plus 150 minus 45 plus 336 plus 150 minus 100.8. That's how they have got this as 385.4. Entire combination of this from this to this. Okay, that is no problem. I don't have any problem with this. But the thing is, you know what? That we have to also take into consideration this loss of rent. This opportunity cost is not taken into consideration anywhere. So they have considered that till here. They have considered in this NPAT. Okay, no problem. But they have subtracted here. But this is of no use. Acha, in old book they have done it before the tax. So that is correct method. That is what it is to be done. That is something which I was talking about. You have to adjust it there. Given before tax. So that is what is given to you in the old textbook. I was just wondering that only. But here though they have completely ignored. So just to do one thing, just to, I think, take into, before they have did it well, but now in the corrected, this is the latest study material. They have not adjusted for this 30 lakh rupees rate. So this is the mistake in the question. Okay. So I will tell you what is to be done now. Okay. In your examination, what is to be done? I'll tell you that. Okay. Can I say you are going to have NPAT? Okay. What is the NPAT, guys? NPAT is how much? 235.2. There is no problem in your NPAT part. What you will do? You will add depreciation to it. What is the amount of the depreciation? 150. Will you be getting the cash inflows? What is the cash inflow? 235.2. Add 150. How much is that? 385.2. From this you have to subtract what? Loss in rent post-tax. Post-tax. So 30 lakh rupees was pre-tax. And you multiply that with what? 1 minus, what's the tax rate? The tax rate is nothing but how much? 30%. Can you just check the tax rate? What's the tax rate, guys? 30%. So this will now become what? 30 into 0.7. That is 21. Okay. And also at the same time, you know this part also. Contract payment and tax on contract payment. So how much is your contract payment saved? 150. So this is going to be add savings in contract post-tax. Contract payment post-tax. So what is the savings in contract payment post-tax? 150 minus 45. How much is the post-tax? 105. So this 105 needs to be added. This should be your correct cash inflows. 385.2 add 21 minus 105. 385.2 minus 21 add 105. How much is this coming? 469.2. This is the correct cash inflow at the end of the first year. So we have to adjust the post-tax rent, and we also have to adjust what? Savings in your contract tax payment. Okay. So unfortunately, this part is not considered in your new material which we are doing it. Okay. Chalo. Now, rest all what we have to do once we get the cash inflows, we have to discount it and then we have to bring it to what? Present value terms. Chalo. Shall we start with the next question now? Okay. Now let's do your question number 11. Okay. Are you ready? Okay. Now let us start with your question number 11. See what is given to you. Now this question is actually on your replacement decision. This question is on a replacement. That now we are going to replace the old machine with a new one. So what is going to be the consequences of that? Okay. Chalo. So let's get started now. I want you all to please read this question. Zalvi Limited has a machine which has been in operation for how many number of years? 3 years. The machine has a remaining estimated useful life for how many number of years? 5 years, with no salvage value in the end. And then they have told you that its current market value is what? 2 lakhs. And the company is considering a proposal to purchase a new model to replace the existing machine. Now the relevant information is given to you in which there is existing machine, there is new machine. Existing machine, cost of machine is 3 lakh 30, estimated life is 8 years, salvage is nil, annual output is 30,000, selling price is 15, annual operating hours, material cost, labor cost and indirect cash cost. The company uses the written down method of depreciation which is 20%. It has several machines in the block of the asset. The income tax rate is 30% and Zalvi did not make any investment if it yields less than 12%. Advise whether the existing machine should be replaced or not. Now see, my dear students, whenever we are talking about your replacement decisions, now we should always take into consideration your incremental cash flows. Now what is the basic meaning of incremental cash flows? Listen to me. Suppose you are already working in Chennai and your job is offering you a package of 10 lakh rupees. Okay. You get an opportunity in Bangalore and there the job offer is 15 lakh rupees. Please tell me that shifting from Chennai to Bangalore will lead to incremental cash flows. How much is the incremental cash flows? 5 lakhs. But now there is also going to be incremental cost. What is going to be the incremental cost? Rent. Can I say also at the same time there is going to be what? Some personal expenses, some food expenses, etc. So suppose those expenses only comes to 6 lakh rupees per year. Should you shift from Chennai to Bangalore? Yes or no? No. Because incremental revenue is less than the incremental cost. Got it? Similarly, here also there is existing machine. Existing machine will be generating some cash flows. But now when we are replacing that with a new machine, of course the new machine will cost you something. So new machine, you have to purchase it. Whatever is your initial investment minus salvage of the old machine, that will give you how much you have to spend for the new machine. But also at the same time, there is also going to be some incremental revenue. We have to check what is the present value of the incremental revenue. If the present value of the incremental revenue is greater than the present value of incremental cost, only then we should replace the old machine with the new machine. Have you understood this? So in replacement of machine onwards, which type of method we have to use? We have to use incremental NPV method. Which approach should you use? Beta, incremental. And what is incremental approach? Incremental means incremental PV of CI. We have to subtract that by incremental PV of CO. That's what is going to give you the final answer. Have you understood this? Okay. Now just check this out here. How should we approach this question? First of all, please tell me, in this particular question, what is the cost of the new machine? What is the cost of the new machine? We are purchasing the new machine. What's the cost of the new machine? 10 lakhs. But when we are purchasing the new machine, are we selling the old machine? What is the old machine which you are selling, beta? How much are we selling the old machine for? 2 lakhs. So can you please tell me what will be the money which will be going from your pocket? 8 lakhs. So this 8 lakhs, we need to multiply it by 1. So can I say this is going to be 8 lakhs? Any problem in this? Okay, so this is going to be 8 lakhs, no problem. This is going to be my incremental PV of CO. Now, my dear students, let us check how do you calculate your incremental PV of CI. Can you just check new machine, what is the output? 75,000. What's your selling price per unit? 15. Will I get my sales? Yes. Okay. So that is 75,000 into 15. Sales is 11 lakh 25. 30,000 into 15, that is 4 lakh 50. Okay. I don't want to look at this column right now. Okay. I will just say sales is 11 lakh 25. This is 4 lakh 50. From this, I have to first subtract material cost. Can you please tell me material cost is how much rupees per unit? 4. 4 into 75,000. How much will this be? 3 lakhs. And this is going to be what? 1 lakh 20. Because it's dependent upon the quantity, na? 30,000, 75,000. What is the labor? For labor, they have told you that old labor cost is 40 rupees and we are working 3,000 hours. So how much is this going to be? 1 lakh 20. Because labor cost is always going to be on the basis of the hours which you work. Come on, yes or no? Yes, sir. And what about the new machine? 70 into 3,000. So that is going to be 2 lakh 10. Indirect cash cost is also given to you. That is nothing but 50,000 and 65,000. Can I say I'll be getting now net profit before depreciation and tax? Will I get net profit before depreciation and tax? Come on, yes or no? Yes, sir. Sales minus variable cost, contribution minus fixed cost. Same process. We'll be getting your NPBDT. Now I have NPBDT available for existing machine 1 lakh 60. I have NPBDT available for the new machine 5 lakh 50. Can you please tell me if you are replacing from old to new, are we having incremental NPBDT? Come on, yes or no? Yes, sir. We are earning something extra. Come on, yes or no? Yes, sir. How much extra are we earning? 550 minus 160. Are we earning extra? 390. I need now just this 390. So that's why I told you that I don't want to refer to this column till here. I just need the difference amount of these two. So the difference amount of these two is nothing but what? It is 390. Have you all understood this? Okay. So if you are replacing the old with the new one, how much is the extra amount which you are earning? 390. Now the depreciation is on SLM or it's on WDV. WDV. So is the value of the block increasing? Come on, yes or no? Yes, sir. The value of the block increasing. How is the value of the block increasing? There are several other assets in the block they have told you. You have sold old machine, you have purchased new machine. Is the value of the block of the assets increasing by 8 lakhs? Are you feeling cold? No, no? Okay. So then can I say we are going to enhance the value of the machine by how much amount? 8 lakh rupees. Come on, yes or no? Yes, sir. So from 10 lakh, if I subtract salvage, 8 lakhs. Don't you think the value of the block will increase by how much amount? 8 lakhs. On 8 lakhs, we have to charge the depreciation. What is the depreciation rate, guys? 20%. So can I say 1 lakh 60? Come on, yaar. 1 lakh 60. So 8 lakh into 20%, 1 lakh 60. Now can you please tell me from 8 lakhs, if I subtract 1 lakh 60,000, what's the next amount? 6 lakh? Huh? 40,000. On that, multiply that by 20%. 1 lakh 28. Did you guys get it? Then again, this will be the depreciation. This will be MPBT tax, NPAT. Okay, add depreciation, will be getting the cash flows. We'll discount it and then we'll be getting your present value of the cash inflows. We'll be taking that present value of the cash inflows. Understood this? So in this particular question, have you understood? We had new machine. From new, we subtracted old. New machine NPBT we had old machine NPBT, we subtracted, we got the incremental NPBT. And that incremental NPBT, from that we subtracted the depreciation as per WDV method. So what was depreciation as per WDV method? Whatever was your new, from that you subtract old. So we understood that the block of assets enhanced by 8 lakhs, on that we multiply that by the depreciation and calculate it. But what about the salvage? Are we getting salvage at the end of the 5th year? Yes, 40,000. New machine salvage is given to you in the question, just check. They have told you that the new machine salvage is 40,000 rupees. This 40,000, when are we receiving? At the end of which year? 5th year. So we have to discount it and we have to bring it to the present value terms. So that will ideally give you final answer. That is 22,680. This is initial outlay. We'll be getting your NPV. If the NPV is positive, should we change the old machine with the new one? Come on, yes or no? Yes, sir. We should do that. Have you understood this? Okay. Sure, confident? Okay. Now question number 12. Question number 12. Now see what is given to you. A and company is contemplating whether to replace existing or to spend money on overhauling it. It means that whether we should go for repairs and maintenance on it. Okay. The replacement machine cost how much? 90,000 and requires maintenance of 10,000 at the end of every year for 8 years. Okay, so if you are purchasing the new machine has some tantrums. What is that? You purchase it right now for 90,000 and every year it requires maintenance of what? 10,000 for how many number of years? 8 years. At the end of 8 years, you can sell this particular machine for what? Salvage, which is nothing but 20,000. The existing machine requires increasing amount of maintenance every year and its salvage value will fall each year as follows. So present there is 0 maintenance and salvage value is what? 40,000. So old machine right now does not require any maintenance. Salvage is what? 40. But this old machine at the end of year 1 will require maintenance of what? 10 and the salvage is reducing. Can you just see, as and when the old machine life is increasing, maintenance cost is also increasing but salvage is reducing. This is a very common part. Suppose you have an Activa, you have a bike, you have a scooter, whatever, you have a car. You know that as and when the life will keep on increasing, don't you think maintenance cost will also enhance? And the salvage value will fall. The same thing is happening here. So they have told you that when the company should require. So this is called as optimum replacement time. When is the best time to replace the old machine with the new one? So this question is on what, beta? This question is on optimum replacement time. What is optimum replacement time? A concept where we have to understand when should you replace your old machine with the new one. That is called as optimum replacement time. Okay. Now what is this optimum replacement time? Understand this very carefully. See, my dear students, what is the life of the old machine? First of all, 4 years. Okay. Old machine can be operational for 4 years. You can replace the old machine today also, at year 0 also. You can replace it at the end of year 1 also, year 2 also, year 3 also, year 4 also. We should try and replace the machine in a year in which, can I say, the cost is least, the cost is minimum. Do you guys agree with this? The cost has to be least. We should replace the old machine with the new machine in a year in which the cost should be what? It should be least. It should be least. Now you must be thinking, sir, at which year should I replace? Now if you think about replacement today, right now itself, then don't you think you will get maximum salvage and maintenance will be negligible? And the maintenance will be negligible. When I talk about year 1, can I say that the salvage will be little bit lower and the maintenance will be higher? Then the salvage will be kept on falling, maintenance will be increasing. The salvage will be kept on falling, maintenance will be increasing. Towards the last, the salvage will be the least, maintenance cost will be highest. So you have to decide in which year should you replace this particular machine, in which year, at the end of which year you should replace the machine. Are you understanding this? Okay. So now in this particular case, just check that year now, as you all know that we have in this particular question, we have old machine, which has this maintenance cost and it has this salvage. New machine has a cost of 90,000. This is the maintenance and the life is 8 years. Anywhere in this question, can you see cash inflow from projects? I'm asking you, anywhere in the question, can you see cash inflows from machine? If the cash inflow from machine is not available, we can always use dash what? NCO method. Do you know net cash outflow method? Yesterday only we discussed, yaar. What is NCO method? A plus B minus C. What was A? Can I say PV of initial investment? What was B? PV of operating cost. And what was C? PV of salvage. Right? PV of initial investment, PV of operating cost, PV of salvage. Please tell me, new machine cost is how much? What is the cost of the new machine? 90,000. So can I say that is 90,000 which we are paying today? How much is the maintenance cost? How much is the maintenance cost of the new machine? 10,000. So can I say that will be 10,000 multiplied that by PVAF at some particular percentage for how many number of years? For 4 years. 4 nahi. New machine is for 8 years. New machine is for 8 years, na? So we have to take 8 years. So we'll be getting this answer. Okay. So what is the PVAF? They have done the calculation for you. Can you see 4.4873? So it is 4.4873. So this will be 44,873. This is your PV. Right? What is your salvage? How much amount of the salvage you are going to get? Can I say salvage is nothing but what? 20,000. And when are we receiving this 20,000 beta? We are receiving that 20,000 at the end of 8th year. So 8th year PV factor is also available with us. That is 0.3269. 0.3269. Can I say I'll be getting the salvage? And if I do A plus B minus C, what will I get? Will I get the NCO of new machine? So just check now the solution. The NCO of the new machine is 1,28,335. But I want every one of you to please answer me. What is the life? 8 years. What is the life of the old machine? 4 years. Is there any difference in life? And whenever Shri, there is any difference in life, what you have to do? Calculate the NCO per annum. How will you do that? Divide that by PVAF. So now what is the PVAF? 4.4873. You divide it, you'll be getting 28,600. So for new machine, everyone is okay. Solo yaar. Okay. But let's talk about the old machine. Old machine. Guys, if you replace immediately, now understand this very carefully. There are two methods for this, okay? But we'll do it in this ICAI method only. If you are replacing it immediately, can I say if you replace it immediately, the first thing is this 28,600 will be incurred at year 0, because you are replacing the old machine with the new machine. So if you are replacing it immediately, what is this NCO per annum 28,600 which will happen at year 0? But also at the same time, can I put it like this, that your old machine is going out, so you will be getting some salvage value. How much value of the salvage you are getting? 40,000. And all this is done at year 0. So there is one cash outflow per annum which is 28,600, and there is some salvage which you are getting 40,000. So don't you think that eventually at year 0 your cash flows are 11,400 positive? It is 11,400 positive. If you are replacing at the end of year 1, can you please tell me at the end of year 1 what will be the activities? First, if you are replacing the old machine with the new one, can I say immediately there will be NCO per annum which will be 28,600 which will start incurring. But you will also get the salvage of the old machine. Can you please tell me what's the salvage of the old machine? 25,000. But because you are using the machine for one more year, there is some maintenance cost also which is 10,000. So can I say if we discount it and we bring it to the present value terms, this is coming as negative 11,832. Acha, if you replace the machine at the end of 2 years, can you please tell me, because you are replacing the machine at the end of the 2 years, you will definitely incur at the end of the second year new machine 28,600. Come on yaar, NCO per annum, that will to come because you are replacing old machine with a new one. So this 28,600 NCO per annum is definitely going to come. But now, because you have used the machine for the period of how many number of years? 2 years, first year maintenance will also come. And second year maintenance will also come. And then you will be selling the machine at the end of second year. For what amount? 15,000. So ultimately when you do this calculations, you will be getting 34,102. Now you tell me how to do it for 3 years. You tell me how to do it for 3 years. If the machine should be replaced at the end of the third year, first what will come? You are replacing the old machine with the new one. So what is the NCO per annum for the new machine? Will that come? Solu yaar, how much is that? At the end of year 3, 28,600. But because you are using now the old machine for how many number of years? 3 years. Maintenance cost will come for. So can I say 1, 2, 3 maintenance cost will come. And then at the end of third year, what you are doing? Selling. So salvage will also come. Give me maintenance cost for year 1. Come on, look at the question. Tell me what's the maintenance cost? 10, 20, 30. All the 3 will come yaar. So there will be 10, 20, 30. All these are your outflows. And then there will be salvage at the end of third year. What's the salvage? 10,000. Now we have to discount this. Please tell me, you will discount 28,600 with the PV factor at the end of which year? At the end of third year. So what's the PV factor at the end of the third year? 0.658. So I will take 0.658. Year also 0.658. Year 1, what was it? Year 1, it was 0.870. So I will take 0.870. Year 2, how much it was? 0.756. I will take 0.756. This is also 0.658. Can you please give me the final answer? Give me the final answer. Remember that there are 4 outflows which are negative, only 1 is positive. Okay? 4 outflows which are negative. So please only take negative, negative, negative first and then subtract with the salvage at the end of the third year. How much is it? Give me the final answer. Are you ready with the answer? How much is it? 55? It should be negative. Just check. 55, 798. Negative. Now do it for 4 years. This is the question. Do it for 4 years. I will not help you. I will just tell you that NCO per annum which you had got was 28,600 negative. Do it on yourself. Give me for 4 years. What should be your answer? Okay, what is the answer, beta? 82,799.2. This is coming negative. Just check this out. 82,799. Did you realize this? How to solve it? Okay, NCO per annum, we will take it 28,600 as it is because we are replacing the old with the new. So NCO per annum will discount it, will bring it to the present value. Then we are having all the cash flows. We'll discount it, we'll be getting the present value. Now, at which year should we replace it? We should replace it at the year in which the NCO per annum is what? Least. But here though it is coming positive only, add, replace immediately. So should we go for the same? Come on, yes or no? Yes, we should replace the machine immediately. That makes more sense. Because here it is best, maximum. Got it? Solu yaar. Okay. Now I want you all to please come to question number 13. Now this question number 13 is very similar to what we just did. Now you'll realize what is there in this particular question. A chemical company is presently paying an outside firm ₹1 per gallon to dispose of the waste resulting from the manufacturing operations. At normal operating capacity, the waste is about 50,000 gallons per year. Please tell me what is the waste, beta? 50,000 gallons. So our waste is 50,000 gallons per year. Can you all please tell me if this waste is 50,000 gallons per year, 50,000 gallons into ₹1, can I say we are right now spending how much rupees? 50,000 rupees. Solu yaar, we are paying right now 50,000 rupees as contract charges. After spending 60,000 on research, the company discovered that the waste can be sold for 10 per gallon if it is processed further. Please tell me, after spending 60,000 for research, should we consider this in your decision making or should we not consider it? We should not consider it. Why? Because this is nothing but your historical cost. And historical cost should be considered, it should be ignored, beta. Ignore. Next, after that, what is given to you? Additional processing would, however, require an investment of what? 6 lakhs. in the new equipment, which would have an estimated life of how many number of years? 10 years with no salvage value. Can you please tell me now, how much are we spending? 6 lakhs. Is there any salvage? No. What is the life? 10 years. If it is straight line method of depreciation, can I say 60 lakhs? 60,000. Can I say that will be nothing but a depreciation debited in the P&L account? Come on, yes or no? Yes, sir. Next. Except for the cost in advertising 20,000, no change in present selling and administrative expenses to be incurred. So this 20,000 is your relevant cost. That should be taken into consideration, okay? Which is regarding this new product. And then they have told you that variable cost is rupees 5 per gallon and fixed cost is 30,000. So when I'll be taking sales minus variable cost, I will also have to take this fixed cost and I will also have to take this advertisement cost. All this will then give me my NPBDT. There will be no loss in processing, and it is assumed that whatever the waste is there, you are selling that. So 50,000 gallons will be sold. The management, when confronted with the choice of disposing the waste or producing it further, which alternative would you recommend? The tax rate is given to you. So how will you solve this? Very easy question, beta. Please tell me, first of all, what is your initial equipment? Initial equipment cost. 6 lakhs? Solo yaar. Okay, so 6 lakhs, money coming in or money going out? Going out, 6 lakh negative. Okay. Now just check the income statement. What is the sale value? 5 lakhs. What is the variable cost? 2 lakh 50. What is the fixed cost? 30. Advertisement cost? 30. Depreciation? 60. So then this is nothing but a total cost. This is your NPBT. Now they have considered this. Can you just check there is a savings which is happening? Because now what is happening that we are not making the payment to that contractors. When we are not making the payment to that contractor, can I say that is nothing but money is saved? If that is money saved, is it your inflow? Come on, yes or no? Yes. So that is savings of 50,000 rupees. So if you want this savings of 50,000, you can write down here also. Okay. And then total 1,90,000, pay the tax on that. Or else what you can do is, you can treat it separately also from this savings. How much tax we have to, we can take this savings. This is nothing but what? Cash outflow avoided. Outflow avoided is your inflow. So then you can add this 50,000 here and then on the total profits pay tax, or else you treat it separately. This savings of 50,000 and tax which is going to be there on the same, that is 25,000. So what was happening is, can I put it like this? Your P&L was earlier debited with this 50,000. But now your P&L will not be debited. So can I say your profits has increased by 50,000? So on that, do you have to pay tax to the government? Yes. So you are just left with what? 25,000. So this 25,000, you can treat it separately as your net outflow per year. This is nothing but net savings. This can't be your outflow. Okay. So here also they have added only. Can you just check? From the annual cash inflows 1,30,000, they have added 25,000. So that will be nothing but 1,55,000. And if I make it very simple for you, just see. From sales, what do you subtract? Variable cost. From that, if you are subtracting fixed cost, if you are subtracting advertisement, what will you get? NPBDT. You subtract depreciation. What will you get? NPBT. Now you were paying 50,000. You were paying 50,000 as your contract charges. But now because you are processing this waste further, are you paying this 50,000 or you are not paying it? If you are not paying it, boss, if you are not paying it, it means your profit should be lower or it should be higher. It is savings, right? So I can add your savings in contract charges. So this will be your adjusted NPBT. Okay. Then you pay what? Tax. You will be getting NPAT. You add what? Depreciation. What will you get? Cash inflow. Give me sales, everyone. Give me sales. How much are we selling? We are selling 50,000 gallons at what price? 10. So what's your sales? 5 lakhs. What's your variable cost? They have told you variable cost is 5. So that will be 2 lakh 50. What's your fixed cost? Your fixed cost. What's your fixed cost? 30,000. It's given here, 30,000. What's your advertisement cost? 20. Give me NPBDT. 5 lakh minus 2 lakh 50, 2 lakh 50 minus 30, 2 lakhs NPBT. What's your depreciation? 60. NPBT 1 lakh 40. How much are we saving? 50. Adjusted NPBT, because that is 50,000 gallons per rupee one, na? Okay, so this is going to be what? 1 lakh 90. To this 1 lakh 90, how much is the tax rate? 50%. So this will be what? 95. And how much is the depreciation? 60. How much is the answer? 1 lakh 55. Just check. 1 lakh 55. Superb. Income statement format. For which question was this? Question number 13. Cash inflow 1 lakh 55. This is much better. Instead of doing two separate things, this is much better. You just adjust everything in the income statement only. That's the best way to do it. Okay. Then after this cash inflows, what is the next thing which we have? We multiply that by PVAF, etc. We calculate and then we get the NPV. NPV is positive, we replace it. But here in this question, I hope you have understood that this research is historical cost. Consider or ignore, beta. We're going to ignore it. Okay. Last question. Oof. Are you ready? Last question of investment decision. Shall we do this? Okay. This question is more about costing. This question will make you realize more about costing. Okay. Let us read this question. What is given to you? Manoranjan is a news broadcasting channel having its broadcasting center in Mumbai. There are total 200 employees in that organization, including top management. As the part of employee benefit expense, the company serves tea or coffee to its employees, which is outsourced from a third party. So you know what is happening right now? There are 200 employees which are sitting in the office. And as a part of employee benefit, we are telling some third party to supply tea and coffee to this 200 employees. Will this cost company something? Of course, yes, na? Our company is not going to have this free of cost, right? So this third party who is going to come with that tea and coffee, he will charge company something. Come on, yes or no? Yes, sir. Continuing further, the company offers tea or coffee 3 times in a day to each of its employees. 3 times, huh? They are offering tea, coffee. How many number of times? 3 times. Okay. I'll also tell Charan to give me coffee. Okay. So they are offering tea and coffee for how many times, beta? 3. 3 times. Okay. So in this particular case, Charan, coffee. Okay. Kya? 2 chi. So now they are offering tea or coffee. Okay. So 3 times in a year. 120 employees prefer tea all the 3 times. Wow. So there are some tea lovers in the house. How much are they? 120. And 120 employees are asking for how many times tea? 3 times. Hello? So 120 into 3. Can I say 360 cups of tea are going? Come on, yes or no? Yes, sir. Okay. And then, if you continue this further, 40 employees prefer coffee all the 3. And there are 40 employees which are preferring what? Coffee all the 3 times. So this is tea, this is coffee. Come on. And then what is the balance? 120 plus 40, 160, 200. What is the balance? 40. Now let us see what these 40 people are doing. And remaining prefer tea only once a day. Okay. So they are, I think, diabetic. Okay. So that is why they are only preferring tea. How many times in a day? Only 1 time. So there's only 1 cup. 40 teas. Okay. Then after that, the third party charges what? Rupees 10 for each cup of tea. Okay. So can I say if they are charging rupees 10 for each cup of tea, 3,600 here and rupees 10 here, 400 rupees here. Okay. And what is the cost of the coffee? 15 rupees into 15. So can you give me this? 120 into 15, 1800. So this is going to be 1800. So what is your per day cost? Can I say your per day cost will be 1800 plus 400 plus 3600? Can I say 5800? Are you imagining company spending how much? 5800 per day just to serve tea, coffee. to their employees. 5,800 per day. Okay. Shri, you want to become tea coffee wala? Okay. Next, after that, looking at the substantial amount of expenditure on tea and coffee, the finance department has proposed the management on installation of a master tea and coffee vending machine, which will cost rupees 10 lakhs. So now what is the cost? The cost of the machine is what? 10 lakhs. So you know the vending machines which are there, So those vending machines, they want to keep a vending machine. And that vending machine, my dear students, that is going to cost you how much? 10 lakhs. 10 lakhs is the cost of the vending machine. Okay. And which has a useful life of how many number of years? 5 years. So this vending machine will have a life of 5 years. Acha, by the way, if you have this vending machine, then don't you think this will be saved? Obviously, this is savings. Okay. Upon purchasing the machine, the company will have to enter into an annual maintenance contract with the vendor, which will require a payment of what? 7,500. So there is a maintenance cost of what? 7,500 or 75,000? 75,000 per annum maintenance. The machine would require electricity consumption of 500 units per month, and the current incremental cost is rupees 12 per unit. So please tell me 500 units per month. Multiply that with what? 12. So per year, how many units? 6,000. And what is the cost? 12. Come on, yaar. So can I say 72,000 is nothing but what? It is nothing but your per year electricity cost. Apart from this running cost, the company will have to incur the following consumables also. Packets of coffee beans, which are 90 per packet. Tea powder is 70 per packet. Sugar is 50 per kg. Milk is 50 per liter. Paper cup, which is 20 paise. Each packet of coffee beans would produce 200 cups. And the same goes for a tea powder as well. And each cup of tea or coffee would have 10 grams of sugar on an average and 100 ml of milk. It is better that we start making tea coffee only. Okay. Because you know now exactly what are the ingredients, how much gram sugar, then how much will be your coffee powder, etc. everything. Okay. The company anticipate that due to the ready availability of tea and coffee vending machines, its employees would end up consuming more tea, coffee. Are you understanding what is this? What is the meaning of this statement? Because now the machine is available here only, na? Employees will start consuming more. They'll be like, chalo, let's go and have tea, coffee. First, so they were only getting how much? 3. But now they will start consuming more. So now you have to see. It estimates that the consumption will be what? 20% more on average. So those who are having 3 will now have 3 plus 20%. Are you understanding this? So number of cups will enhance. Also, paper cup consumption will be 10% more than the actual cups due to leakages in them. But this is also a practical thing. That when that paper cup which is there when you are taking, there is a leakage, immediately you take another paper cup and replace it. So that is also cost for the company. So the person who has prepared this question is definitely a tea vendor. Okay. Or a coffee vendor who knows everything about everything. So he knows that, double cup. Okay. I'll tell you what is to be done. I'll tell you. Don't worry. Okay. So we have to first see how many number of cups which we are going to take into consideration. Then we will see how to do the calculation. I will tell you. But first understand what is to be done in the question. We have to consider that also as the part of your cost. The company comes in how much percent tax bracket? 25. And what's the cost of capital? 12%. Straight line method is allowed. You are required to see whether we should adopt this or not. Now, I want every one of you to please tell me how many days in a year the company is operational. The company works for 200 days. Can I say 5,800 into 200 days? How much are you spending? 11 lakh 60. So the first part is you are spending 11 lakh 60. You are now making the decisions whether we should purchase the new machine or not, because you want to save this 11 lakh 60,000. Okay, so this is the decision making. Please tell me now how many cups are people having? Can I say tea cups is nothing per day? 360 plus 40 That is nothing but 400 cups per day. Arey solu yaar. How many tea cups per day? 400. How many coffee cups per day? Can I say 120 is nothing but coffee. Okay. Now please tell me, tea cups is 400 cups per day. Can you please tell me, if in a day there is 400, in 200 days, how many teacups are we talking about? 80,000 teacups. And if this is coffee cups 120 into 200, how much is this going to be? 24,000. Solo yaar. Now please tell me that this teacups was 80,000, but is the consumption enhancing by 20%? Hello yaar. So now ultimately how many teacups will go? 96,000. And for coffee cups, this is 24,000, but again 20% will be more. So how much is this going to be? 28,800. Are you all okay with this? Are solo yaar? 28,800. Now please tell me, what is the ideal cost? What can be the cost? Can I say first there can be coffee cost and tea powder cost. What is tea powder cost? It is 70 rupees per packet. Can you please tell me, in one packet, how many cups can you make? Each packet of coffee produces 200 cups, and each packet of tea tea powder will produce this. Okay, now this is very important. Please tell me, one packet will produce how many tea cups? 200. And how many coffee cups? Come on, yaar. 200. So can you please tell me, what are the number of packets which will be required? Can I say one packet is 200 cups? So for 96,000 cups, can you please tell me, 480 packets will be required? What is the cost per packet? 70 for tea, and here in one packet 200 coffee cups. So in 28,800, how many packets? 144. So 144 you will multiply it by, how much is it? Tea powder is this. Coffee is what? 90. So this is going to be 90. So can you please tell me, what is the total powder cost? 480 into 70. Can you give me this? 33,600. And this will be 144 into 90. How much is this? 12,960. This is the first type of the cost. Powder, tea powder and coffee. But second, please tell me, there will be some sugar also. How much sugar is there? 50 rupees per kg. But it is important also for you to understand now, how many grams of sugar will be required? 10 grams. Each cup of tea or coffee would get 10 grams. So can you please tell me, one cup is 10 grams of sugar. How many cups are we anticipating for tea? For tea it is 96,000. Solu yaar. So 96,000 into 10 grams. Can you please tell me how many grams? Into 10. Can I say 9,60,000 grams? Hello? But if I divide this by 1000 grams, so how many kgs of sugar? 960 kgs of sugar. Hello? And this I need to multiply it by, what is cost per kg? Cost per kg is 50. So what is the sugar cost? Can I say 48,000? Solu yaar. Thank you. It is nothing but 48,000. Sugar cost. Can you see sugar cost is more than the powder cost? Then can you please tell me, your 10 grams, and this is how many cups are we making here? 28,800. So how many grams of sugar? 2 lakh 88,000. Divide by 1000. So how many? 288 kg. What is the cost? 50. Give me 14,400. Are you all okay? 14,000 rupees, 14,400. So this is nothing but your sugar cost. This is sugar cost. What's the third part? Milk cost. Can you please tell me what is milk cost? 50 rupees per liter. 50 rupees per liter. Now 1 cup, how much ml? 100 ml. So 1 cup, 100 ml. Hello? Can you please tell me how many cups? How many cups? 96,000 cups. Can you please tell me how many ml? 96,000 into 100. This is 96 lakh ml. But divide that by 1000 ml. Because we want it in liter. So how many liters? 9,600 liters of milk will go. And what is the cost per liter? 50 rupees. Multiply that by 50. 4 lakh 80,000. This is milk. Then what about the next case? How many? 28,800? Solu yaar. 28,800. So how much this? 1,000 into 28,800. How much? 1,000 ml into 100 ml. 100 ml into 28,800 will give you 28 lakh 80,000 ml. Divide that by 1000 ml. How much? 2880 liter. Multiply that by 50. 1 lakh 44. This is milk cost. Last, paper cost. Paper cup. Your favorite. Tell me how many cups? 96,000, 28,800. But 10% will be utilized more. Hello? 10% will be utilized more because of the leakage in the cup. So how much is this? 96,000 plus 10%. 1 lakh 5,600. Cups. What is the cost of the cup? 20 paise. Multiply that by 20 paise. How much is this? 21,120. And this is 28,800 plus 10%. 31,680 into 0.2. How much is this? 6,336. Okay. Now just check the solution. What is the 75,000? See, savings 11 lakh 60. We all got it. Solu yaar. Savings was 11 lakh 60. We all got 11 lakh 60. AMC 75,000. That is also 75,000. We can directly write down 75,000. Electricity we got it 72,000. Solu yaar. 72,000. Coffee beans cost 12,960. Coffee bean. Just check this out. 12,960. Can you just check that? Come on yaar. 12,960. Tea 33,600. Tea 33,600. Then sugar 62,400. Let us check sugar. Add both these things. 48,000 plus 14,400. 62,400. 62,400. Milk 6,24,000. Add both these things. 6,24,000. Milk 6,24,000. Paper cup 24,756. Add both these things. 21,120 plus 6,336. 27,456. Just check. 27,456. Can I have coffee now? I hope you have understood. Then what do we have next? Depreciation, NPBT, tax, NPAT, depreciation, cash flows. Then we check. NPV is negative. If NPV is negative, what do you think? You should replace the machine? You should replace the vendor with the machine? No. We should continue with that third party. Anyway, that machine tea and coffee is not tasty also. Then it is better that we should continue with what, beta? Can I say we should continue with your third party? Because NPV is negative. Superb. Have you all understood this? With this, my dear students, finally, All the questions are now completed. Have you understood? Okay. Now we'll take a small break. After that, we'll continue further. Okay. 10 minutes we'll be starting with working capital. Then 1 hour we'll do, then lunch. Okay. Coffee break. Did you enjoy this? Chalo. Shall we start? Are you guys ready? Okay. Now we are going to start with your next part, and that is going to be your management of working capital. Okay. Are you guys ready? All my online students, are you guys ready? Write down in the chat box. Last chapter of your study module. Okay. So ratio analysis is done, leverages is done, cost of capital is done, capital structure is done, investment decision is done, dividend decision is done. Now we are going to do what? Working capital. Okay. So today, now in this management of working capital, okay, which all important things are there? Let us first quickly understand it. Okay. See, basically, what is the basic meaning of the word working capital? Can I say working capital is nothing but current assets minus current liabilities? Okay. Now in this chapter, we are going to learn how do we estimate this working capital. Okay. Now let's say, for example, you are a CFO of a company. Now if you are a CFO of a company, what will you do? You will have to first arrange for the funds. Okay. So what will you do? First you will decide, okay, that let's say, for example, you decide that I need investment in fixed assets amounting to rupees 10 lakhs. For the smooth functioning of those fixed assets, don't you think that you will need working capital? Yes or no? Yes. For day-to-day operations. See, if suppose I need in my fixed assets 10 lakh rupees, if I go to the bank and if I just ask for 10 lakh rupees, that 10 lakh rupees I will use and I will just purchase the fixed assets. Now, I don't have the money for doing the business. I should have working capital on the basis of which I can purchase stock. I should need working capital so that, I can make the payment to my creditors, to my labor, wages, etc. for administrative expenses. For all those things, we need the amount of the working capital. Without working capital, I'll not be able to function only. That is why it is important for a CFO to estimate the working capital amount. That's why this chapter is also called as estimation of working capital. We have to estimate the working capital. An estimation of working capital is required for either an existing company or it is required for your newly formed company. For both the types of companies, we have to learn how to estimate the working capital. Now, when I'm talking about an existing company, can I say, for example, you just got appointed as a CFO of Tata Motors. Now, today is what date? Example, you got appointed as a CFO on 26th of March, 2026. Okay. On this date, you got appointed as a CFO of Tata Motors. Now, in the next year, that is in the financial year 26-27, suppose Tata Motors is going to manufacture 2 lakh cars. Currently, it is manufacturing 1,50,000 cars. Please tell me, now when the level of activity is going to be increased, don't you think the need for working capital will also be more? With the same amount of working capital which was there in 25-26, do you think that you will be able to manufacture 2 lakh cars? You will need some extra amount of working capital. See, because earlier, what was the amount of working capital? It was only available for 1,50,000 cars which you are manufacturing. But now your level of activity has increased from 1,50,000 to 2 lakh units. So don't you think when the level of activity increases, the need for working capital also increases? So for every existing company, they will always plan in the next year what is going to be their level of activity. And based on that, don't you think there is a need for working capital? Come on, yes or no? Yes, sir. Also, at the same time, when we are talking from the newly formed company perspective, even they will have to estimate the working capital. If suppose you have just now started with a company, so don't you think now you should also need some amount of working capital for its smooth functioning? Come on, yes or no? Yes, sir. So estimation of working capital is required for how many types of companies, beta? Two types of companies. Whether it is existing company or whether it is newly formed, we have to learn how to estimate the working capital. And to estimate the working capital, level of activity plays a very, very, very important role. Can I say higher the level of activity, higher will be the need for working capital? Come on, yes or no? Yes, sir. But also at the same time, if you have to estimate the working capital, your time period is also very important. For how much time period your money is getting blocked in your raw material, for how much time period the money is getting blocked in your WIP, for how much time period the money is getting blocked in your finished goods, how much time period are we giving to our customers, how much time period are we getting from the customers. So time period also plays a very, very, very important role. Suppose, for example, you know, my raw materials money gets blocked for the period of 1 month. For my work in progress, that is to convert that particular raw material into finished goods, suppose I take 2 months. Then once I prepare the finished goods, it's not necessary it will be sold immediately. There will be some stock of finished goods also. Suppose your stock of finished goods is going to be there for 1 month. And once I sell these goods also, it's not necessary I will get immediate payment. There can be some credit period which will be offered to your customers. Suppose we are giving 2 months credit to your customers. So based on all these things, can you please tell me what is the total time period for which the money is getting blocked? 5 months. How much is it? 2 plus 1, 3 plus 1, 4, 6 months. And suppose when you are buying the raw material, your creditors are not giving you any time period. So can I say ideally the money which is getting blocked for how many number of months? 6 months. So today you will need some money so that you can survive for how much period of time? 6 months. Right? After 6 months you will get the money from your customer, then again you can do the business with that. So what are the number of operating cycles can you run when your credit period offered is, when your operating cycle duration is 6 months? Can you please tell me, in this particular case, can I say 2 times I'll be able to run the business? Come on, yes or no? Yes, sir. So I have to go to the bank and I have to ask for the amount of working capital which can help me to sustain for how much period of time? 6 months. And then that 6 months money will come again. Can I say I can utilize that for the remaining 6 months? Come on, yes or no? Yes, sir. So remember that operating cycle duration plays a very, very, very important role when you have to estimate the working capital. That for how much time period the money is getting blocked. So suppose my operating cycle duration is 6 months. And for example, my per annum, my total cost is 12 lakh rupees. So I've estimated that in the next year, I will require a total cost of how much? 12 lakhs. But I don't have to go to the bank and ask for 12 lakh rupees. I cannot go to the bank and ask for 12 lakh rupees. Why? Because my annual cost is 12 lakhs. But can I say that the money is only going to be blocked for how much period of time? 6 months. So I will go to the bank and ask for how much amount of working capital? 6 lakhs. Because this 6 lakhs will be rotated 2 times in a year, and that will be helpful for me to recover the entire 12 lakh rupees cost. Come on, yes or no? Yes, sir. So always remember that if suppose your operating cycle duration is lower, then the amount of working capital which you'll require, that will also be lower. Because that same amount of working capital will be rotated for more number of times in a year, and your 12 lakh rupees expenses throughout the year can be met. See, even your dad, he knows that during the next year, the total cost which will be required, that will be 12 lakh rupees to run the house. Do you think he will go to the bank on the first day and remove 12 lakh rupees and keep it with him? No. I hope you are trying to understand this. Okay. So similarly, when a company knows that 12 lakh rupees is the cost for the entire year, he will not go to the bank and remove entire 12 lakh rupees. He has to check that for how much time period the money is getting blocked. So in that particular case, let's say for example, in my second example, if my gross duration is 6 months, but creditors are offering me a time period of 3 months, then please tell me what's the net duration for which the money is being blocked. 3 months. So now what is the need for the working capital? 12 lakh into 3 divided by 12, only 3 lakh rupees. Because this 3 lakh rupees will be rotated for how many times in a year? 4 times in a year. And can I say my 12 lakh rupees expenses can be taken care of? Come on, yes or no? Yes, sir. So that's why to understand the estimation of working capital, two things are very important. One is your level of activity. What is this called as, beta? Level of activity. And the second thing which is required is called as your time period. If the level of activity is higher, can I say need for working capital is also higher? Also at the same time, can I say if the time period for which the money is getting blocked, if that is also higher, can I say the need for working capital will also be higher? So we need to check, for example, in a year, there is 12 lakh rupees. This is called as annual operating cost. So this annual operating cost, we don't have to go to the bank and ask for the entire 12 lakh rupees. We need to first check for how much time period the money is getting blocked. Suppose my operating cycle duration, what is OCD? Operating cycle duration. Suppose my operating cycle duration is 6 months. Now how much money will I go to the bank and ask for? How much money will I go to the bank and ask for? 6 lakhs. Because if operating cycle duration is 6 months, what are the number of operating cycles? How many number of times can I rotate this money in a year? Can I say 2 times? So what is number of operating cycle? 12 divide that by OCD. So that is 12 divided by 6. So can I say it is nothing but 2 times? But if suppose I need in a year 12 lakhs, if my operating cycle duration is just 3 months, can you please tell me what are the number of operating cycles can I run? 4 times. Come on here. 4 times. So now will I need here, what is the amount of the working capital? 3 lakh rupees. And here how much money will I need? 6 lakhs. So as a CFO, what do you think you should try and do? Should you try and have a higher operating cycle duration, or you should try and have a lower operating cycle duration? Lower operating cycle duration. So that number of operating cycles are higher. Can I say need for working capital will also be lower? Come on, yes or no? Yes, sir. So to estimate the working capital now, we need current assets and we need current liabilities. Give me different types of current assets. Stock. But how many types of stocks are there? Can I say stock of raw material, stock of work in progress, stock of finished goods? Can I say there can be debtors also, there can be prepaid expenses also, there can be cash bank also? Give me the list of current liabilities. What are the list of current liabilities? Creditors. There can be outstanding expenses, there can be bills payable, all these bank overdraft, all these things are your dash, current liabilities. So we have to estimate each and every item of CA and CL. Ultimately, can I say CA minus CL, will that give you your working capital? Come on, yes or no? Yes, sir. So now, how do you evaluate stock of raw materials? So for that, it is important for you to just check that what is the time period for which the money is getting blocked in stock of raw materials. Suppose the money which gets blocked in the stock of raw materials is for the period of 1 month. So I will check what is the total raw materials consumed for the entire year. Suppose my raw material consumed for the entire year is 3 lakh rupees. What is the raw material consumed for the entire year? 3 lakhs. Now to value the stock of raw materials, can I say 3 lakh rupees for the entire year? Then can I say for stock, it is only getting blocked for 1 month. What is the amount which is getting blocked? Can I say 3 lakh divided by 12? How much? 25,000. Can I say 25,000? 3 lakh divided by 12 is nothing but 25,000. So can I say 25,000 will be the stock of raw materials? Come on, yes or no? Yes, sir. Are you understanding this? So after raw material consumed, what's the next item which usually comes? Direct wages. Then can I say we have something which is called as your direct expenses. The total gives you what? Prime cost. To this you add what? Factory overheads. The total gives you what? Factory cost, also known as your works cost. But now let's say direct wages is 2 lakh rupees. There is no direct expenses. What's my prime cost? 5 lakhs. Suppose my factory overheads is 1 lakh. What is my works cost? 6 lakhs. please tell me now, if I want to value your stock of WIP, at what price should I value the stock of WIP? Now to value the stock of WIP, it is important that what is my degree of completion? What is my what? Degree of completion, also known as a stage of completion. Suppose they have given you specifically that work in progress should be 50%. That's the stage of completion which they have given to you. So in that particular case, I know that my total works cost is what? 6 lakhs. My total works cost, my total factory cost is 6 lakhs. But to value your WIP, do you think you will take entire 6 lakhs or you should take 50% of it? 50% of it, because they have specifically given to you. Because it is work in progress. Now what is work in progress? Work in progress means incomplete goods. And incomplete goods, do you think you should take all the cost on it, or you should only take some percentage which is applied to it? Some percentage. See, if this particular bottle is complete, this is my finished product, so I can value this at the total cost per unit. But if suppose I remove the cap, please tell me now, this is a finished product or this is semi-finished? And if it is semi-finished, then to value the cost of this, I should check now how much percentage is it complete. Suppose this is just 50% complete, then can I say I should only take into consideration 50% of its value? Come on, yes or no? Yes. So now 6 lakhs is my total works cost. I have to multiply this by how much? 50%. So can I say 3 lakhs should be taken on per annum basis? But then I need to check how much time is blocked in my work in progress. Suppose the time period blocked is 2 months. Then to value the stock of work in progress, what do you think I should do? 3 lakh is for the full year. I will take what? Into 2, divide by 12. It is nothing but what? 50,000 rupees. So can I say I will value the stock of work in progress at what price, beta? 50,000. But if they don't give you the degree of completion, na, we have to take 100% raw materials, 50% direct wages and direct expenses, and 50% of your factory overheads. So now in this particular case, what's my raw materials? 3 lakhs. So can I say I will take first 3 lakhs? Then labor and overheads is nothing but what? 50-50%. So 1 lakh here and 50,000 here. So this will be 1 lakh and 50,000 here. Can you please tell me 3 plus 1, 4. So this will be 4 lakh 50. And this 4 lakh 50 is on per annum basis. Suppose I need it for 1 month. Then can I say I will take 4 lakh 50,000, divide that by 12. How much is that? 37,500. So in that particular case, I will take 37,500 if it is 1 month. And if it is 2 months time period, then can I say this will be nothing but what? 75,000. Come on here. This will be your stock of WIP value. How do you now value your stock of finished goods? So to value the stock of finished goods, can I put it like this? That this cost of production, if opening and closing WIP is same, if opening and closing WIP is same, can I say that this works cost is equal to your cost of production? Come on, yaar. This work cost is nothing but your cost of production. Suppose your cost of production is 6 lakh rupees. What's your cost of production? 6 lakhs. Now suppose they give you something like this, that in a year you were manufacturing 50,000 units. How much were you manufacturing in a year? 50,000. But is it necessary how much you manufacture you have to sell that? Is it necessary whatever you manufacture you have to sell it? No. Suppose you have manufactured 50 but you have only sold 40. Then what is your closing stock of finished goods? 10,000 units. Then how do you value this on the basis of 10,000 units? Then can I say 6 lakh is the total cost of production in which I manufactured how much? 50,000 units. What's my cost per unit? 12. Come on here. My cost per unit is what? 12. But my cost per unit is 12. Now what is the closing stock? Suppose from 50,000 I have sold 40,000. Then can you please tell me what's my closing stock? 10,000. So I need to take 12 and multiply that with what? 10,000 units. So what will this be? 1,20,000. So sometimes your stock of finished goods, can it be valued on the basis of this data? Come on, yes or no? Yes, sir. Or else they can also give you time period. Suppose they give you stock of finished goods is going to be there for the period of 1 month. Then can I say I will take 6 lakhs into 1 divided by 12. In that particular case, the stock of finished goods will be valued at what? 50,000 rupees. So have you understood how to value stock of raw material? Stock of work in progress. So stock of raw material will always be valued at what? Raw materials consumed. Stock of WIP will always be valued on the basis of degree of completion. If it is given, follow instructions. If it is not given, assume 150-50. And to value your stock of finished goods, either they will give you units or either they will give you time period. If it is units, calculate what is the cost per unit, multiply that by number of units which are there in finished goods. And if they give it to you in time period basis, we will take, if this is per annum, 1 month should be how much? You cross multiply, you will be getting the value. Solo yaar, on this basis we can get the stock. Now how do you value your debtors? So to value your debtors, see, always remember that if you want to value your debtors in working capital should be valued on total cash cost basis. It should be valued on what basis? Total cash cost. See, my dear students, one very simple example I'm giving you. If I buy this phone for 10,000 and if I'm selling this phone to you for 15,000, okay, then can I say that if you give me the payment after 1 month, in my books of accounts, you are my debtor. And in books of accounts, I will always value the debtors at 15,000. But a finance manager knows that how much money is blocked in the debtors. Is it 15,000 or it is 10,000? Then the answer is 10,000. So when I want to take the money from the bank by the way of loan, should I take 15,000 rupees or should I take 10,000 rupees? 10,000, because actual money which is blocked in my customer is what? My total cash cost. And that is nothing but 10,000 rupees. See, I buy the phone from the bank. I buy the phone, and to buy the phone, I need some funds. So I want to buy the phone for 10,000 rupees. I want to sell it to you for 15,000 rupees. I will go to the bank and I will ask for the loan. Well, give me loan so that I can buy the phone and I can sell the phone. So bank will ask, how much loan do you want? Should I ask for 15,000 rupees or should I ask for 10,000 rupees? 10,000, because that is the money which I need for buying the phone and to selling it to you. So money which is getting blocked in my customer should be including the profit margin or should it be excluding the profit margin? Including or excluding the profit margin? It should be excluding the profit margin. So in that particular case, you should try to value the debtors at dash. Should you try to value the debtors at sales or should you try to value the debtors at cost? Then the answer is you should try to value the debtors at cost. So please tell me, if you want to value the debtors at total cash cost, what you will do? You had raw material consumed, you had direct wages, you had direct expenses. What's the total? Prime cost. You add what? Factory overheads. What do you get? Factory cost or works cost. If opening closing is same, can I say this is COP? If opening closing is same, can I say this is COGS? And to this I will add admin. And to this I will add what? Selling. Can I say I'll be getting something which is called as total cash cost. So I will value the debtors at total cash cost and not at sales. Okay. Suppose any prepaid expenses I have to value. Okay, by the way, suppose my total cash cost is 12 lakh rupees. My total cash cost is what? 12 lakhs. And suppose I give 2 months credit to my customer. So what is going to be your answer? What will be your money blocked in debtors? 12 lakh rupees is for full 12 months. So for 2 months, this should be how much? Can I say 2 lakhs will be blocked in my customers? Come on, yes or no? Yes, sir. Suppose if I ask, how do you value your prepaid expenses? Suppose I tell you that this administrative expenses are prepaid in nature. Then I have to check, suppose this administrative expense is 2 lakhs and that is prepaid in nature. So 2 lakh rupees is for entire 1 year. Suppose I want to check for 3 months, this should be how much? Then can I say I will take 2 into 3, divide by 12. What's the answer? 50,000. Sorry, 2 into 3, divide that by 12. Yeah, the answer is what? 50,000. Can I say 50,000 will be nothing but my prepaid expenses? And similarly, there is also something which is called as outstanding expenses. So for outstanding expenses, what will I do? Same process I will apply. Suppose my selling and distribution is 1 lakh and this is outstanding for the period of 1 month. Then can I say 1 lakh is for 12 months? So for 1 month, this should be how much? So I will take what? 1 divided by 12. And how much is that? 8,333. Can I say this is my outstanding selling and distribution expenses? Come on, yes or no? Yes, sir. Suppose they tell you that creditors are there for the period of 3 months. Now creditors are always for dash. If you just check the income statement, the creditors are always for what? They're always for your raw materials. So whatever is your raw material consumed for full year, we need to check. Suppose raw material consumed is 6 lakhs. So 6 lakh is for full year. Creditors is 3 months. So this should be how much? So to understand how you should estimate your working capital, you should know how you should estimate your current assets and current liabilities. But there is one very simple rule which you have to remember in your estimation of working capital, that should you consider depreciation as the part of the operating cost, yes or no, then the answer is no. Why? Because see, depreciation, do you pay depreciation to someone? Do you pay depreciation to someone? Do you pay depreciation to someone? No. So when we don't pay depreciation to someone, it means that your money is never blocked in depreciation. And guys, when the money is never blocked in depreciation, we don't consider that as the part of the cost. So should depreciation be considered as the part of the breakup of cost, or it should not be considered? It should not be considered. Have you understood this part? Okay. So to estimate working capital, 2 things are very important. What are the 2 things? Time period, level of activity. And to estimate the working capital, we need what? Current assets, current liabilities. From current assets, if I subtract current liabilities, will I get working capital solo? Yes, sir. And stock of raw material, WIP, finished goods, debtors, prepaid, cash will always be given to you. Creditors, outstanding expenses, all these items we have to value. But for that, we should always prepare this breakup of cost. What should we prepare, beta? Breakup of cost. So I have explained you approach of income statement for every chapter. In ratio analysis, how do you start with the income statement? We start with what? Sales less COGS, what do we get? GP less operating expenses, what do you get? EBIT, right? In leverages, we start with the income statement starting with what? Sales less variable cost, what do you get? Contribution less fixed cost, we get EBIT. In capital structure, we start from EBIT. In investment decision, we start with sales less variable cost, contribution, fixed cost, NPBIDT. Then we subtract interest, if any, NPBDT, we subtract depreciation, NPBT, subtract tax, NPAT, add depreciation, cash inflows. In estimation of working capital, we'll always start our question with breakup of cost. And breakup of cost, how are we going to start with? First, solo yaar, raw materials, add what? Direct wages, add what? Direct expenses, what do you get? Prime cost, add what? Factory overheads, what do you get? Factory cost, also known as works cost. If opening closing is same, this works cost is dash, COP, also COGS. And to that, what do we add? Admin. To that, what do we add? Selling. What do we get? Total cash cost. And then we understood how should we value your current assets and current liabilities based on the required items. Have you all understood this? So you all understood what is operating cycle duration. How to calculate operating cycle duration? We have to check what is the stock of raw material holding period. What is the stock of WIP conversion period? What is the stock of finished goods holding period? What is your debtors collection period? All this total, we subtract with creditors payment period. We come to know that what is going to be your operating cycle duration. As a CFO, what will you try to do? Have a higher operating cycle duration or lower operating cycle duration? Lower operating cycle duration. Purinjida. Okay. Have you understood this? So this is how the theory of working capital is. Now I want you all to come directly to the questions. Let's do this. Are you all ready? Okay. Let us start with your illustration 1. Now this illustration 1 is first only regarding your calculation of returns. So first let us read this. Okay. See, basically they are telling you that there are 3 types of policy: conservative, aggressive and moderate. We'll understand what is the meaning of this. Okay. Let us read this illustration one. A firm has the following data for the year ended 31st March 22. We have sales, we have EBIT, we have fixed assets. There are three possible current asset holdings: 5 lakh, 4 lakh and 3 lakhs. It is assumed that the fixed assets will remain constant and the profits do not vary with the current assets. Analyze which of the three alternatives, analyze the effect of the three alternative policies. Now see, who are conservative people? Conservative people are those who will have more investment in your current assets so that the risk is lower. A conservative management will always try to have lower amount of working capital or higher amount of working capital. Higher, because they want to reduce the amount of risk. So their investment in current assets will be lower or it will be higher. An aggressive management will always try to invest least amount in your current assets, and moderate is somewhere between the two. Please tell me, higher the risk, higher the return is something which you know. So in conservative, moderate and aggressive, which policy has higher risk? Aggressive. And which policy will have higher return? Aggressive will have a higher return. Okay, just check this out. Conservative, moderate and aggressive. Okay. Now in conservative, what's your sales? 20 lakhs, 20 lakhs, 20 lakhs. You have the amount of EBIT which is given to you. You also have current assets, we have fixed assets. Guys, current assets plus fixed assets, can I say I get total assets? Now if I want to calculate return on total assets, there is no other data given to you. Can I take EBIT and divide that by total assets? Come on, yes or no? Yes, sir. So please tell me, now what is going to be the return percentage? Conservative, what's my return percent? 20. Moderate, what's the return percent? 22.22. Aggressive, what's the return percent? Can you please tell me where the returns is higher? Come on, yaar. Aggressive, the return is maximum. As I told you, in aggressive, the amount of working capital is the least. But don't you think the return is highest? In conservative, don't you think amount of investment in current assets is highest? But what is the risk? What is the return? Lowest. So conservative is always what, beta? Can I say higher current assets, lower risk, lower returns? This is conservative for you. And what is aggressive? Lower current assets, higher risk, higher returns. This is aggressive for you. Solu yaar. Okay. And then current assets to fixed assets. You all can check. Conservative has the highest current assets. They have the lowest current assets to the fixed assets. Okay. Now let's talk about estimation of working capital. So I wanted to come to illustration 2. See what is given to you. From the following information of XYZ, you are required to calculate what is the net operating cycle period and what are the number of operating cycles. And here we have raw material inventory consumed during the year, which is 60,000. Average is 50,000. Here we have COP, which is 5 lakhs. Average is 30. COGS, which is 8 lakhs. Average is 40. And then debtors collection period, creditors payment number of days in a year is 360. How do you calculate operating cycle duration? As I explained to you, to calculate your operating cycle duration, what do you need? What is your stock of raw material holding period? Then we need what is the stock of WIP conversion period. What is the time period block? That is something which you have to check. Then we have to check what is the stock of finished goods holding period. We need to check what's your debtors collection period. The total of this will give you your gross duration. And from this gross duration, we have to subtract creditors payment period to get something which is called as your net duration. Okay. Can you please tell me what's your stock of raw material holding period? Have they given to you or you have to find out that? We have to find out that. They have just give you debtors collection period. What's your debtors collection period? 45 days. What is your creditors payment period? 30 days. Solo yaar. Now, how will you calculate stock of raw material holding period? Please check and tell me, do you have raw materials consumed during the year? How much is it? 6 lakhs. Please tell me, in a year, raw material consumed is 6 lakhs. Can you please tell me how much is the stock which is being kept? 50,000. So can I say actually 6 lakhs is the entire year's raw materials consumed? What is the stock amount? 50,000. So on this particular basis, can I get the time period? But here we don't have 12 months. How much days in a year? 360 days. So for 360 days, how much days? Can you give me the answer? 6 lakh is for 360. So for 50,000 it is how much? Can you give me the answer? This is 30 days. So what is your stock of raw material holding period? 30 days. Okay, now give me for cost of production for the year is 5 lakhs and your stock of work in progress is for how much? 30,000. Can you please tell me what will be a WIP? Can I say here they have told you it is nothing but what? 5 lakhs. 5 lakh is for how many number of days? Can you please tell me? 360 days. So now what is the amount here? 30,000. For 30,000 it should be how much? 21.6. Come on here. Just calculate and tell me. Is it 21.6? 21.6 days. Because 5 lakhs is the COP. So for WIP we are going to take into consideration what's the cost of production. So cost of production 5 lakh is for 360 days. So for 30,000 it should be how much? How much is it coming? 21.6. You are getting this? No. Okay. 21.6. So can I say this will be nothing but 21.6? Come on, yaar. So 21.6 is nothing but 22 days. So I will take 22 days. Acha, regarding finished goods, now you all tell me. What is the finished goods for the entire year? 8 lakhs. And 8 lakhs, what's the average? 40,000. So can you please tell me 8 lakhs is for how many number of days? 360. So for 40,000, how many days will you require? 80. 18. So can I say this is going to be 18 days? Right? So have we got this everything? Okay. What's the total gross duration? One. From that you subtract 30. What is this? 85. So 85 days is your net operating duration. Now in a year, how many? They have also asked you to calculate what should be your number of operating cycles. So guys, 360 divide by 85, how many times you will be able to rotate this money? 4.24 times or 2-3 times, whatever. Don't round off this. Okay, we will write down up to 2 decimals. So this should be 4.24 or 2-3 times. Just check. 85 days and 4.23 times. Superb. Everyone understood what is this duration? Okay. Now we have to estimate CA and CL to get the working capital. So I want you all to now please come to your illustration 3. Okay. Let's do this. See what is given to you. On 1st of January, the managing director of Norin wishes to know the amount of working capital that will be required during the year, in which the following information is being given to you. Production for the previous year is what? 60,000. It is planned that this level of activity will already be maintained during the year. So what's the level of activity right now? 60,000 only. The expected ratios of cost to selling price is given to you. So raw materials is 60% of your selling price. Direct wages is 10% of the selling price. And overheads, if no data is given to you, this is always your factory overheads, which is 20%. Raw materials are expected to remain in store for an average of 2 months. Everyone in one voice, what is this, CA or CL? Come on, raw materials remain in godown for the period of 2 months. CA or CL? This is CA. So your time period is given to you. We have to find out the stock. In the previous question, stock was given to you and we had to prepare the time period. Next, each unit is expected to be in process for 1 month. This is stock of work in progress. That is also your CACL, CA. And raw materials are being fed into the pipeline immediately and labor and overheads accrue evenly throughout the year. Please tell me, is the degree of completion in terms of percentage directly given to you? No. So if it is not given to you, what is going to be your assumption? 100% raw materials. What about labor and overheads? 50-50%. Finished goods which are waiting for dispatch is approximately for the period of 3 months. This is also your current asset because this is stock of finished goods. Credit allowed by creditors. Tell me what is this? Credit allowed by creditors. CACL, CL. Credit allowed to debtors. CACL, CA. Selling price per unit is also given to you. What is the selling price per unit which is being specified, beta? We have the selling price per unit, which is nothing but 5 rupees. There is a regular production and sales. Wages and overheads are paid for on the first of each month for the previous month. So please tell me, are we paying wages and overheads in the next month? Come on, yes or no? Yes, sir. So this is your current asset or current liability? Current liability. Because April month's wages, when are you paying? We are paying on 1st of May. So don't you think on 30th of April, that is nothing but your outstanding, 1 month outstanding. And then the company keeps normally cash. What is this? CACL? CA. Now we are required to find out this estimation of working capital. So this question, see, how should we approach it? Okay. Always remember, my dear students, the first step is always to prepare what? Breakup of cost. Now breakup of cost, everyone please tell me what's the format? Raw materials, direct wages. Do you have any direct expenses in this question? No, there is only factory overheads. Can I say the total will be called as what? Factory cost, works cost, cost of production. Because here, is it an existing company? Come on, yes or no? Yes, sir. And opening data is not given to you. So what will we assume? Opening is same as your closing. So can I say if opening closing is same, works cost is nothing but COP. Come on here. And this COP is also called as your COGS. Because this is a newly formed company or this is existing company? Existing company. Have they given you opening stock data available? So what is your assumption? Opening is same as your closing. Do you remember in ratios I taught you? If opening and closing both are same, factory cost, work cost will be equal to your COP. And COP will be equal to your COGS. Because factory cost, works cost, we add opening WIP. We subtract closing WIP to get COP. To this we add opening finished goods. We subtract closing finished goods, we get COGS. But if this both are same, can I say this is equal to this? Right? To this, what do we add? Admin. To this, what do we add? Selling. What do we get? Total cash cost. Can I say total cash cost will be helpful to calculate the amount of your debtors? But in this question, there is no admin, no selling. So can I, no selling and distribution cost. So can I say this itself is your total cash cost? Okay. Please tell me, raw material consumed is some percentage of selling price. How much is my selling price per unit? Solu, come on, yaar. 5 rupees per unit. Selling price is 5 and raw materials is what? 60% to selling price. So can I say my raw material is nothing but 60% to 5, that is 3 rupees per unit. I need to multiply this by level of activity. What is my level of activity, guys? My level of activity is 60,000. So this 3 into 60,000. Can you please tell me what is this raw material consumed? 1,80,000. Superb. What about your direct wages? Can I say that is 5 rupees per unit and this is 10%. So how much is this going to be? 0.5, which will multiply that by 60,000. So can I say this will be 30,000. Factory overheads. Can you please tell me how much is it? Factory overheads. Can I say your factory overhead is 20%. So this has to be 20% of 5. What is 20% of 5? 1 rupee, which I need to multiply by 60,000. So can I say this will be 60,000? So 80 plus 30, 2 lakh 10. 2 lakh 10, right? Plus 60. That is going to be what? 2 lakh 70. Solo yaar. So your this is also going to be 2 lakh 70. Are you all okay with the breakup? Okay. Now, what's the next thing? The next thing is now we have to estimate the working capital. So always remember, if you have to estimate the working capital, we have to first write down CA. We have to write down your CL. And here we have to write down the time period. I will do the working year so that I can get the final amount here. Okay. Can you give me what are the list of CAs we have identified? What are the list of CAs? Can I say there is stock of raw material, there is stock of work in progress, there is stock of finished goods, there is going to be debtors. Is there any cash? Yes. Current liability, there is going to be what? Creditors. There is outstanding wages. There is outstanding overheads. Do I have time period for every CA and every CL? Come on, yes or no? Yes, sir. Can you please tell me stock of raw material is going to be there in the go down for how much period of time? 2 months. What about WIP? It's going to be in process for how much period of time? 1 month. Solo yaar. Finished goods, it's going to be in go down for how much period of time? 3 months. Debtors, their time period is what? 3 months. Cash, is it given to you? What is the cash which is given to you? The cash which is given to you, that is nothing but how much amount? 20,000. Solo yaar. And then we have creditors. What is the time period for creditors? Come on, creditors. How much is that? 2 months. Outstanding wages and overheads is 1 month. Okay. How will you calculate now this? Stock of raw materials. Can you just check what is the raw material consumed? 1,80,000. But this 1,80,000, I want every one of you to please tell me, if 1,80,000 is for full 1 year, we have to calculate for the period of 2 months into 2 divide by 12. Can I say this is 30,000? Superb. Now when it comes to your work in progress, can I say it is 100% of raw materials? Labor and overheads is what? 50-50%. So 1,80,000 into 100% is 1,80,000. Solo yaar. And labor and overheads is what? 30 and 60. But this 30,000 and 60,000 should be multiplied with what? 50-50%. So now this will be what? 15,000 and this will be what? 30,000. What's the total, guys? 2 lakh. 180 and 30 is 210. 2,25,000. But this is per annum. My work in progress is there for the period of how much period of time? How much? 1 month. So can I say it will be 2,25,000 into 1 divided by 12? Can you give me what is this? 18,750. Then after that, what is the next thing? Stock of finished goods. Finished goods, can I say I will value this at my COP, which is 2,70,000. So can I say I will take 2,70,000 into what? 3 divided by 12. Give me 2,70,000 into 3 divided by 12. 67,500. Debtors, will I value this at total cash cost, which is 2,70,000. And all the sales are on credit basis. If they would have given 80% is on credit, then 2,70,000 into 80%, I would have done it. But all are on credit into 3 divided by 12. Give me this. 67,500. This is the total of current assets. Current liabilities. Creditors. Creditors are always for your what? Raw materials. Can I say this will be 1,80,000 into 2 divided by 12? Can you give me what is this? 30,000. And wages and overheads, which is 30 and 60. Can I say this is 30,000 into 1 divided by 12? Come on, yes or no? Yes, sir. 60,000 into 1 divided by 12, yes or no? Yes, sir. How much is this? 30,000 divided by 12. How much? 2,500. And this is 5,000. Can you please add the CA and tell me? 30,000 plus 18,750 plus 67,500 plus 67,500 plus 20,000. Huh? 2,03,750. Give me CL total. 37,500. What is working capital? A minus B. This is the working capital. 1,66,250. 1,66,250. Have you realized? Understood how should we solve it, beta? Sure, confident? Okay. Now, they have told you that only. Illustration 4. Now see what is given to you. That sales at 2 months credit is given to you. Everyone in one voice. If they have told you sales and it is at 2 months credit, can I say in this particular case, we already have a debtor in our question? Come on, yes or no? Yes, sir. So can I say this will be debtors is equal to current asset. Materials consumed. Supplier extends 2 months credit. Can you please tell me what is this? Creditors is equal to your current liabilities. Come on, yaar. And then after that, just check wages paid 1 month lag. What is this? Can I say creditors is equal to outstanding wages? Outstanding wages is equal to your current liabilities. Cash manufacturing expenses. Expenses are paid 1 month in arrear. Can I say this is also nothing but outstanding is equal to current liability? Administrative expenses 1 month lag. Can I say this is also nothing but outstanding, which is current liability. Sales promotion paid quarterly in advance. Can I say this is prepaid, which is your current assets? The company sells its products on gross profit of 25%. Depreciation is considered as the part of cost of production. Oh no. Guys, under cash cost method, should we consider depreciation or should we ignore it? Ignore it. Then they have told you it keeps 1 month stock of raw materials, CACL, CA. 1 month stock of finished goods, CACL, CA. Cash is what? 1 lakh, CA. Assuming 20% safety margin. Now what is this safety margin? Just check in the previous amount, what was the working capital? 166,250. If I add safety margin to it, then can I say my gross amount of working capital will be 1,66,250 plus some percentage? Come on, yes or no? Yes, sir. So that will give you your final amount. Okay. Then after that, compute your working capital based on what basis, beta? Cash cost. Ignore work in progress. Always remember, what's the first step? This is illustration 4. What's the first step? We always have to do dash. Breakup of cost. So in breakup of cost, you will start with what? Raw material consumed. Can you give me raw material consumed from the question? How much is it? Come on, yaar. 9 lakhs. And they have told you per annum basis. So there is no level of activity given to you. They have already calculated that and given to you on per annum basis. Second, after raw material consumed, what's the next item? Wages. Can I say there is direct wages amounting to how much? 7 lakh 20. Have they given you manufacturing expenses? Solo, yes or no? Yes, sir. How much is that? 9 lakh 16. Okay. And this total will be called as what? Factory cost, works cost. Also, can I say this is an existing company? There is no newly formed word given to you. So this is an existing company. So opening, closing, both will be the same. So can I say this will be your COP, also known as your COGS. Opening, closing is same. How much is this? Can you please add it for me? Huh? 9 lakh plus 7 lakh 20 plus 9 lakh 60. 25 lakh 80,000. To this now I have to add what? Administrative overheads, and to this I have to add what? Selling and distribution. Can I say I'll be getting something which is called as your what? Total cash cost. Solo yaar. Now give me admin and give me selling. What is your administrative expenses? Can you please tell me what's your administrative expenses? 2 lakh 40. What's your selling and distribution expenses? 1 lakh 20. Can you please give me my total cash cost? 29 lakh 40,000. Now we have to estimate CA and CL. Now what is the format? We'll write down here, then they'll be write down your period, working amount. Now please tell me what are the list of CAs which you have identified. Starting with first part. Can I say there is debtors? Solo yaar. Debtors, what's the time period? 2 months. Then after debtors, go further. You will have prepaid expenses. Prepaid sales promotion expenses. Come on yaar. How much is the time period? They have told you quarterly in advance. So 1 year is how many quarters? 4 quarters. So 1 quarter is nothing but how much number of months? 3 months. So this is your prepaid sales promotion, 3 months. Then what is your next current asset? Stock of raw materials. Can you please tell me stock of raw materials? What's the time period? Solo yaar. Stock of raw material is 1 month. What is your stock of finished goods? What's the time period? Again 1 month. Come on, yes or no? Yes, sir. Can you please tell me next item will be what? It will be nothing but your cash. Can you give me cash? Have they specified in the question? Cash. Is it given to you? Come on, yes or no? Yes. How much is that? 1 lakh. Come on, yaar. And after that, what are the list of current liabilities? Do we have creditors? What's the time period for creditors? Can you tell me what's the time period for creditors? 2 months. After that, what's the next item? After creditors, current liability, there is outstanding wages. Can you give me the time period for outstanding wages? 1 month. Then after that, can I say manufacturing expenses are also outstanding and administrative are also outstanding? Outstanding manufacturing, 1 month. Outstanding admin, this is manufacturing expense, this is admin, 1 month. Can I say now this will be your CA, this will be your CL. You will be getting working capital which is A minus B. But to this I have to add what? Safety. I'll be getting total working capital. Are you guys understanding this? Okay. One by one, now tell me. At what price will I value my debtors? This is the breakup in front of you. Come on, fast now. You have to answer fast, yaar. At what price should I value my debtors? 29 lakh 40. Come on, yes or no? At 29.40. So I will take 29.40 and multiply that with what? 2 divided by 12. Have they given to you any percentages on credit or something like that? Have they mentioned? No. All sales are on credit. So how much is this? 4 lakh 90. Prepaid sales promotion expenses. Can I say I have to take sales promotion expenses? Come on, yes or no? Yes. How much is that? 1 lakh 20. So I will have to take 1 lakh 20 into 3 divided by 12. Give me the answer. 30,000. Stock of raw materials. Do you have raw materials? Come on, yes or no? Yes, sir. 9 lakh into 1 divided by 12. Give me this. 75,000. Stock of finished goods. Can you please tell me what is stock of finished goods? Can I say there is total cash, we will value it at 2580 or 2940? 2580. So 2580 into 1 divided by 12. 2 lakh 15. 15. Now, huh? But I have, in this entire breakup of cost, I have not considered any depreciation here. So just check now. They have told you sales minus GP. Will that give you COGS? What's your sales in the question? 36 lakhs. What's your GP? 25%. So can you please give me COGS? COGS is 27 lakhs. Now what is my COGS here? 25 lakh 80. Are you understanding there's a difference in my COGS? Amounting to how much? 1 lakh 20. And this is nothing but what your what? Depreciation. Which we ignore it. This is not to be done in the exam, but just showing you that we have to ignore this depreciation. Got it? So that's why we will only be taking this part. Okay? 2580. Now give me the total of this. 9 lakh 10,000. Now let's talk about your creditors. How will you value your creditors at? Look at the question and tell me. At what price will I value the creditors? Solo. Raw materials. What's your now raw materials? 9 lakhs. So what will I take? 9 lakh into 2 divided by 12. Give me this. 1 lakh 50. Outstanding wages. Can you please tell me outstanding wages? It's 7 lakh 20. 7 lakh 20 into 1 divided by 12. Give me the answer. 60,000. Outstanding manufacturing expenses. Can you please tell me how much is that? 9 lakh 60. Can you please tell me 9 lakh 60 into 1 divided by 12? Solo. 80,000. Outstanding admin. How much is it? 2 lakh 40. 2 lakh 40 into 1 divided by 12. Solo. 20,000. Give me this total. 1 lakh 50 plus 60 plus 80 plus 20. Huh? 3 lakh 10. Can you please tell me what's your working capital? 6 lakhs. Add 20%. 7 lakh 20. Just check. 7 lakh 20. Superb. Understood how should we approach this? Okay. Now this question of single shift, double shift. Okay. This is the last illustration. Can you give me 10 minutes so that I can complete this illustration, and after that this chapter only will be over then? Or are you hungry? Is it okay? Saptingla? Are? Saptingla? No. Okay. Illa? Very good. So no Saptingla now. Okay. Govni. Govni means? Listen. Listen. Govni. Illustration 5. Okay. I'm learning little bit of Tamil. Okay. But if I learn more, I'll forget FM. So that is why I'm learning in bits and pieces. Okay. Words are very difficult in Tamil. I feel that. Purinjita. Sikrama. Gauni. That is why. Little bit. Telugu also and Arthamainda. Do you know Telugu? Anyone knows Telugu here? You know Telugu. Okay. You also know Telugu. Shri. Aipoinda. Aipoinda. IPO in the means have you finished or not, right? So my students teach me whenever I go across the country somewhere or the other, they tell me, sir, these are the wordings. But it's okay. You want to learn Gujarati? After May 26. You also teach me Nepali. You know how, but you first know what is Nepali. You know Nepali? Nepali is a language, na? You teach me Nepali. Okay. What is it called? Have you what is that called? Huh? Huh? Khano. Khano. Khana khanu. Huh? Bhayo. Khana khanu bhayo. Okay. So, khana khanu bhayo. Okay. You all try once. Khana khanu bhayo. खाना खायू भयो खाना खानू खा अरे यार दिस इज लाइक अ टंग ट्विस्टर खाना खायू भयो खाना खानू भयो ओके फाइन चलो let us now start with your illustration 5. Let's do this. Okay. Submarine Enterprise has been operating its manufacturing facilities on 31st of March 2022 on a single shift basis. So we have cost of materials, that is nothing but your raw material consumed. We have wages 5. Can I say out of that 40% is fixed? And can I say 60% is variable? Solo yaar. So if 50% is fixed, can you please tell me 5 into 40%? Can I say 2 is your fixed cost? Variable cost is what? 3. Out of that overheads. Overheads, can I say it's nothing but your factory overheads? Can I say factory overheads also has 80% fixed, so that is 4 rupee. And how much is your variable? That is nothing but 2 rupees. Come on, yes or no? Yes, sir. So this is the fixed cost and this is 1 rupee is your variable cost. Profit selling price. Sales is 4,32,000. Can you please tell me what's your selling price per unit? 18. If selling price per unit is 18 from 4,32,000, if I divide that by 18, can you please give me quantity sold? 24,000. Now, my dear students, as on 31st March 22, we have stock of raw materials at cost, which is 36,000. Can I say this is your current assets? Solo, work in progress, this is valued at prime cost. This is also your current assets. Finished goods, can I say this is also your current assets? Debtors, this is also your current assets. But debtors in the balance sheet is always valued at what? Sales. But we don't have to value the debtors at sales. We should value the debtors at cost. In view of an increased demand, it is proposed to double the production by working an extra shift. So now, instead of 12 hours in a day, you are working for what? 24 hours in a day. So now, if you increase your shift, can I say the need for working capital will also increase? Come on, yes or no? Yes, sir. It is expected that 10% discount will be available from suppliers of raw materials in view of increased volume. Selling price will remain the same and the credit period allowed to customer will also remain same. They have not given you the credit period, but they are telling you it's going to remain the same. Credit availed from supplier will continue to be at a present level, which is nothing but 2 months. And lag in payment of wages. So this is your current liability. Debtors is your current asset. And lag in payment of wages and expenses will be half a month. That is 0.5. We are required to prepare the additional working capital requirements. Okay. Now for this, now I'll just show you the solution so it becomes easier for you. Okay. To understand this in my particular way. Okay. So now, 1 second. I just have to find this part for my estimation of working capital. Let's do one thing. We will take a break only. In the break, I will find it out. And then I'll refer to the solution and then I'll explain that to you. So that will become much more faster. Okay. So take a break. Okay. Chalo. Now I'll see you at what time? Now, the last illustration which we were doing, see, illustration 5. Okay. Now in this particular question, as you all can see, always the first step is dash to prepare what? Breakup of cost. Now to prepare the breakup of cost, as you all know that we will be starting with what? We'll be starting with your raw materials consumed. Okay. So raw material consumed, as you all can see, how much rupees per unit they have told you on your single shift basis. If you just check, it is nothing but what? 6 rupees per unit. Okay. So if I take 6 rupees per unit, and how many number of units am I manufacturing on a single shift basis? So I'm manufacturing 24,000 units. So in this particular case, 6 into 24,000, can I say my total raw material consumed will be what? 1,44,000, right? And also at the same time, we have direct wages in which there is 60% fixed cost and then 40% is fixed cost and 60% is variable cost. Can you please tell me variable cost is how much rupees per unit which we have just now identified? 3 rupees per unit. So this 3 rupees per unit, if I multiply that by the level of activity which is 24,000, so can I say 3 into 24,000 will now give you what, beta? 72,000. That's nothing but the variable cost. Okay. Fixed cost, it is 2 rupees per unit. But if I multiply by 24,000, it will be nothing but what? 48,000 rupees. Same happens with your factory overheads. There is variable cost, which is 80% is your fixed. So 4 rupees is your fixed cost. So 4 rupees, you multiply that by 24,000, you will be getting 96,000. And 1 rupee is your variable cost. So that will be nothing but your 24,000. Now in this particular case, if you guys can just check, your factory cost, work cost, COP, COGS, total cash cost, everything is going to be the same. Why is it going to be the same, guys? Because can I say that there is no opening data given to you, so opening is closing is same. So that will be your 3,84,000. Okay, so this is something which we are going to do pertaining to your single shift basis. But when I talk about the double shift basis, can I say in double shift basis now, is the supplier offering you some 10% discount, which is given to you in the question? Come on, yes or no? Yes, sir. So instead of paying 6 rupees, now how much do you have to pay, beta? 6 minus 10%, that is nothing but what? 5.4. So you will pay 5.4 and multiply that by how much number of units which you have? 48,000 units. So this will eventually give you what? 2,59,200. Similarly, your variable cost is 3 rupees per unit. If you multiply it by 44, you'll multiply by 48,000 units. So this will be nothing but what? 1,44,000. And then also at the same time, your fixed cost is 1 rupee per unit. If you multiply that by 48,000, then can I say this is going to be what? 48,000 rupees. So if you take the total of this, this will be 9.4. This will be 4,51,200. And here we are having 1 rupee as your variable cost. Now just understand one thing, that fixed cost, can I say it remains the same even when we increase the level of activity? Come on, yes or no? Yes, sir. So you have to be very careful here. Your fixed cost, it was 48,000. Can I say here also it will be 48,000 only? Because fixed cost is not going to change with the change in the output. So now if I take 48,000 as my fixed cost, my number of units is also 48,000. Then can I say my per unit is going to be what? 1 rupee. Come on, yes or no? Yes. So that is how this will be 9.4. Variable cost is going to remain the 1 rupee per unit multiplied by 48,000. That will be 48,000. And your fixed cost is going to continue to remain what? 96,000. If I divide that by 48,000 units, it will be 2 rupees. That's how this 12.4 will now become 5,95,200. So now based on this, we have to estimate the working capital on cash cost basis. Now in this question, now beta, we have to prepare the working capital on single shift as well as on double shift basis. So that is why on single shift basis, first we'll write on the list of the items: stock of raw material, WIP, finished goods, debtors, creditors, outstanding expense and outstanding wages. Now when I talk about your raw material, please check and tell me, have they given to you in the question that raw materials are going to be in stock of raw materials which is available, which is nothing but 36,000 rupees? Come on, yes or no? Yes. So this 36,000 rupees will continue to be the same. WIP is 22,000. Stock of finished goods is 72,000, which you can take it from here. because all this is on single shift basis. But when it is on double shift basis, you have to understand that for double shift basis, for your single shift basis, when it comes to your debtors, it is not going to be 1,08,000, because 1,08,000 is valued at dash sales. We want to value the debtors at sales, or we should value the debtors at total cash cost. At total cash cost. So 1,08,000 is actually at sales. So we cannot take that into consideration. So first what we will do, we will find out what is going to be the time period for which the money is getting blocked in your debtors. So just check what's the amount of the sales, guys. The amount of the sales is given to you as what? 4,32,000. And the amount of the debtors which is valued at sales is what? 1,08,000. So please tell me that 4,32,000 is the sales for the entire year, and 1,08,000 is nothing but the amount of debtors. Can I say this data will give me nothing but the amount of debtors? Come on, yes or no? Yes, sir. So what is going to be the amount of the debtors? Just check and tell me. 4,32,000 is for 12 months. So for 1,08,000, it should be how much? What is going to be the time period? 3 months. Now, once I get this 3 months, can I say I can substitute my debtors, which is going to be nothing but 3 months. And this debtors should now be valued at total cash cost. So do I have the total cash cost in the question? Come on, yes or no? Yes, sir. Which is nothing but 3,84,000. So I will take 3,84,000 into 3 divided by 12, that is 96,000. So it's the same process only which we are doing for your single shift basis. Also your creditors, they have given to you the time period which is nothing but 2 months. You will take creditors always for your raw materials. So what's the amount of the raw materials which you have? 1,44,000. So then you will take 1,44,000 into 3 divided by 12. You will be getting this as your 20 into 2 divided by 12. You will be getting your creditors and your outstanding expenses and your outstanding wages. That is also given to you as 0.5 months. So for single shift and double shift, the process is the same. The only thing here which we have to understand is your work in progress. Now please tell me your work in progress. They have told you it is valued at dash. It is valued at your prime cost. When we are operating on your double shift basis now, then remember that work in progress in units is always going to be the same. Your work in progress in units is always going to be what? It is always going to be the same. Now why is that so? See, because remember that whenever we are talking about WIP partner, work in progress partner, then remember one very simple concept, that if you are working on double shift basis, it means that WIP in units will not be doubled. Your double shift basis will always keep your work in progress in units to be the same. How? Now let me explain this to you. Now listen to this very carefully. See, let's say for example, you were first on single shift basis manufacturing 24,000 units. How many units were you manufacturing, beta? 24,000 units. Okay. Please, can you give me what is the value of the WIP given to you in the question? Just check and tell me. What is the value of WIP which is given to you in the question? 22,000. So that is your value of WIP which is given to you. That is nothing but 22,000. But this is valued at prime cost. So if I divide that by prime cost, what is the prime cost per unit? Your prime cost per unit is nothing but how much rupees per unit? Just check and tell me. Can you just check what is the prime cost per unit? 11. So if I take this 22,000, if I divide that by 11, what are the number of units of WIP? Can I say it is 2,000 units? Now in double shift basis, when you are manufacturing 48,000 units now, in this also your number of units will continue to be 2,000 units only. It will not be increased. Why? Because the first thing you have to understand here is that under double shift basis, what is happening is that whatever is your single shifts WIP na, that gets converted into a finished product in your double shift. So ultimately towards the end of the year, there will only be one shift's WIP which is going to be there. And what is a single shift's WIP which is going to be there? It is 2,000 units. Acha, there are two ways actually to double the production. How many ways are there to double the production? Two ways. The first way is, you know what? That you double the production by purchasing an extra machine. So there is machine A, there is machine B. Machine A was manufacturing 24,000 units. Machine B was also manufacturing 24,000 units. So machine A, if it has 2,000 units, so machine B also has 2,000 units. So can I say total WIP is going to be what? 4,000 units. But now you are not doubling the production by purchasing an extra machine, but by working on the same machine, double shift. So in that particular case, what do you think your WIP in units will be? Will that be doubled or that is going to remain the same? It is going to remain the same. So that's why we will take only 2000 units. And what is the prime cost which is given to you? Your prime cost is nothing but what? 9.4. So now we will take 9.4. So ultimately, if you take 2000 and multiply that by 9.4, can I say 18,800? That will be treated as your WIP, which you can check also in the solution. That is 18,800. Okay. So rest everything will be doubled. Your stock of finished goods will be doubled. Your raw materials will be doubled. Your debtors can also be increased. But when it comes to WIP under your double shift basis, will your units be doubled or your units are going to remain the same? It's always going to remain the same, and that is the crux of this particular question. Okay. So this is the solution for your, ultimately what is going to be your working capital on your double shift basis. Now, my dear students, are we done with all the illustrations which were given to you in your working capital? Okay. Now let us continue this further. And now we will be starting with something which is called as your receivables management. Okay, so we are starting with what, beta? We are now starting with your receivables management. Okay, so I want your now full attention to the receivables management which we are going to do. Okay, receivables management. Fine, are you all ready? Okay. Okay, chalo. Now we are going to start with this new section, new unit, which is nothing but management of receivables. Okay, now see. How do you manage your debtors? Okay, see. A sales manager of a company will always want to increase the sales. And how will we want to increase the sales? He will always want to increase the sales by increasing the credit period. A sales manager will always want to increase the sales by what? Increasing the credit period. So let's say, for example, first you have given a credit period of 1 month. Okay. So you are selling 1 lakh units. But now when you offer a credit period of 2 months, will your quantity sold be 1 lakh units only? Will it be less than 1 lakh units or it will be more than 1 lakh units? Of course, it's going to be more than 1 lakh units. Why? Because now you're offering more credit to your customers. So your sales will reduce or your sales will increase? Reduce or increase? So a sales manager always wants to increase the sales. So he will always tell the company CFO, let us increase the credit period. But when the credit period will increase now, with that, there is also going to be some type of cost which will be increased. Please tell me what's the first type of the cost which will increase if you increase the credit period. Once you increase the credit period, the first type of the cost, sales will increase. But with that increase in sales, the first cost which will increase, that is nothing but your bad debts. Don't you think because higher credit period means what? Higher credit sales, there is more possibility of bad debts. Come on, yes or no? Yes, sir. Also at the same time, there is going to be more increase in the collection charges or cost of administrating that debtors. See, first I have a staff of 5 people who's managing 10 debtors. But now if I increase the credit period, don't you think that 10 debtors will now become 20 debtors? So in that particular case, I will need more people to manage those debtors. Come on, yes or no? Yes, sir. So collection charges can also increase. And the third type of cost which can increase is called as cost of investment in debtors, which is also called as your opportunity cost. What is this cost increase beta called as? Cost of investment in debtors. See, understand a situation like this, that for example, I am giving 1 month credit to my customers. Okay. Now, suppose my sales less variable cost, what do you get? Contribution. Contribution less fixed cost, what do you get? Profits. Okay, example, I'm keeping this as profits. Suppose your sales is 12 lakhs. Your variable cost is, example, 6 lakhs. Can you please give me what's your contribution? 6 lakhs. Suppose my fixed cost is 3 lakhs. What's my amount of the profits, guys? My amount of the profits is nothing but 3 lakhs. But my first question to you is that what is the total cost per year? What's the total cost per year? Can I say my total cost per year is nothing but 9 lakh rupees? And what is the credit period which I'm offering to my customer? 1 month. So if 1 month is the credit period offered in my customers, so in that particular case, what's the money which is blocked in my customer? Can I say that is 9 lakh into 1 divided by 12? So what is 9 lakh into 1 divided by 12, everyone? 75,000. So what is 75,000? That is nothing but my investment in debtors. Example, if I increase now my credit period to 2 months, what do you think? The sales is going to remain the same or the sales will increase? Suppose my sales has now become 18 lakhs. Variable cost is now 9 lakhs. Can I say your contribution will be what? 9 lakhs. What is your fixed cost, guys? 3 lakhs. So can I say my profits will now become what? 6 lakhs. But what do you think now my total cost is going to be? 9 plus 3, how much? 12 lakhs. And what is the time period which I'm offering to my customer? 2 months. So now can you please tell me what is the amount of investment in debtors? 2 lakhs. So my simple question to you is, if I increase the credit period, then my investment in debtors is going to remain the same or investment in debtors will increase? Investment in debtors will increase. So my one very first simple question to you is that if my investment in debtors will increase, do you think that the money will come free of cost or the money is going to cost you something? It's going to cost you something. It's never going to be free of cost. So it is definitely going to cost you something. Because now first my money which was getting blocked in debtors, that was 75,000. Now the money which is getting blocked in my debtors is 2 lakhs. So I have to arrange from the bank 2 lakh rupees. So don't you think that the cost will also enhance? Come on, yes or no? Yes, sir. Can you please tell me now if my cost of investment in debtors is 10%? What's my cost of investment in debtors? 10%. Then don't you think that your 7,500 will be CID and your 20,000 will be your CID, cost of investment in debtors? So my one very simple question to you is, if I increase the credit period, don't you think that bad debts will increase? Don't you think my collection charges will increase? And with that, don't you think my cost of investment in debtors is also going to increase? Come on, yes or no? Yes, sir. So my dear students, when we prepare the income statement now in receivables management, we have to just check what is the sales less variable cost. What will you get? Contribution. From contribution, what do you subtract? Fixed cost. What do you get? Profits. And from profits, what do you subtract? These 3 types of additional cost. What are the 3 types of additional cost which we are going to subtract? Tell me. First is your bad debts. Second is your collection charges. Third is your cost of investment in debtors. Ultimately, I'll be getting something which is called as net benefit. So now in receivables management, whether we should offer higher credit period or not completely depends on what is going to be the net benefit. Suppose there is an existing policy of the company in which we are offering a credit period of 1 month. But a sales manager comes to you with different type of proposals, P1, P2, P3, where he wants to increase the credit period to 2 months, 3 months, 4 months. So definitely the sales will increase. Your variable cost will also increase. But will the fixed cost remain the same? Come on, yes or no? Yes, sir, because fixed cost, the name itself is fixed cost. Will it remain constant? Come on, yes or no? Yes, sir. And then we are going to subtract bad debts. We will subtract collection charges. And then we will subtract your cost of investment in debtors. And then ultimately what we will calculate, guys? Net benefit. Suppose the net benefit for existing is 1,50,000. Suppose this is 1,60,000. Suppose this is 1,40,000. And suppose this is 1,20,000. Please tell me which policy will you select? Can I say we will select proposed policy 1? Because the net benefit there is dash. Is it minimum or it is maximum, beta? Maximum. Are you guys trying to understand this part? So always remember this thing, that whenever we are understanding receivables management chapter, the first part of the chapter deals with evaluation of credit policies. Because company wants to always enhance the sales. So for that they will keep on increasing the credit period. But do you think you should select the highest credit period? No. Because as you can see that whenever a credit period increases, the sales increases, but with that different types of cost also increases, which is bad debts, collection charges, CID. We have to calculate all this, and then we have to calculate the net benefit and check which policy has the best net benefit, and we will take that into consideration. So bad debts now is always a percentage of your credit sales. So they will give you the sales is example 1 lakh, and they will give you bad debts is nothing but 1%. So what is 1 lakh's 1% beta? 1,000. So that will be your bad debts. So bad debts is always a percentage of sales. This collection charges now, it is staff salary, which will always be given to you in the question. If it's given, we will consider. If not given, we will ignore it. CID, for that, it is nothing but cost of investment in debtors. For that, we have to learn how do you value your debtors. In estimation of working capital, we understood that valuation of debtors is much better at sales or at cost, at total cash cost. So that's why we will first value the debtors at total cost, which is nothing but what? Variable cost plus fixed cost. Sometimes fixed cost will not be given to you, so you will value the debtors at what? Variable cost. But if variable cost and total cost both are not given to you, only then we will value the debtors at sales. But your first priority is what? Debtors the value at total cost. Second is what? Value the debtors at variable cost. And third is what? You can value the debtors at sales. Are you guys trying to understand this? Okay. Now, my dear students, in this chapter, we are going to learn that part only, that whether we should give the credit period to our customers or not. For that, I want you all to now please come to your question number 12. Illustration 12. In your study module after estimation of working capital, see this is which unit? This is your unit number 4. So what is your unit number 2 and unit number 3? Cash and inventory. So cash and inventory we'll do later after we complete this receivables management. Okay. So let us now first start with your second illustration. Are you guys ready? Okay. Now see what is given to you. A trader whose current sales in the region is what? 6 lakhs. On an average collection period is what? How many number of days? 30 days. And then wants to pursue more liberal policy to improve the sales. Now just check how many proposals do you have, beta? 4 proposals, in which your credit period can go from 30 days to increase in collection period is 10 days. So can I say in policy it is 40, then 30 it can increase to 20 days. So can I say this is 50, 30 it can increase by 30 days. So this is 60, 30 and 45 days. This will become 105 days. Sorry, 75 days. Okay. So these are your different credit policies. Now what is going to be increase in sales? This is what? 6 lakhs. So this will become what? 6 lakh 30. This can become 6 lakh 48. This can become 6 lakh 75. This can become 6 lakh 90. Percentage default anticipated. Can I say this is nothing but your bad debts, which is always a percentage of whatever is your sales. Selling price per unit is 3 and average cost per unit is 2.25. Average cost is nothing but total cost, which is 2.25. Out of that, variable cost they have told you is 2. So what is your fixed cost, beta? 0.25. Come on here. Variable cost and fixed cost. Now, the current bad debt loss is 1% and required rate or return on additional debtors is 20%. Assume 360 days. Which policy will you adopt? What should be your approach to the question, guys? How should you start? Can I say you should start with your income statement? Now, what is the income statement format in your receivables management? How do you start? Can I say sales less what? Variable cost. What do you get, guys? Contribution less what? Fixed cost. What do you get? Profits. From profits, you subtract three types of additional cost. What are the three types of additional cost? Bad debts, collection charges, CID. What will you get? Net benefit. Now, do you have an existing credit policy? Come on, yes or no? Yes. How many proposals the sales manager has given to you? 4 proposals. Now, in existing, how much credit are we offering? 30 days. In proposal A, how much are we offering? 40. B, 50. C, and last, 75. Do you have your sales available? How much is your sales? 6 lakhs. But don't you think it is going to increase? What is that? 6 lakh 30. Then 648. Then 675. Last 690. Okay. Now variable cost, they have told you that is nothing but 2 rupees. So what's my selling price per unit, guys? Just check. My selling price per unit is 3. Variable cost per unit is what? 2. Can you please tell me what's my sales, guys? 6 lakhs. And how much quantity are we selling now? If the selling price is 3 rupees per unit, my sales is 6 lakhs. How much quantity am I selling? 2 lakh units. Solo yaar. Now what is going to be your variable cost? 4 lakhs. So what is going to be my contribution? 2 lakhs. Right? Now what is the fixed cost per unit they have told you? The fixed cost per unit is nothing but what? 0.25. Now you will take 0.25 and multiply that with what, beta? 2 lakh units. What is your fixed cost? 50,000. And will this 50,000 remain the same everywhere? Come on here. This is not going to change. Now what is going to be your profit? 1 lakh 50,000. Can you please give me your existing bad debts percentage? 1%. So 1% of 6 lakhs will give you what? 6,000. There is no collection charges here. But now comes how do we calculate your debtors? CID. Please tell me debtors can be calculated in how many ways? 3 ways. Debtors can be calculated on total cost basis or variable cost or your sales. But here, do you have variable cost and fixed cost both? So you will prefer valuing the debtors at dash. At what? Total cost. So now in this particular case, this is 4 lakhs. This is 4, variable cost is what? 4 lakhs. And what's your fixed cost, guys? 50,000. So can you please tell me what's your total debtors? 4 lakh 50,000. But don't you think this 4 lakh 50,000 is on per annum basis? The debtors are getting blocked for how many number of days? 30 days. So this is 4 lakh 50 similar to the total cash cost which you used to have in estimation of working capital. So this is nothing but on your receivables management, this is 4 lakh 50,000. So can I say whatever is your total cost, you multiply that by credit period, divide that by 360. Have they told you to assume 360 days? Yes, sir. So what's your total cost? 4 lakh 50. What's the credit period which you are offering? 30. Divide by 360. How much is this coming as? Sorry? 37,500. Now this is your debtors at total cost. This is the money which is getting blocked in your debtors on cost basis, which is 37,500. Now any money which is blocked in your customer, is it free of cost or it will charge you something? So just check what is the additional which they have told you, return on investment 20%. So if you multiply that by 20%, can you please give me what is this? 37,500. 7,500. So can I say your CID will now become 7,500. Understood this? So can you now please give me what's your net benefit, guys? 1 lakh 50 minus 6 minus 7,500. 1 lakh 36,500. So this is going to be my first part, which is 1 lakh 36,500. Superb. Everyone understood this income statement? Okay. But now let me do it for one more policy, for your policy A. So now you only tell me, what is my sales? 6 lakh 30. What's my selling price per unit? Can you give me quantity? 2 lakh 30. 2 lakh 10,000. Now 2 lakh 10,000. What's my variable cost? 2 rupees. You didn't get it? How, madam? See, the sales is 6,30,000. Selling price is 3 rupees. So sales divided by selling price, that will give you quantity sold, na? 2,10,000. Hello? From that 2,10,000, you need to multiply it with what? 2 rupees. So how much is this going to be? 4,20,000. Can you give me contribution? 2,10,000. This is 1,60,000. How much bad debts have they told you? 1.5%. This is 1.5% always of dash. Sales. So do you have sales? Hello? What's your sales? 6,30,000. Multiply that by 1.5%. How much is this? 9,450. Now let us calculate CID. For that, what's your variable cost? 420. What's your fixed cost? 50. Can you give me the total? 470. But this 470 is on per annum basis. So you have to take 470 and multiply that by what's the credit period? 40. You will take 40 divided by 360. Give me debtors. 52,222. Multiply that by 20%. What is the CID? Because this is the money blocked, and any money blocked will bear some cost. So what is the cost? 440. So can I say this is 10,444? Can you give me the net benefit? 1,60,000 minus all these things. 1,40,106. Just check this out here. 1,40,000. Exactly your answer will match. Now which policy will you adopt, beta? We have to adopt the policy in which the net benefit should be maximum. Same process you have to apply for all the policies. So can I say your policy A has the maximum net benefit? So should we adopt that? Come on, yes or no? Yes. Did you understand this? Okay. Chalo. Next question. Illustration 13. Okay. XYZ corporation is considering relaxing its present policy and it's in the process to evaluate 2 proposed policies. Can I say we have one existing policy and how many proposed policies we have, beta? 2 proposed policy. Currently the firm has the annual sales of what? 50 lakhs and the account receivable turnover ratio is 4 times. Now please tell me, if the accounts turnover ratio is 4 times in a year, we know that what is going to be your debt collection period. What is going to be the debt collection period if it is 4 times? Can I say it's 3 months? So if it is 4 times, it means that, can I say my debt collection period in my present policy is 3 months? Acha, if policy option 1 it is 3 times, can you please tell me what's your debt collection period? 4 months. Because in a year, 3 times the debtors are giving you the payment. It means you must be offering how much credit period? 4 months. If this is 2.4 times, then what is your debt collection period? 5 months. Then they have told you that the current loss is 1,50,000 for bad debts and the firms require a return of 25% on the investment. So can I say this is nothing but your CID percentage? Come on, yes or no? Yes, sir. And the company's variable cost is 70% of the selling price. And given the following information, identify which is the better option. So there is present policy, there is option 1, option 2, we have sales, we have turnover ratio, we have bad debts losses, and everything is given to you. Okay. How should you approach the question? Everyone, please tell me, what's the format for your, this is what illustration 13. What's the format? Can I say we are evaluating credit policy? Come on, yaar. Evaluation of credit policies. Can you please tell me, we'll be having particulars existing P1, P2. Solo yaar. What's your debt collection period? I have already calculated a debt collection period. 3 months, 4 months, 5 months. Guys, please tell me what's the format of the income statement. From profit, what do I subtract? How many additional costs do I have? Bad debts, CC, CID. What do I get? Net benefit. Come on, yaar. What's the sales? 50, 60 lakh. And then the last one is what? 67 lakh 50. What is your variable cost? What is your variable cost? Your variable cost is what? 70%. Give me 70% of this. 35 lakhs. What's my contribution? 15 lakhs. Solo yaar, have they given to you any fixed cost in the question? No. So there is no fixed cost. So this will be 15 lakhs. What is your bad debts? Have they told you your current bad debts? 1,50,000. There is no collection charges. The time has come to calculate your CID. To calculate the CID, now we should prefer valuing debtors at total cost. But do you have total cost in the question? Is there any total cost? Is there any fixed cost given to you in the question? So you will value the debtors at dash. Variable cost. Okay? Now can you please tell me variable cost into credit period upon 12. So what's your variable cost, guys? 35 lakhs. What's your credit period, everyone? 3 months. And that is something which we divide by 12. Can you please tell me what is this answer? 35 lakh into 3 divided by 12. 8 lakh 75. What's your CID percentage, everyone? Can I say the CID percentage is 25%? Can you give me the final answer? 2,18,750. So this is 2,18,750. Can you please give me the net benefit? From 15 lakhs, you will subtract the 2 additional cost. 11 lakhs 250. Just check what's your net benefit. 11 lakh 31,250. And the same thing you also have to apply when we are doing 4 months. Now in this particular case, variable cost will become what? 60 lakh into 70%, 42 lakhs. So this will now be what? 18 lakhs, and then you have to proceed further. Will you be able to solve this? Same process you have to apply. Got it, everyone? Okay. And then we will select the policy in which the net benefit is maximum. Come to your question number 14, illustration 14. See what is given to you, guys, that a company is presently having a credit sales of 12 lakhs. The existing credit terms are 1/10 net 45. What is 1/10 net 45? 1/10 net 45 means that in general we are offering a credit period of 45 days. But if a customer makes a payment on or before 10 days, then we offer them 1% discount. Once again, I'm repeating. What is the general credit period? 45 days. But if a customer makes the payment on or before, how many number of days? 10 days. Then how much is the cash discount which you are offering? 1%. Got it? And the average collection period is 30 days. Now, why is that the general credit policy is 45 days, but average collection period is 30 days? Because there are some people who will be taking cash discount, so they will make early payments. Some people will make the payment on 45 days. Some might be even later than them. So based on that, your money is on an average getting blocked for how many number of days? 30 days. So to calculate your CID, you should take 45 days, 10 days, or average 30 days. Average 30 days. That's the time period for which the money is getting blocked. Current bad debts losses is 1.5%. And in order to accelerate the collection process further and so as to increase the sales, the company is contemplating liberalization of the credit terms to 2/10 net 45. So what is the credit period which you are offering now, my dear students? 2/10 net 45. Can you all please tell me if it is 2/10 net 45, it means in general we are offering a credit period of how many number of days? 45 days. But if the payment is made on or before what? 10 days. Then a cash discount of 2% will be offered. So it is expected that the sales will increase by 1/3. Bad debts will increase by 2%. And then the average collection period will reduce to 20. Contribution to sales ratio is given to as 22%. It means that contribution is 22%. So variable cost is 78%. And the opportunity cost is 15%, which is pre-tax. 50% and 80% of the customers are availing cash discount under liberalization scheme and your existing scheme. Tax rate is 30%. Now, whenever the tax rate is given to you in the question, we have to subtract tax also from the income statement. But please tell me that is variable cost allowed to be debited in the P&L account? Yes, sir. Is fixed cost allowed to be debited in the P&L account? Yes, sir. Is bad debts allowed to be debited in the P&L account? Yes, sir. Is even collection charges allowed to be debited in the P&L account? Yes, sir. But is CID debited in the P&L account? No. Because this is opportunity cost. This is notional cost. We don't debit that in P&L account. So where do you think it should come? Should it come pre-tax or it should come post-tax? Then the answer is it should always come post-tax. So whenever the tax rate is given to you, when do you think that the CID will come? Will it come before tax or it will come after tax? Everyone? After tax. And the CID percentage is also given to you. What's the CID percentage which is given to you? Just check. What's the CID percentage given to you? 15%. But this is pre-tax. So we have to convert that into post-tax. So when you convert that into post-tax, can I say this will become 10.5%? Okay. So how many policies are there in this question? Tell me. 2 policies, existing and proposal. In existing, what is the credit period which we are offering? On an average, the money is blocked for 30 days. In proposal, how much is the time period which we are offering? So based on that, the average credit period for which the money is blocked is what? 20 days. Give me the format, everyone. You have to say, come on, first, less. What do you get? Less. What do you get? From profits, what do you subtract? What is the first additional cost? Bad debts, collection charges. Here there is discount also. Then what we will get? NPBT minus tax, which is 30%. What will I get? NPAT. From this, what will I subtract? CID. What will I get? Net benefit. Okay. What's your existing sales? You only tell me, I will not tell. It's given on the first line of the question. What's the existing sales? Come on, yaar. Your existing sales is nothing but 12 lakhs. Come on, yaar. So your existing sales is 12 lakhs. How much is your contribution? 22%. So what's your contribution? 12 lakh into 22%. Tell me. What is your bad debts? Have they given to you bad debts? What's your bad debts, guys? 1.5%. So now 12 lakh into 1.5%. 18,000. Sure. Is there any collection charges? No. We have to now also calculate discount. When we were offering them this credit policy, how many customers were taking discount? 50%. So 50% people are taking discount. So can I say from 12 lakhs, 50% are taking discount, and how much percent discount are we offering? 1%. So can I say 6,000? That will be your discount. Solo yaar. So now 2,64,000 minus 18 minus 6. 2,40,000. What's the tax rate? 30%. Calculate this. 72,000. 1,68,000. But now we have to calculate CID. How will you value CID? Tell me, how will you value CID? No, we have variable cost, na yaar. Why don't you have variable cost? You have variable cost. What's your variable cost, everyone? 12 lakh minus 2,64,000. So we have variable cost, na? So we'll prefer valuing the debtors at dash, variable cost. So I will take debtors at variable cost. Can you all please tell me variable cost into credit period, divide that by 12, that will give you the answer. What's your variable cost, guys? 9,36,000. What is your credit period? Can I say 30? 30 days, na? So we will divide that by, they have told you to assume 360. Yes, sir. So we'll divide that by 360. What's your debtors? 78,000. But this you will multiply it by 15% or 10.5%. That is your post-tax, 10.5%. Can you give me now what is this? 8,198. 8,190. Can you give me the net benefit? 1,59,000. 8, 10. 1,59,810. Just check. You'll be getting this as 1,59,810. Superb. But now what is happening? Are we enhancing the sales by 1/3? Come on, yaar. So now what is going to be my new sales? 16 lakhs. Variable cost, contribution. Now my cash discount is 2%. So I'll take 16 lakh ka 2%. How much percentage customers are taking discount? 80%. So take 16 lakh into 80% into 2%. Are you getting this? 25,600. Then you will be NPBT, tax, NPAT, and then this is 7280 on the basis of which we calculate, we get it. Everyone's okay with this? Okay. Now I am teaching you something which is called as factoring, okay, in your receivables management. So pay attention to this. Now let's talk about factoring, okay. See guys, what is factoring now? See, factoring now, basically this is one type of a service which is actually provided by banks, which are usually factors. Okay, they provide such kind of a service to their customers. This is one type of collection service. And because these are banks, they also give some kind of an advance. So understand a situation like this. For example, you are Mr. A. You sold goods to Mr. B. Okay. And you sold the goods on credit basis. Now Mr. B was supposed to give you the payment in 3 months. So you have your own collection department who will do the collection. But then there is a bank who tells you, okay, listen, we will do the collection on your behalf. Matlab, we will go to the customer, collect the money, and we will give it to you. So what is the advantage for me? Now I don't have to keep my own collection department. But then this particular factor which will be there, he will do this service free of cost or he will charge you something. So then he is definitely going to charge with some factoring commission. Suppose your factoring commission is, let's say, 2%. So 2% of whatever is the credit sales which I do throughout the year. Suppose my credit sales is 1 crore. So what is 1 crore 2% everyone? 2 lakhs. So that is the collection charges which I have to pay to my factor. This is one type of service which a factor provides, which is collection services. The second type of a service which a factor provides is nothing but advance against your debtors. It is also called as buying your firm's debtors, or providing loans against your debtors. Now bank will never give you loan free of cost or without any security. So bank usually keep this debtors as a security, and on that debtors they will give you some percentage by the way of advance. So let's say for example, the same customer A is selling goods to B, and for example the time period is 3 months and the amount of the credit sales is 1 crore. So there is a bank who is definitely going to go to B, collect the money and give it to A. But bank tells you, okay, listen, rather than getting you the money and giving it to you after 3 months, do you want the money now? So A will tell, okay, give me the money now. So bank in that particular case will tell you, acha, if you want the money now, then first of all, we will take this debtor as a security. So what is the amount of the debtor, guys? 1 crore. Now do you think that whenever the debtors, this is valued always at sales, so whatever is the amount of the debtors, do you think bank will give you 100% loan? Does the bank give you 100% loan on the security which you keep? Suppose you have gold of 30 lakhs. You go to the bank and tell bank, listen, take this gold and give me loan. Do you think bank will give you full 30 lakhs? Bank will definitely keep some reserves. So what will bank do? Bank will subtract reserves. Suppose the reserves is 10%. So can I say 10 lakh rupees will be kept as a reserve? Bank will also subtract its commission on this debtor. So bank will subtract what, beta? Commission on the debtor. So what is the factoring commission on this debtor? Suppose commission rate was 2%. So bank will subtract 2 lakhs. Now what is the money which is available by the way of advance? The money which will be available, that will be 1 crore minus 10 lakh minus 2 lakhs, 88 lakhs. So can the customer get 88 lakhs today at day 0? Come on, yes or no? Yes, sir. But will the bank give this free of cost? Or bank will charge with some interest? So whatever is the interest, we have to multiply this by interest. So that will give you your interest charges. So factor will provide how many types of services? 2 types of services. Number 1, collection. Number 2, providing advance. On collection, you have to give them some dash commission, and on advance, you have to give them some dash interest. Now tell me one thing, does appointment of factor leads to increase in sales? No, because factor is just doing your back office work. It's just collecting the money. So always remember, in all the factoring questions, will your sales enhance or your sales is always going to remain the same? The sales will always remain the same. Now just imagine something like this. Sales less variable cost, what do you get? Contribution less fixed cost, what do you get? Profits. Now from profits, what do I usually subtract? Additional cost. What are the additional costs which will come? Bad debts, CC, CID, and now factoring commission, and now interest also. Can I say I'll be getting the net benefit? Solo yaar. Suppose your sales here is 1 crore. So don't you think without factoring, if I don't appoint the factor, the sales is 1 crore. If I appoint the factor also, can I say my sales has to be 1 crore only, yaar? Suppose my variable cost is 70%. So can I say if this is 70 lakh, this will also be 70 lakh. If this is 30 lakh, this will also be 30 lakhs. If this is 10 lakh, this will also be 10 lakh. So what's your profit going to be? 20. So now instead of preparing the entire income statement, we will just do cost analysis. Why do we have to prepare the entire income statement? Because till profit, everything is the same only. Now what should we do, beta? Cost analysis. And now net benefit was always higher the better. But what do you think the cost should be dash? Lower the better. So we will select the policy in which the cost is going to be lower. Come to question number 15. A factoring firm has a credit sales of 360 lakhs. Actually, this should be a firm. A firm has a credit sales of 360 lakhs and its average collection period is nothing but how many number of days? 30 days. The financial controller estimates that the bad debts is 2% of the credit sales. Now, many times, you know what happens, that once we appoint the factor, they will only collect the money on our behalf, and whatever is the bad debts, even that is their responsibility. So sometimes factors are also ready to bear the bad debts. They are also ready to bear the bad debts. So that is why those kind of agreements are called as non-recourse agreement. What is it called as, beta? Non-recourse. So whatever is the bad debts, whose responsibility? Factor's responsibility. In ICAI questions, if no information is given to you, we will always assume it to be your non-recourse agreement. It means who will bear the bad debts? Factor will bear the bad debts. Right now, so because we are collecting the money, of course, we have to bear the bad debts, which is 2%. The firm spends 1,40,000 on managing your debtors, and the cost comprises of telephonic bills, etc. And these are all avoidable costs. A factoring firm has now offered to buy the firm's receivables, and the factor will charge 1% commission and will pay an advance against at the rate of 15% after withholding 10%. And then analyze what the firm should do. Anywhere in the question have they mentioned who will bear the bad debts? Till now what you have read, has anywhere it is mentioned that who will bear the bad debts? No. So who will bear the bad debts in this particular case? Factor. So the question is whether we should adopt the factor or not. Now just check. What do I have to do in this question number 15? I will check what is my cost without factoring. Then I will check what is the cost with factoring. And then I will select that which of the total cost is going to be the least. What are the types of additional cost? Can you please tell me what are the types of additional cost? Bad debts, collection charges, CID, then factoring commission, solo yaar, and then interest. There is no CID percentage given to in the question. Now, please tell me, if I don't adopt a factor, if I don't adopt the factor, Shri, if I don't appoint the factor, do I have to pay factoring commission? If I don't adopt the factor, do I have to pay interest? But if I appoint the factor, do I have to pay bad debts? No, because bad debts is factor's responsibility. If I appoint the factor, there is no collection charges. But do I have to pay factoring commission? Do I have to pay interest? This is bad debts and this is collection charges. So these are the 4 boxes which you have to calculate. And do I already have collection charges given to you in the question? Without factoring, if I don't appoint the factor, how much are we spending on collection? On managing your debtors, on administration of your debtors, how much are you spending? 1,40,000. But the moment I appoint the factor, I will tell my staff to go away. So that's why it's not my cost. Because obviously, I will not have 2 collection departments. Na? I am going to tell my factor to collect the money. So now this money will be saved when there is without factoring. Come on, yes or no? Yes, sir. Now, what is the percentage of bad debts? Tell me. 2%. So can you all please tell me in this particular case if it's 2%. So what is your 2% of credit sales? Can I say all sales are on credit? So 360 lakhs is on credit. So 360 lakhs multiplied that by 2% everyone. 7,20,000. So if I don't appoint the factor, what is the total cost which I am bearing? 8,60,000. But when I appoint the factor, then can I say that I have to first pay them dash factoring commission? Can you please give me what's your factoring commission percentage? How much is it? 1%. So can I say it's going to be 1% of sales? How much is your sales, beta? 3 crore 60 lakhs. So can I say this will now be what? 3,60,000. That's the commission which I have to pay. But then I also have to pay them some dash. What do I have to pay them? Now to pay them interest, first I should know what is the amount of advance. What is the amount of loan? At what the factor is giving me the money. So for that, we will always value the debtors at sales. Because advance is always given by whatever is the market value of the debtors. How much amount are we going to recover from the debtors? So that is always valued at what? Sales. So do I have sales available? Come on, yes or no? Yes, sir. How much is that? 360 lakhs. And they have not told you that factor is going to collect the money faster or something like that. What was my collection period, guys? 30 days. So factor will also collect the money in how many number of days? 30 days. So can I put it like this? 360 into 30 divided by 360. Will this give me my debtors, which is 30 lakhs? Come on, yaar. My debtors will be what? 30 lakhs. From debtors, now I told you that bank will subtract 2 things. What are the 2 things? Reserves. And what is the second part? Not interest. Factoring commission. Our bank will always give you advance after reducing their right from that customer. Na? So gold, I told you 30 lakhs. Will you get 100% loan? No. So here also, will the bank give you 100% loan? So bank is definitely going to subtract some reserves. What's the reserves? What's the reserves, everyone? So it's going to be 10%. So 10% of 30 lakhs. Then let's talk about factoring commission. Now to calculate the factoring commission, do you have the amount of your sales? Yes, but now wait, we just have to calculate the commission on this 30 lakh rupees. So we will take 30 lakhs and multiply that by 2%, 1%. So that is 30,000. Now why have I only taken the factoring commission on this debtors? Because when bank is keeping this debtor as a security, bank will give you loan, but first it will remove how much money they are going to receive from them. Matlab, what is their commission on them? So their commission is just 30 lakh ka 1%, which is 30,000 rupees. No doubt, total commission is 3 lakh 60. But when they are giving loan to you by keeping a debtor as a commission, as a security, then they just have to reduce the commission on that debtor only, not the entire amount of the sales. See, for example, Shri, you all are my customers. Okay, they all are my customers. And you are a factor. Now, I have first sold goods to Shri. And Shri is going to give me the payment after the period of 30 days. What's the sales which I am making? 30 lakh rupees. My money blocked in Shri is 30 lakhs. I gave you Shri as a debtor. You gave me advance. Now when you will give me advance, you will definitely subtract commission and give me advance. As you are subtracting reserves, you will also subtract commission and give me advance. But when you are going to subtract commission, will you subtract commission from all the customers? Or will you just subtract commission from Shri's as a customer? Only from Shri. Are you understanding? So that's why here it should be factoring commission will be only 30 lakhs ka 1%. So can you please give me the amount of the advance? 26 lakh 70,000. I am not concerned with advance. I am concerned with the interest on advance. So what's the interest amount, guys? I'll multiply that by 15%. Can you give me this? 4 lakh 500. So can I say this is 4 lakh 500? Can you please tell me this will be total of dash? 7 lakh 60,500. Now can I say if I appoint factor, my cost is reducing? By how much amount is it reducing? 99,500. So is this the savings which is happening because if I'm adopting a factor? Come on, yes or no? Yes, sir. Should I appoint a factor or I should not appoint the factor? I should appoint the factor. Check this out. 99,500. 99,500. But our presentation is very simple. If you just check now what they have done, similar way only, but they have taken into consideration this into 360 upon. Why to do all these things when we can do it in a very simple way? Purinjida? Are Purinjida? Sure. Illustration 16. Are you all ready? Are you understanding better? I'll give you the sheets today, don't worry. Okay, so you can just take all the notes from there. It's absolutely fine. It will be there in our Telegram group. Today, before giving you sheet, I will not leave this class. Okay, don't worry. But it has made now so simple. Students find factoring so difficult. But if you follow this process, it's very, very, very simple. It's very manageable. Okay. Question number 16. Let's do this. Mosaic has current sales of what? 15 lakhs. Cost of sales is 75%. And bad debts is 1%. Cost of sales comprise of 80% variable cost and 20% fixed cost. While the company's required rate of return is 12%. Mosaic currently allows 30 days credit, but is considering to increasing that to 60 days. It has been estimated that change in policy will increase the sales by 15, while bad debts will increase from 1% to 4%. And it is not expected that the policy change will result in an increase in fixed cost and creditors, and stock will be unchanged. Should Mosaic introduce the proposed policy? Everyone with me? Achha, this was 14. This is 15. No, this is what? 16. This was correct only, sorry. This is question number 15. Now we are doing which question, beta? Question number 16. Everyone please tell me, how many policies do you have in this question? Existing and proposal. That's it. Come on, yaar. Now I want you all to this time answer this to me. Chalo, fast. There is no factoring question, normal question. Please tell me existing. What's the credit period which we are offering? Mosaic Limited allowed a credit period of what? 30 days. But now they are planning to increase it to what? 60 days. Please tell me the format of the income statement. Profit. How many types of additional cost do we subtract? Bad debts, CC, CID. Is there any discount in the question? Is there any discount or something which is given to you in the question? No. So can I say, is there any tax rate? No. So can I say this will be my net benefit? At present, what's your sales? 15 lakhs. And now see, what have they told you? That cost of sales comprises 75% of sales. Can you please give me what's your cost of sales? It is 75% of sales. So you take 15 lakhs and multiply that by 75%. 11 lakh, 25,000. Now in this cost of sales, you will be having variable cost, you will be having fixed cost. What is variable cost? If you guys can just check, your variable cost of sales comprise of 80% of variable cost. Give me 80% of variable cost. 9 lakhs. So what is this going to be? 2 lakh 25. So now do I have variable cost which is available, which is nothing but how much? 9 lakhs. What's my fixed cost, guys? My fixed cost is 2 lakh 25. Can you give me what is this going to be? 6 lakhs. And 6 lakhs minus 2 lakh 25. This is 3 lakh 75. Solo yaar. This is 3 lakh 75. Can you give me bad debts percent? They have told you that what is your bad debts? They have told you it's 1%. Bad debts is 1%. Can you give me bad debts? 15,000. Is there any CC? No. CID. How will you value your CID? Debtors at what? Total cost. What's your total cost, everyone? 11 lakh 25. Into what? 30. Divide by, have they given you days? Assume 360. Can you give me your debtors? 93,750. But multiply that by the cost percentage. What's the cost percentage? Where is it? Cost percentage is 12%. Multiply that by 12%. Give me this. 11 to 50. Can I say this will be 11 to 50? Subtract this. Give me the answer. This is the net benefit. 348, 750. But now what is happening? Are we increasing the sales? I am asking you, are we increasing the sales? So now old it was 15 lakhs. Now you are increasing the sales by what? The sales will increase by 15%. Give me new sales. 17 lakh, 25,000. Now can I say my cost of sales is going to be how much percentage of this? So this will be 17 lakh 25,000 into how much percent? 75%. What is 75% of this? 12 lakh 93,750. But variable cost is going to be what? 80% of it. What is variable cost? 10 lakh 35,000. But you know something? My variable cost will be 10 lakh 35. That is okay. And this 10 lakh 35,000 can also come from like this plus 15%. Please take 9 lakh and add 15%. Take 9 lakh and add 15%. It's the same. So that is going to be the same. But what do you think will happen to the fixed cost? They have told you that it is not expected that it will result in increase in fixed cost. So unfortunately, I have to keep the fixed cost to be the same. So it should not be this balancing figure because they have told you that it is going to remain constant. Give me this figure. 8 lakh 10,000. So give me now what is going to be your profits. 5 lakh 85,000. Bad debts is how much percentage? Just check. Bad debts is 4%. So 4% of sales. 17 lakh 25,000, 4%. This is contribution is wrong. Okay, what is the contribution? Please tell me. 6 lakh 90. What is your profits? 4 lakh 65. Right? What's your bad debts? 4%. 69. Come on, yaar. What's your CID? We have to value the debtors at total cost. Take 10 lakh 35 plus take 2 lakh 25. What's your total cost? 12 lakh 60,000. What's your credit period? 60. Divide by 360. What is this? 12 lakh 60 into 60 divided by 360. 2 lakh 10,000. You'll multiply that by how much percent? 12%. Give me this. 25 200. So this is 25 200. Can you give me the net benefit now? 3 lakh 71 800. 3 lakh 70,800. Shri is all giving me wrong answers only. Ah, Shri? So this is 3,70,800. Can you please tell me now what is going to be the net benefit increase? 3,70,800 minus what? 3,48,750. What is the increase in the net benefit? 22,050. Should you adopt the new policy? Come on, yes or no? Yes, sir. Shri. Oh, with this now all the illustrations are over. Superb. Did you enjoy? Very good. But now we will be starting with the next one. Now let us do cash management. Okay. Now this cash management is also very easy. Okay. But the illustrations are very big, so we'll be doing important adjustments from that illustrations. Okay. So get ready for this. Are you all ready? Solo yaar. Last chapter of this, because inventory management does not have any questions. That inventory management is your material costing. EOQ, root of 2A, CA, CI. Very good. What is that smuggling going on? Very good. No drugs, no? No drugs, no? Okay. Very good. Eat it, it's okay. I will not take it. Okay. You can eat. So, during when there are long lectures, and I've heard students saying this in the class. Hey, do you have any chocolate? I'm feeling very sleepy. And then that is something which happens right in front of my face. So I'm looking at them, I'm telling, listen, you want chocolates to survive in my class? They're like, sir, I had very heavy sharp tingla. So now stomach is full. So concentration po, sleep wah. Okay. Are you guys ready? Let's do this. Cash management. Now, what happens in cash management? Okay. Last chapter, madam, don't worry. Okay. After that, I will not trouble you. Payables, I will tell you what is to be done for that. Okay. See, sir, there are some specific topics for which there are special videos which will come. So you have to refer to that. Rest all I will complete. Payables management institute ask once in 10 attempts. Inventory management once in 10 attempts. But I don't know your luck. That once can come here now also. So we will do that by special videos, which I'll tell you that you have to watch. Okay. इसके लिए एक बार कर लेने का. Ready? You want something else also? Chalo. Are we ready? Last bench. Last bench paid attention to entire receivables management chapter. Very proud of you. But before that, he was sleeping. Research management, he paid attention. Estimation, he slept. Single shift, double shift, no shift. No shift at all. He slept. What's your good name? Sorry? Surya. Shri, what are you doing, beta? Shri, whenever he's sleepy, he throws bottle here and there. He's giving wrong answers. That's what he does. Beta, give him also some chocolate. You want? He has. No, he's okay. He's okay. You have. Chalo. Let's start. See, cash budget now, this cash management, this is very easy, beta. Now see. What first we have to do in your cash management, we'll first focus on this. See, cash. First, I'll start with cash budgeting. Now, what is cash budget? See, this is not a chapter. This is something what you do in your day-to-day life. You always have opening balance. To opening balance, what do? You add what? Receipts. Solo yaar. And then what are we going to do? We'll subtract your payments. What will you finally get, beta? Closing balances. Okay. So usually this is what we do. Suppose you wake up in the morning, then you check how much money is there in your wallet. Suppose 100 rupees is there. What is that 100 rupees called? Opening balance. Opening balance. Then you will plan your day. Okay, what can be the payments which can happen? Suppose 60 rupees is the payment. Then you will plan what is the receipts which is possible. 50 rupees is the receipt. So opening balance plus receipt of 50. 100 plus 50. Minus payments of 60. Can I say that will give you your closing balance, which is going to be what? 90. Thank you. So 90 is going to be the closing balance. Come on, yes or no? Yes. So we prepare a cash budget like this. Opening plus receipts plus payment. That will give you closing. But what should come in your receipts and payments? So all the types of capital or revenue, expenses or income should come in your receipts and payment. Okay. When money is va, it should be your receipts. When money is po, it should be your payments. Okay, I'll give you some list of examples. You first tell me. Money va means money coming in. Money po means money going out. Or else these students, my other students will not understand. Okay, so va means come in. And po means going out. Okay, I'm giving you some list of examples. You tell me money va, money po. Okay, are you ready? Come on, yaar. Sale of fixed assets. Money va, money po. Money va. Va will come in your receipts. Come on, yaar. You just have to tell me vapo, vapo, vapo. Okay. Sale of fixed assets. Purchase of fixed assets. Sale of investments. Va. Issue of equity shares. Va. Eh? She thought vapo, next will be po only. Are yaar, sale of, what did I say? Issue of equity shares. Whenever we issue equity shares, money va, money po. Redemption of preference shares. Po na, because whenever we redeem preference shares, can I say we have to pay? Purchase of plant and machinery. Dividends paid. Interest received. Loans taken. Loans repaid. Dividends receivable. Dividend receivable. 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 Illa. So it is on the way. Can I say that dividend receivable, yaar? So there is no money va, no money po. Solu, yaar. So there is no money coming in, no money going out, so receivable will have no impact. Interest payable. No impact. Depreciation. No impact. Salaries paid. Dividend received. Interest payable. Outstanding expenses. Have you understood? Outstanding expenses. But when outstanding expenses is paid, understood? So all these items we are going to write down in opening balance, add receipts, less payments. Zoom students, you all have not written in the chat box, Vapo, Vapo, Vapo. Come on, yaar. Money va, money po. See, I am writing. What is the spelling of va? Va. Okay. You guys are there with me? Come on, online students. Va. Good, very good. So opening balance, we add receipts, we less payments. What do we get? Closing balance. Sometimes in the closing balance, they will tell you to adjust the closing balance by taking some loans or by making investments. That is something which we'll discuss when we'll be doing the questions. Okay. So let's get started now directly with the questions. So 5 questions we did, illustration till 5 we did it in working capital. Now let's do illustration 6. Are you all ready? Let's do this. Prepare a monthly cash budget for 6 months beginning from April 2024 on the basis of the following information. Now we have estimated monthly sales which is given to you. You have Jan, Feb, March, April, May. Do you have the sales? Come on, yaar. From Jan to what? October. Wages and salaries are estimated to be payable as follows. We have wages and salaries also which is given to you. Of the sales, 80% is on credit and 20% is on cash. Please tell me, credit sales, any impact or no impact? But collection from debtors, Vapo. Can I say money comes in? Credit purchases, any impact or no impact? But payment to creditors, can I say the money will be going out, so that will be payments. 75% of the credit sales are collected within 1 month after the sale, and the balance is collected 2 months after the sales. There are no bad debts. Now, purchase amounts to 80% and is made on credit and paid for in the month preceding the month of sales. The firm has 10% of the debentures, which is 1,20,000. Interest on this has to be paid quarterly. The firm can make advance tax payment of 5,000. The firm has the cash balance of 20,000 on 1st of April, which is the minimum desired cash balance. Any surplus or deficit above or below this level has to be made by temporary investment or liquidation or temporary borrowings at the end of each month. This is something which we have to discuss. But first, please tell me, we are required to prepare the cash budget for how much months? So can I say your format should look like this? Opening balance, but 6 months starting from where? April. April, May, June, July, August, September, yaar. And for that, I need April month's opening balance. Do you have April month's opening balance? Come on, yaar. Do you have April month's opening balance? They have told you, the April month's opening balance is what? 20,000. Can I say then this will be your closing balance? This closing will become next month's opening. Then this will be your closing balance. This will become next month's opening. This will be your closing balance. Come on, yaar. That's how we have to prepare it. Okay. Please tell me, how will you start? Do you have sales given to you for the month of April? Give me sales. But please tell me, guys, my sales is 80,000. Can you please tell me how much percentage is on cash basis? Come on, yaar. How much percent is on cash basis? 20%. So 20% is on cash. So can I say your cash sales will have in the month of April, can you see receipt side, cash sales will be 16,000. Solo yaar. So her months, every month's cash sales, can you write down like this? Come on, yes or no? Yes, sir. Can you please give me what's your credit sales? See, your sales is 80,000. Okay. Now listen to this. Your sales is 80,000. How much is your cash sales? 20%. So what's your credit sales? So what is 80% of 80,000? But how are you receiving the 64,000? That is important. So they have told you 75% of the credit sales are collected within 1 month. So 75% of this is collected within 1 month. 48,000. And what is 25% which will be collected when, beta? It will be collected in 2 months. How much is this 2 months? 25% of 64,000. How much is this? 16,000. So this 48,000 will be collected in which month? May. And this 16,000 will be collected in which month? June. Just check. Is there any 48,000 here in the month of collection from debtors? Can you just check? In the month of May, is there any 48,000? Come on, yes or no? Yes, sir. This is 16,000 in June. For every month, can we do it like this? Let's do it for one more month. What is your sales for the month of May? What is the sales for the month of May? Out of that, cash sales will be dash. 20%, 12,000, that will come in May itself, yaar. That will come in May. Here only, 12,000. But what about 80%? What is 80%? It is 48,000. Now this 48,000, 75%, when it will be collected, beta? 1 month. 25%, when it will be collected? 2 months. Give me 48,000, 75%. 36,000. Can I say this money, when are you going to receive? June. And this balance part, 12,000. When will you receive? July. Just check. June, 36,000. And July, 12,000. Correct? Can we do this for every month? Hello? But now this part is remaining. Can you just check? This part is remaining. Can you please tell me where this part will come from? March. Very good. What's your March month sales? Do you have March month sales? Come on, yes or no? Yes. How much is that? 1,40,000. 1,40,000. How much percentage you will take, beta? 80%. So out of that 80, take 75. 1,40,000 into 80% into 75. 84,000. That 84,000 will come here. Right? And balance will come here. And then similarly, Feb month sales is also given to you. So this both will come. But we need from April onwards. So we need this figures. That is collection from debtors. Are you all clear? Okay. So this is how we'll be getting your collection from debtors. So cash sales is done. Collection from debtors is done. Now let's talk about purchases. What have they told regarding your purchases, guys? Purchases amount to 80% of sales. So do you have sales? Come on, yes or no? Yes. What is April sales? 80,000. Solo yaar. But purchase amounts to what? 80%. So that can I say it's 64,000? But they have told you that purchase amounts to 80% and are made on credit. But it is paid for the month preceding the sales. So please tell me this 64,000, when are you paying? Preceding. Preceding means next or previous. Before. Preceding means before, beta. Succeeding means next. Preceding, it is before. So can I say this 64,000 payment, when it will be done, beta? Before. So what is before? March. So just check. In March, there should be 64,000. But we are not preparing March anyway. So let's talk about May. What is your May month sales? Solo, what is May month sales? And purchases is how much percent? So 80% is what? But when are you going to make this payment? April. So can I say April there has to be 48? Just check. 48. Superb. Give me June month sales. Give me June month sales. 80,000. Multiply that by 80%. 64. When will you pay? In the month of May. Just check. In the month of May, 64,000. Purchase is clear? Solo yaar. So third is also done. Fourth is also done. Fifth. The firm has 10% debentures of 1,20,000. Can you please give me the amount of interest? 1,20,000 into 10%. What's the amount of interest? 12,000. That 12,000, how is it being paid? On quarterly basis. So how many quarters are there, guys? 4 quarters. So can I say per quarter it is 3,000? Solo yaar. So first quarter it will be paid in the month of April. Then what is the next quarter? July. So this is also done interest. Then what is the next thing which we have? The firm has to make the payment of advance tax of 5,000. So this 5,000 will come here. Come on, yes or no? Yes, sir. Tax payment. But then there is no adjustment given regarding wages and salaries. So don't you think wages and salaries will be paid in the month in which you have incurred? So 9,000 rupees. So are we going to have 9,000 rupees? Come on, yes or no? Yes, sir. So then this is total A, total B, closing balance. We have to keep it. Now see, what is the minimum level of closing balance they have told you to keep? 20,000 they have to keep it. Okay. Now just check. If I take opening balance, okay, and then if I add everyone on your calci, take opening balance of 20,000. What is your total receipt? 1,44,000. So add, sorry, yaar, this is after adding only it is 1,44,000. Understood? So this is 1,44,000. What's your payments total? 60. Can you please take 1,44,000 and subtract that by 60? Please tell me 84,000 is the closing. But you have to keep a minimum level desired balance of what? 20. So what do you think you should do for the balance 64,000? Invest it. Because that's the surplus available. Can you just check there is surplus of 64,000? What are you going to do? Temporary investments. Got it? So your closing balance will be 20 only. Because can I put it like this? That from your closing balance, which came as, what was the closing balance which came? 84. Right? You have to do three things. Either you can make investments, or else you can take loans, or else you can repay loans. Come on, yaar. Okay. But you have to carry forward next month balance of 20,000 only. So can I say 84? So balancing part is what? 64. So 64 is purchase of investments. And your opening balance for next month will become what? 20,000 only. Because we have to keep 20,000 compulsory. So next month, 20,000. Can you just check? Opening is 20. Now what is the total which is coming? Everyone on your calci. 1,08,000. Minus, what's your payment? 72. Please subtract 72. How much is this? 36. Can I say this is more than 20? By how much amount? What will you do with 16,000? Can I say invest? So hence this will now continue to be what? 20. This 20 will go here. Acha, do the, what is this? 88. Take on your calci 88. Subtract what amount? Payments, how much? 90. Do you realize there is negative 2,000? But you have to keep how much? 20. So now you have to take borrowing of what? 22,000. But why do we have to take borrowing when we have investments? We will sell it 22,000. So now your closing balance is 20. This will be 20. Got it? Now what is the total? Everyone on your calci, 1 lakh. Subtract payment, how much is that? 82. Can you please tell me what's your closing balance? Are you in deficit? How much amount? So what will you do with this 2,000? Sell investments. So you sold investments of 2,000. What's the closing balance? 20. Go here 20. Do the total 1,12,000. Take on your calci 1,12,000. What is your payments, guys? 57. Solu yaar. So how much have you got? 55. Is 55 more than dash? What will you do with 35? Invest. Here they have not mentioned regarding borrowing. So what will you do? Invest it. So then this is 35. So the closing balance will become what? 20. This is 20 and do it for the next month. Superb. Okay, so there is no repayment of borrowing. In the question they have just told that either you should make investments or you should take borrowings at the end of the each month. So only investment or borrowing. That's it. Have you all understood this? Next question. Question number 7. Come on. Shall we? Are you guys tired? Should not be tired. Turning pages is not going to help. She is checking how many more pages to go. Not helping. Today you are going to sit till late. Okay? Will you sit till late? If you want, I'll order dinner also here. Yes, sir. Now he is ready. Order dinner. Yes, sir. If you're giving dinner, then make us sit, sleep also here. Tomorrow breakfast also you give. AC is to there. You are also relaxed. Open classroom, sleep. But we have to do it. Okay? How much ever time it takes. But I hope I am not the only one motivated in the class. You all are also motivated now to do it. Okay. Today is the last lecture. And tomorrow onwards you will not see me. And you are gone. Okay? Only today. Tomorrow also you have a revision lecture. Tomorrow you have or tomorrow you do? Today is what? Thursday, na? Tomorrow is Friday. Tomorrow you have it? My lecture? No, no, no. It's going to change. It's going to change. No, I had written. No, no, I have messaged them. It's only till 26th, na? One more day. But tomorrow I have one more lecture here. One second, I'll just confirm with them. Come on. So today you are here only. Okay, I'll give you a break. Don't worry. Even if I don't give you, you will take it on your own only. I know that. So that is why I have to give you a break compulsory. Okay. because students are very smart. I tell them that I want to give a break, and they will realize that whether you give the break or we are going to take on our own. Chalo. Question number 7. Prepare the following information relating to a departmental store. You are required to prepare for the period of 3 months ended 31st March 24, month-wise cash budget on receipts and payment basis, and statement of sources and uses of funds for the period of 3 months. It is anticipated that the working capital and other account balances on 1st of Jan 2024 is as follows. So this is nothing but your opening balances on which date, beta? 1st of Jan 2024. We have budgeted profit statement which is given to you. Solo yaar. And then we have budgeted balances at the end of each month which is given. Depreciation amount to what? 60,000, which is included in the budgeted expenditure for each month. Now my dear students, please tell me, first of all, we are required to prepare what? Your cash budget. First let's talk about the cash budget. What is the opening balance which we have? We are required to prepare the cash budget first of all for how many number of months? 3 months ended 31st March 24. Solo yaar. So we are required to prepare for Jan, Feb, March. So you'll be starting with what? Opening balance. Add what? Receipts. Then we are going to subtract payments. Ultimately what will we get? Closing balance. Come on yaar. And there is no need for any adjustment. If I am starting from Jan, can I say I should have opening balance of Jan, which is given to you as 545. So can I start with 545? Come on, yes or no? Yes, sir. Then my dear students, we have list of data which is given to you. Example, short-term investments. Everyone please tell me what is the opening short-term investments? 300. Okay. Please tell me Jan's closing. Arey 300 was Jan's opening na yaar. What is Jan's closing? So during the month of Jan, what has happened? You have purchased the short-term investments or you have sold it? Purchase of short-term investments, money va, money po. Money will go. So can I say it will go to your payment side as purchase of short-term investments? Come on, yes or no? You all can just check. We are going to have purchase of short-term investments, 400 rupees. Understood? Please give me what is Feb month's closing. What is Feb month's closing? 0. So everyone answer this in one voice. Is Feb month's closing is 0. What does it represent? Sold. Money va, money po. Money va. So can I say that will come in your receipt side? How much amount should come? How much amount should come? 700. And in the month of March, again you are purchasing, so 200. Everyone understood this? After short-term investments, what's the next item which we have? Debtors. What's your debtors? 2570. Do you also have sales for the month of Jan? Right? And you also have closing debtors, which is 2600. Can I calculate debtors like this? Opening balance. What was the opening balance? Come on, yaar. 2570. What's your closing balance? 2600. What's your journal entry for credit sales? What's the journal entry for credit sales? Debtors account debit to sales. Beta, what is your sales? 2100. Can I calculate my collection from debtors? How much is it? 2070. So this is by cash bank. This is money va, money po. Money va, money po. Money va. Collection from debtors is money va na yaar. So this 2070, where it will come, beta? It will come in your collection from debtors. Everyone please tell me, money is coming in na? So this is 2070. So you can take opening debtors, add sales minus closing debtors. You will get it for each and every month. Superb. Okay. What's the next item which you have? After debtors, we have stock. Now stock which we have, can I say stock will actually be helpful for you to calculate your amount of your purchases. So do you have COGS in the question? So what is COGS? Your COGS is nothing but opening stock plus purchases minus closing stock. Do you have COGS in the question? What's the COGS? 1635. What's your opening stock? Can I say opening stock is 1300? What's your purchases? X. What's your closing stock, everyone? 1200. Can I say this data is sufficient to calculate your purchases? What's your purchases? 1535. You have got the purchases. What will you do with the purchases? You will have to make the payment to your creditors. So can I say in this particular case, when you have to make the payment to your creditors, can you see there is trade creditors which is given to you? How much is that? 2000. That is your closing. How much is your opening? 2110. So can I say for your creditors, what's your opening, guys? 2110. What's your closing, guys? 2000 and come on, yaar. And what's your purchases? 1535. Can you get your payment to creditors to cash bank? How much is this? 1645. You all can just check here. You will come to know that payment is 1645. So from COGS, you will get your purchases. From purchases, you will get your what? Payment to creditors. Okay, everyone? Okay. Come on, yaar. So this, with this, your trade credit is also done. Other creditors, how much is it? 200. And can you just check it is 200 everywhere? So this is paid or not paid? Paid or not paid? Effect or no effect? No effect. What's your dividends payable? 485. Please check what's your dividends payable in the month of Jan? 485. No effect. But in the month of Feb, it is what? 0. So can I say we have paid dividends? So then money va money po. Can I say in the month of Feb, it will be money po? 485. Solu yaar. Then please tell me, dividends payable, taxes due, how much is it? 320. And just check the closing balances. Everywhere it is 320, no effect. Then please tell me, sales is done. Yes, COGS is done. Admin expenses. Now how much is your admin expenses? 315. But they have told you that depreciation amounting to 60 is included here. So should I take 315 or should I take 255? So 255, because depreciation will never have a partner. So that will be 255. Got it? Then we have the last item, and which is nothing but your plant. Plant. Everyone please tell me plant, guys. What was your opening plant? What's your closing plant? No effect. But what's your closing plant? 1600. Hey, plant sold, plant purchased. Money va money po. Money go. How much amount? 800. Can I say that will come in the month of what? Feb. Feb. 800. And then we are selling some plant. So then receipt will be. Superb. So this is how we're going to do this question. So now see this sources and application of funds. Now it's okay if you ignore it because this is part of your fund flow statement. So not that important from this examination perspective. Question number 8. Okay. How many questions are there after 8? Oh, then there is Prachi. Prachi is a very big question. Okay, so Prachi, I will tell you what to do. Okay. But where is 9 and 10? I cannot see 9 and 10. Oh, these are small questions. Okay. Let us first start with your question number 8. Are you all ready? Okay. Chalo, let's do this. You are given the profit and loss account for the 2 years of the company. We have opening stock, raw material, stores, manufacturing, other expenses, depreciation, sales, closing stock, miscellaneous income. Sales are expected to be what? 12 crores in year 3. As a result, other expenses will increase by what? 50 lakhs besides other charges. Only raw materials are in stock. Assume sales and purchases are in cash terms and the closing stock is expected to go up by the same amount between year 1 and year 2. You may assume that no dividend is being paid and the company uses 75% to service a loan. Now compute how much cash from operations will be available for year 3. This is a very different type of a question. Please tell me that cash from operations, this wordings you must have heard in your cash flow statement. Do you know cash flow statement first? In AS3, you know your cash flow statement, indirect method or direct method. In cash flow from operating activities, we have cash from operations. So let us talk about your AS3, one cash flow statement, indirect method. How do you get your cash from operations? We start with your net profits. And this net profits, now we adjust it 2 times. We make adjustments for any kind of non-cash expenses we added, any non-operating expense we added, any non-operating income we subtracted, all those things we do it. Then ultimately we have to make second type of adjustments, and that is going to be changes in working capital. Any increase in current asset, what do you do with the same? Can I say this increase in stock, we are going to subtract it? Come on, yes or no? Yes, sir. Ultimately what we get? Cash from operations. So in this question, first what do I need? I need what should be the net profit for my third year. So the objective is to calculate what should be the net profit for the third year. Because once I get the net profit, then can I find out cash from operations? Come on, yes or no? Yes, sir. Now, they have given you year 1 and year 2. They have not given you year 3. So now I will prepare very quickly year 3. Year 3. Can I say the first item which will come here will be your sales? Hello? Buy sales. What was your sales earlier, beta? 10 crores. Now the sales in year 3 will be what? 12 crores. Please tell me, is the sales increasing? Come on, yes or no? Yes, sir. Now, what is the next item? Just check here. Can you just check there is miscellaneous income? Miscellaneous income, this is 10 lakh, this is 10 lakh. I will assume in the third year also, my miscellaneous income will be what? 10 lakhs. I'm writing down everything rupees in lakhs. Then can I put it like this? Here, there will be 2. Now, opening stock of raw material plus purchase of raw material minus closing stock of raw material, can I say will give me raw material consumed? Because they have told you that the stock only belongs to raw materials. Just read this statement. Only raw materials are in stock. So the stock which is given to you, that is nothing but what? Stock of raw material. So opening plus purchase minus closing, that will give you your what? That is nothing but RMC only. So can you please tell me what is second year's RMC? What is your RMC for second year? Can I say this is nothing but 1 crore? अरे बोलो ना यार, 100 lakhs plus raw materials is what? 4 crore, matlab 400 lakhs. What's your closing stock? 150. Can you please give me what is your RMC? 350. Now when the sales will increase by 20%, what do you think RMC will do? RMC will also increase by 20%. And how did I come to know that the sales is increasing by 20%? My year 2 sales was 10 crores. My year 3 sales is what? 12 crores. Can I say my sales has increased by 20%? Solu yaar. So raw material consumed will also increase by 20%. So what was my old raw material consumed? 350. Now this will increase by 20%. Can you please give me 350 plus 20%? 420. So this is raw material consumed 420. What about stores? Is stores your variable cost or stores is your fixed cost? Variable cost. Will that also increase? Yes or no? Yes, sir. So old sales was what? 120. Aresh, what happened, Shri? Ask na. See, if the sales increases by 20%, raw material consumed, is it your fixed cost or it's your variable cost? So when sales increase by 20%, your RMC will also increase by 20%. So what was my old RMC? This is year 2 RMC. Opening stock plus purchase minus closing stock. Okay, just check. What's the opening stock? 1 crore. Look at the screen now. Opening stock is what? 1 crore. Purchase is what? 4 crore. Closing stock is what? 1 crore 50 lakhs. So can I say your RMC is 350 crores? 350 lakhs. So this 350 lakhs will increase by what? 20%. So can I say this will be 420? If sales increases by 20%, hey Bhagwan, this is 10 crores. Are Inder Kade, I'm wondering, hey, your year 2 sales is 10 crores. Your year 3 sales is 12 crores. Has the sales increased by 20%? Are why mode? So closing stock is going to increase by 50 lakhs. That's a separate thing, beta. Closing stock is going to increase by 50 lakhs. That's a separate thing. That I will tell you what you have to do with the same, beta. But this is their variable cost, na yaar. So that will increase by 20%. Understood? Now please tell me, what is your stores? Fixed cost or variable cost? Variable cost. Can you please tell me stores for year 2 is dash? 1 crore 20 lakhs. That also has to be enhanced by how much percent? 20%. So now what will be the new part? Stores 1 crore 144. When you increase that by 20%. Solu yaar. Manufacturing expenses 160. Will that also increase by 20%? How much is that going to be? 192. Other expenses, they have told you in the question that it is going to increase by 50 lakhs. Now, bachcho, your sheet is specifically mentioned, beta, that other expenses will increase by 50 lakhs. So, will I increase this 1 crore by 20% or by 50 lakhs? Other expenses. How much is this? 1 crore 50 lakhs. And then depreciation. Is it going to remain the same? 1 crore. Come on, yaar. So then we'll be calculating what is going to be the amount of net profit. Can you give me the net profit? You directly saw from the question and you are telling me. I was just wondering how can you do the calculation just by looking at the screen. He's so smart. He looked at the 2 lakh 4. Do the calculation. 204. You'll be getting this net profit as 204. Shri, Gauni, this is 204. Can I say we have net profits 204? Solu yaar. First, now we have to adjust for non-cash expense. Is depreciation your non-cash expense? How much is that? 100. And what is the increase in stock? Now you tell me, Shri, is there any increase in stock, bacha? How much? By how much amount? 50 lakhs. So you subtract 50. Any increase in current asset, we subtract it. So now can you please tell me what is this answer which is going to come? 304 minus 50 is what? 254. Easy, right? Let me just check. 254. And we are using from this cash from operations how many percent to service a loan? 75%. So this is going to be 75. Service a loan means repayment of loan. So in that particular case, out of that, I am using 75%. So 75% of 254 will give you what? Solo yaar. 190.5. Which is this answer. Superb. Understood this question? Sure, confident? Come on yaar. Okay. Now this question, now it's a very huge question. Very huge question. So this I will tell you by the way of video. I'll give you one video which you have to watch it. Okay, that video you have to watch it. Now let us come to question number 10. Are you ready? So 9th video. Okay. 10th, we have to do it. Now, do you know optimum cash balance? This is very similar to EOQ. Do you know there we were keeping stock beta? Here we have to keep optimum cash balance. What's the formula? Root of 2ACA upon CI. So I don't have time to explain the entire question, but I'll just give you the explanation for this. That whenever, you know, it is specified that how much optimum cash you should keep. So we have to take into consideration what is your annual cash requirement. Now just check what's the annual cash requirement which you are going to have per year. 12 lakh 60. So this is your 12 lakh 60. What is your cost per transfer? That is 20. And what is your yield? That is 0.08. So based on this, if you calculate now, then you'll be getting 25,100. So just for the time being, remember this by the way of formula, that to calculate the optimum cash balance, we use root of 2A CA upon CI. Okay. So that's your question. This question number 11, which is the last one, this is very similar to working capital. Let's do this. On an average, debtors collected after how many number of days? 45. Inventory is what? 75. Creditor is what? 30. Can you please give me what is your operating cycle duration? 45 plus 75 minus 30. Can you give me this? 90 days. That is nothing but 3 months. So what is the cash cycle? Cash cycle means operating cycle. Can I say operating cycle is nothing but 90 days? Solu yaar. And how many times in a year can you rotate this money? If it is 360 days, can I say 4 times? Can you just check 4 times? Very easy. Next part. The firm spends 1,20,000 at an annual rate. So if the firm is spending 1,20,000, can I say the money can be rotated 4 times? So how much is the cash required? 30 lakhs. And it can earn 10% return on the investments. So that is helpful in the last part. Okay, cash cycle, cash turnover, we are done. Minimum cash, 30 lakhs, even that is done. Savings by reducing the average collection period by 30 days. Now, please tell me, if I reduce the average collection period, then the money will be blocked for 90 days or the money will be blocked now for 90 minus 30, 60 days. It will be blocked for 60 days. So then, can I put it like this, that how much money was required per year? 120 lakhs. But now if the money is blocked for 60 days, how many times in a year can I rotate the money? 360 divided by 60. So that is 6 times. So how much money will I need? 20 lakhs. Old money was how much? 30 lakhs. Now I need what? 20. Am I saving 10 lakhs? So if I saving 10 lakhs, the rate of interest is 10%. 1 lakh is the saving. That's it. With this, cash management illustration is also done. Now, your last thing which is remaining, that is from the practical problems. Payables also, you'll be getting the video, you have to check from there. Okay. Now, these questions which are there now, we will be doing this after a break. These practical problems. Okay. How many are there? 14. So we'll be doing these practical problems. We'll take a break and then we'll do it. I will take 1 hour, 10 minutes, 1 hour, 15 minutes to do that. Okay. So see, it's 5 o'clock. We'll take a break till 5:15. From 5:15, I will start. We'll try to complete it by maximum 6:30. Is it okay? You have to go somewhere. Tell your boyfriend no today. She could understand because she is her cousin. She knows. If you had planned, I know. Okay, tell him to come after 7. Okay? Understood this? Break of 15 minutes. Okay, after that we'll continue. But this last session, I want you all to be there because we are going to do lots and lots of things. Okay? Take a break. So now we are doing your last segment, that is practical problems of working capital chapter. Okay, let us start with the very first question. See what is given to you. Now this practical problems that will cover your working capital also, that will cover your receivables management also, that will cover your cash management also. Everything is mixed here. Okay. So are we ready for this? Okay. Now, okay. Now let us start with the first question. Following information is forecasted by R Limited for the year ended 31st March. We have raw material, we have work in progress, we have finished goods, we have receivables, we have payables. Then we have average purchase of raw materials, annual cost of production, COGS, annual operating cost, and annual sales. The first part is we are required to calculate the net operating cycle period. How do you calculate the operating cycle period, guys? So we have to take into consideration your stock of raw material holding period. So here we need work in progress, conversion period. Come on, yes or no? Yes, sir. We need after this, what is going to be your finished goods holding period? We need whatever is your debt collection period. From this, what will you subtract? Creditors payment period. Ultimately, what will we be getting? Operating cycle duration. Now, we don't have stock of raw material holding period, but that's okay. Do you have opening stock of raw material? Do you have closing stock of raw material? Do you have purchases of raw material? Can you please tell me now, how do you calculate your raw materials consumed? Give me the formula for raw material consumed. Opening stock of raw material plus purchases of raw material minus closing stock of raw material. What's the opening raw material which you have? 45. Just check this properly. This is 21. This is 22. So this is opening. This is closing. Okay. What's the opening raw material? Come on. 45. What's your closing? 65. How much are you purchasing? 400 you are purchasing. Come on, yaar. So give me your RMC. 380. Now, how will you calculate your stock of raw materials holding period? So guys, your stock of raw material holding period will be calculated by taking whatever is the average stock of raw material. You will divide that by your RMC and multiply that by whatever is your days, months, weeks, year. What is given to you, beta? 365 days. So here we'll multiply that by 365. See, this is nothing but very simple. What's RMC? 380. But that is for 365. But now we have opening and closing both available. So should we take average? Come on, yes or no? Yes, sir. So what's the average which is given to you? 45 plus 65. Tell me. Divide that by 2. 45 plus 65 divide by 2. How much is it? 55. So this is 55. So if this is 55, then for that how many days will be required? So this is nothing but average stock of raw material upon RMC into 365. Can you give me what is the raw material holding period, everyone? 52.8. Can I say approximately this is nothing but how many number of days? 53 days. So can I say we have stock of raw material holding period 53 days? Solo yaar. Okay. Work in progress. What's your average work in progress? 51 and 35. Do the average. 43. This is the average. But for work in progress, what should I take? I should take cost of production, which is what? 450. So what will you take, beta? Whatever is your average, you divide by 450 into 365. You'll be getting how many number of days? 35 days. So that will be coming as your 35 days. Acha, for finished goods holding period, now you only tell me what's your average, beta? 65 is your average. And for finished goods, will I value it at annual COGS? Come on, yes or no? Yes, sir. How much is that? 525. So what will be the answer? 65 divided by 525 into 365. How many number of days are there? 45 days. So will that be taken into consideration as your 45 days? Come on, yes or no? Yes, sir. What about your debt collection period? Now, when I'm talking about the debt collection period, we should have, first of all, average debtors. What's the average debtors which we have? Opening plus closing divide by 2. 123.5. For debtors, what should I take? Sales. Do you have sales? Come on, yes or no? Yes. What is that? 585. So now it will be nothing but whatever is your 123.5 divided by 585 into 365. How many number of days are you getting? 77. So can I say this is 77 days? Solu yaar. And when we talk about creditors payment period, what do we need is nothing but your amount of purchases. And do you have opening closing both available? Come on, yes or no? Yes, sir. Give me the average. 69.5. And what's your purchases, guys? Your purchases is nothing but 400. So now you will take this divide by 400 into 365. How many number of days do you have? 64. So this will be treated as your 64 days. Now can you please give me what's your operating cycle duration? Give me your operating cycle duration, everyone. What's your operating cycle duration which is coming? 53 plus 35 plus 45 plus 75 minus 64. 144 or 6? 146. So now 146 days is nothing but your operating cycle duration. That's the first part of the question. What's the second part of the question? Number of cycles. How will you calculate number of cycles, guys? 365. We will divide that by operating cycle duration. So that will give you your 2.5 times. And then they have told you that what is the amount of working capital. Just check in a year, what is the annual operating cost? 325. Now in a year you need 325. But will you go to your bank and ask for 325? No. We have to just check now how much number of times the money is being rotated. So you will divide that by, can I say, the number of operating cycles which we had, and that is nothing but what? 2.5. So you will divide that by 2.5. And can you please tell me what's the amount of working capital? 130. So this is rupees 130 in lakhs. So rupees 130 lakhs will be required by the way of working capital. Very easy. Okay. So this was your operating cycle duration basic question on how we have to calculate it. Okay. Chalo. Now let us come to your practical problem number 2. The following data is given to you for an auto component manufacturing company for the year 2021-22. We are very lucky. Do we have the days available? Come on, yes or no? Yes, sir. That is 20 days, 30 days, then conversion period, that is 10 days, finished goods, that is 45, credit from suppliers, that is 60, advance payment 5 days. Acha, advance payment to supplier, is it your current asset or it's your current liability? Whenever you pay any advance to your supplier, what is it? Current asset. And total cash operating cycle cash expenses given to you as 800 lakhs. Now out of this 800 lakhs, can you just check how much percentage are for raw material? Just check. 75% is for raw material. So 800 into 75. Can you please tell me what is this going to be? 600. Can I say for 600 it is raw materials? So what about your balance? 200. Can I say that will be direct wages, factory overheads? Come on, yes or no? Yes, sir. 360 days are there in a year. We are required to estimate CA and CL. Very easy to solve. Please tell me, raw materials, is this your current asset? At what price will you value your raw materials? Very good, because raw material consumed is given to you as 600. And what's your what's your storage period which is given to you? 20 days. So can I say 600 is for full year? So 600 is for 360. So for 20 days, it should be how much? Can you please tell me? 33.33. Can I say this is 33.33? So that should be your first current asset, which is nothing but 33.33. Are you guys trying to understand this? Okay. Next, after that, what's the next item which is there? Thank you. What's the next item which is there? Work in progress. For work in progress, guys, can I say raw materials 100% and other cost is nothing but what? 50%. So in this particular case, can I say to value your WIP, we will take 600 of what? We will take raw material consumed, which will be nothing but what? 600. Hello? What is your other overheads? Can I say 200? But here we just have to take 50% of it. So that's going to be 100. So in this particular case, 600 plus 100, how much is this total going to be? 700. And this 700 is for how many number of days? 360 days. So in this particular case, this 700 is for 360 days. WIP is for how much time period, guys? WIP is for 10. So for 10, it should be how much? Cross multiply. 19.44, right? So this should be your WIP 19.45. Okay. What about the next thing, beta? Finished goods. Finished goods is what? 45. Can I say this 45 will be valued on this entire 800? So 800 is for how many number of days? 365. Finished goods is for what? 45. Cross multiply. How much is this coming? 100 days. 100 lakhs. So this will be your 100. Got it? Then what's the next thing, my dear students? They have told you that the next thing which we have, that is nothing but your what? Credit allowed from suppliers. How much credit is allowed from suppliers? 60 days. This is your CA or this is your CL? Wait, CA or CL? Mr. Nepal, CA or CL? Credit from suppliers. From suppliers. CL. So can I say it will be your CL and it will be for your raw materials. So can you all please tell me 600 is for how many number of days? 365. So now for 60 days, it should be how much? Cross multiply. Sorry, this is 360. 600 is 360 is how much? 100. So can I say this is 100? Solu, yes or no? Okay. Now let's talk about the next part. And what is that? Advance payment to suppliers. What is your advance payment to supplier, guys? 5 days. So this is your CA or CL? CA. So for raw materials only it is 600. So 600 is what? 360. For 5 it should be how much? Cross multiply. 8.33. So that is nothing but advance. For your debtors, what have they told regarding your debtors? They have told you that for debtors, what's the time period which is being mentioned, guys? 30 days. But this is cash cost method. So you'll value the debtors at sales or will value the debtors at cost? Cost. So what's the cost? 800. Please take 800 is 360. So 30 is how much? 66.67. Have we got all CAs? Have we got all CLs? So now it's very easy to estimate working capital. Take your CA. Okay, cash is given to you. Just check in the question, is there any cash which is available to you? Have they told you? Yes. Estimate the working capital if the company wants to maintain the cash of 10 lakhs. So then we'll be simply taking here as cash, CA minus CL, will you be getting the working capital? Extremely easy. Okay. So have you understood that I told you in the beginning only in estimation of working capital? Two things are very important to estimate. Number one, level of activity, and number two, time period. So are you seeing with the help of time period how easily we can estimate the amount of working capital? Got it? Clear? Okay. Practical problem number 3. The following figures relate to the following figures and the ratios relate to a company. We have sales, which is 90 lakhs. GP ratio is 35%. Fixed asset turnover ratio, that is based on COGS. Stock turnover ratio is also based on COGS. Liquid ratio is given to you. Current ratio, debt collection period, reserves, capital gearing ratio, fixed assets to net worth. We are required to prepare the balance sheet of the company. And we are also required to show the statement of working capital requirement if the company wants to maintain a provision of what? 15% to the net working capital. See, first part of the question, what is required to be prepared, beta? Balance sheet. However, I explained you this particular part. Can I say whenever we have to prepare the balance sheet, this is ratio analysis question. So how do we have to prepare the balance sheet, beta? Can I say first we have to prepare the face? Equity share capital, reserves and surplus, total. Can I say it will be called as net worth, equity shareholder fund, shareholder funds, owners funds, proprietors funds, everything is the same. Is there any debt in the question? Just check long-term debt. Is there any debt in the question? See, because now there is capital gearing ratio which is given to you now. So there is a possibility that there can be some dash debt. Okay. So in this particular case, you will find in the question that there is going to be some long-term borrowings also there in the question. Okay. So you don't have to prepare it like this. We have to always prepare it in which format, beta? T format only. Okay. Only in this question, In the entire study module, only here only they have used this vertical. Rest all the other questions I've showed you the solution. We have done it on the T format basis. Okay. So is there any long-term borrowings there in the question? Come on, yes or no? Yes, sir. Long-term loans, long-term borrowings. Then there will be what? Current liabilities. Then there is going to be what? Fixed assets. And then please check, will there be any current assets? Come on, yes or no? Yes, sir. And we'll be having some current assets. And in current assets, we are having stock, we are having debtors, we are having what? Cash. All right. All these things are going to be there. Now, do you have sales in the question, everyone? Solu, come on, fast. Sales is 90 lakhs. What's your GP ratio? Can you give me COGS, everyone? How much? 58 lakh 50. So is this your COGS? Solo, yes or no? Now, what is fixed assets turnover ratio? See guys, fixed assets turnover ratio. What's the formula for fixed assets turnover ratio? COGS upon fixed assets. Usually it is sales. But here it is to be calculated on the basis of what? COGS. What's the COGS which you have just now got? 58 lakh 50. So can I say it is going to be 58 lakh 50? And let the fixed assets be X. What's the turnover ratio which they have given to you in the question? It is how much? 1.5. Is this sufficient for you to calculate your fixed assets? How much? 39 lakhs. So your fixed asset should be 39 lakhs. Solu yaar, your fixed asset should be 39 lakhs. Now, what's the next thing which they have? Just check. Can I say now if I have got the fixed assets, I can also use this ratio, fixed assets to net worth ratio. What is this ratio? 1.3:1. So fixed assets to net worth. What is the ratio, beta? 1.3:1. Now do I have the fixed assets? Come on, yes or no? Which is 39 lakhs. Can I get my net worth? Come on, yes or no? How much is my net worth, everyone? 30 lakhs. Solo yaar. So your net worth is going to be 30 lakhs. Now I have to do the breakup. So what is the breakup which they have given to you? They have given to you reserves to share capital is 1:1.5. So your reserves is 1, equity is 1.5. So this is going to be 2.5. This we're going to divide by 2.5. So everyone please take 30 lakhs. Divide that by 2.5. How much is it? So what is 18 lakhs? Acha, you have multiplied that also. Are 30 lakhs divided by 2.5. 12 lakhs into 1.5. 18 lakhs. So 18 lakhs is this. So this has to be 12 lakhs. Okay, no problem. 18 lakhs, 12 lakhs. Okay. Now can I use the next ratio? What is the next ratio, guys? I can use your capital gearing ratio. Can you all please give me what's the capital gearing ratio, guys? Capital gearing ratio is nothing but fixed income bearing security, that is debt, plus preference shares, but there is no preference shares. And we divide that by equity shareholders funds. So now what's the capital gearing ratio, guys? 0.7875. So can I say this will now become 0.7875 is equal to X upon what's your shareholders funds? 30 lakhs. Can you find your X? I am talking about the question. Okay. How much is this? 23 lakh? 500. Okay. Because this girl started laughing. No, sir, I don't want to find. 23 lakh 62,500. Okay. Everyone got it? Okay. Chalo. Now with this, your capital gearing ratio is also over. Then can I find out my stock turnover ratio? Solu yaar. Stock turnover ratio. What's your stock turnover ratio? It's going to be COGS upon what? Average stock. So what's the stock turnover ratio, everyone? 6. So can I say this is going to be 6 is equal to, what's your COGS? 58 lakhs, 50,000. Let the stock be X. Can you find your stock? 9,75,000. So your stock should be what? 9,75,000. Come on, yaar. And what was your borrowings, beta? 23,62,500. Okay. Now let's continue this further. We have stock also done. Okay, liquid ratio. Guys, please tell me what's the formula for your liquid ratio. Liquid ratio is also known as your quick ratio. current assets minus stock minus prepaid upon current liabilities. But unfortunately, I don't have current liabilities also, and neither do I have current assets. I don't have that, right? But I only have one item. What is that one item, beta? I only have your stock which is available. Okay, see what I will do, I'll tell you. See, what is my current ratio, everyone? CA upon CL. What is that? 2.5:1. है ना? So can I put it like this? My current asset is 2.5 times current liability. So let CA be 2.5 times CL. So can I substitute my CA as 2.5 times CL? Right? What is the quick ratio, guys? What's the quick ratio? The liquid ratio which they have told you, that is nothing but what? 1.5:1. So 1.5 is equal to, now I am substituting this CA with what? 2.5 CL. So 2.5 CL minus, do I have stock? Yes, I just now calculated. What is that? 9,75,000. Let the prepaid be 0. And what is your current liability? CL. Now this will become 1.5 CL is 2.5 CL minus 9,75,000. So can I say this is 9,75,000 is equal to current liabilities. So I should get my current liabilities, which should be 9,75,000. Solu yaar, this is 9,75,000. Okay, this is your practical problem 3. So then can I take the total of the liability side? Do the total. 30 lakhs plus 23,62,500 plus 9,75,000. How much is that coming? 30 lakhs plus 23,62,500 plus 9,75,000. 63,37,500. 63,37,500. Can I say my current assets will now be the balancing figure, which is 24,37,500. Now what is required to be calculated? Can I say debtors? So debtors is what? 1 month. Now you have sales available. On that basis, can we calculate your debtors? Come on, yes or no? What is your sales? 90 lakhs. All are on credit. 90 divided by 12. How much is that? 7,50,000. So this is your debtors. So don't you think balancing figure will be your cash? Solo here. So this is going to be what? 7,12,500. Just check. 7,12,500. Superb. Everyone understood? Then they have just told to estimate working capital. Now what is this nonsense? You already have your current assets here. You already have your current liabilities here. Subtracted working capital, add safety margin, total answer. So once you have CACL from the balance sheet, we can directly substitute that and we can get the working capital. Awesome. Purinjida. Great. Amazing. Chalo. Next. 4th question. PQ Limited is a company newly commencing business. Now this newly word is very important, because whenever there is new word given to you now, it means that your opening and closing both are not the same. So in this question, your RMC is not equal to purchases. In this question, your factory cost, work cost is not equal to your COP. Your COP is not equal to COGS. So earlier what we used to take now directly, in this question we cannot take it. Why? Because it is what type of a company, beta? Newly formed company. Now we have sales, we have COGS, we have GP, we have admin selling, we have NPBT, provision for tax and PAT, and then we have the cost of goods sold has been arrived at under materials, wages, depreciation. So this cost of goods sold, can you see 1,53,000? That 1,53,000 ka breakup is this, where there is raw material, wages, depreciation, less stock of finished goods. The figure given above only relate to finished goods and not to work in progress. So these figures which are given to you, are they including your work in progress or excluding your work in progress? Excluding the work in progress. So whatever is the raw materials used only in finished goods, that is given to you. What is the labor only in finished goods, that is given to you. Whatever is the depreciation only relating to finished goods, but regarding work in progress, no such data is given to you. So we have to calculate what is the WIP data as well. Goods equal to 15% of the year's production in terms of physical units will be in process on an average requiring full material but only 40% of the other expenses. The company believes in keeping raw materials equal to 2 months consumption stock. Please tell me what is this CACL? CA. Your work in progress is also what? CA. Your finished goods is also what? CA. All expenses are paid 1 month in advance. Bolo. CACL. CA. Suppliers of materials will extend 1.5 months credit. CACL. CL. Sales 20% for cash and rest is for 2 months credit. So this is nothing but your debtors, which is your CA. But be very careful that all sales are not on credit basis. Only 80% are on credit. 70% of the income tax will be paid in advance. CACL. CA. The company wishes to keep cash. CACL. CA. And 10% has to be added as the safety margin. So guys, please tell me what are the list of CACL? Come on. Can I say in CA there is going to be stock of raw material? So here there is what? Stock of work in progress. There is what? Stock of finished goods. Is there any debtors? Yes. And then is there any prepaid expenses? Yes. Then there is advance tax also. I will just write down here advance tax, but we can do net adjustment as well. Okay. There is no cash balance which is given to you. Is there any cash balance given to you? I don't know. Cash is given to you, right? So will there be any cash also? Come on, yes or no? Yes, sir. So there is some cash also. I'm writing down here cash. Okay, how much is the cash? 8,000. Okay. And then current liabilities. Give me the list of current liabilities. Is there any creditors? Yes. Is there any outstanding expenses or something? No. But there is something which is also called as provision for tax. So then this will be your CACL. And from your CACL, what will you get? Working capital. Add what? Provisions. What will you get? Total working capital. Are you all okay with this? Come on, yaar. Okay. Now, the problem with this question is that the data given above is only related to finished goods. Now, which method do we follow better? Do we follow cash cost method or do we follow total cost method? Then the answer is cash cost. Now, whenever I'm talking about cash cost method, please tell me, should we include the depreciation or should we exclude the depreciation? Include or exclude? Exclude. Now, raw materials consumed, they have given only regarding finished goods. So we have to add what? WIP. Can I say then we'll be getting the total amount? Because the figure given above is only relating to what? Finished goods. They have not given regarding your work in progress. Please tell me what's the raw material consumed for your finished goods. Yeah. So what is the raw material consumed given for your finished goods? 84,000. But for your WIP, can I say 15% is your WIP? Right? They have mentioned here, see, your goods equal to 15% of the year's production will be in process, which require full materials. So can I say this will be multiplied by 100%? Can you please give me 84,000 into 15% into 100%? How much is that? Sorry? 12,600. Now can you give me total raw material consumed? 84,000 plus 12,600. 96,600. So can I say this is raw material consumed? Come on, yes or no? Yes, sir. What about your direct wages? What is your finished goods direct wages, beta? 60 to 500. Solo yaar. But what about your WIP? 60 to 500 into 15% into. But they have just told you that for work in progress, there is only 40% of your wages. So don't you think it should only and only be what? 40% of this. So can you please tell me 60 to 500 and 15 into 40%? 3750. Can you give me direct wages? 66,250. Now what is the total of this? Someone just said, sir, what about depreciation? Are depreciation do we consider or we ignore? We ignore. So what is the total of 96,600 and 66,250? 1,08,50. Right? Can I say this will be called as your factory cost? Will this be called as your works cost? Yes. But will this be called as your cost of production? No. Because add opening WIP less closing WIP. Please tell me, do you have any opening WIP? No. But do you have closing WIP? Yes. Please do the total of these two parts. 12,600 plus 3750. 16,350. So can I say this will be 16,350? Solo yaar. So then what will be your COP? Can you give me COP? 1,62,850 minus 16,350. 1,05,500. To this we add opening stock of finished goods, which is nil, less closing stock of finished goods. What is that? Closing stock of finished goods they have given in the question. Just check, that is nothing but 10% of this. I cannot take this 17,000 because this 17,000 includes depreciation. So don't you think I have to calculate again? So what is going to be 10%? 10% of 1,46,500. What is the 10% of 1,46,500? 14,650. So this will now give me my COGS. What is the COGS? $850. Can you just see the COGS is 131,850, and in the question the COGS which is given to you, that is 1,53,000. Why there is a difference? Two differences. One, WIP was not included, so we included WIP, and number two, there should not be any depreciation. Got it, everyone? Okay. So please tell me now, what is your admin selling expenses? Have they given to you admin selling expenses? Just check. Yes. What is the admin and selling expenses? 27,000. Come on, yaar. Is there any admin? Yes. 14,000. Is there any selling? 13,000. Can you please give me total cash cost? This is total cash cost. What's the total cash cost? 1,58,850. Okay. So in this question, there is something new for you to learn. That when the figure given above is only pertaining to your finished goods, don't you think we have to add your WIP to get the total amount? And we are not going to consider your depreciation. Purinjida. Then we'll be getting 1,58,850. Now can you all please tell me, guys, what are we going to do next? Now we have to calculate your different types of, your working capital, etc. So first, let us talk about your stock of raw materials. Guys, stock of raw materials, what's the time period which they have given to you? Stock of raw materials. Just check. The company believes in keeping material for 2 months. So now do I have raw material consumed available? Come on, yes or no? What is the total raw material consumed? 96,600. So Shri, what are you going to do? 96,600 into 2 divide by 12. 16,100. Just check. 16,100. This should be your stock of raw material. 16,100. Purinjida. So we have to take the total raw material consumed, not what was given to you in the question. Because that was only finished goods. But there was some raw materials also in your WIP. So don't you think we have to consider that also? Solo yaar. Then work in progress. What is work in progress, guys? Did you get work in progress? Hello? Work in progress. Your work in progress is readily available. How much is that? 16,350. That is work in progress. 16,350. Just check this out here. 16,350. Got it? Then what about your stock of finished goods? Can I say your stock of finished goods? In that particular case, it is going to be how much percentage? Can I say it is going to be 10%? Solo yaar. So in this particular case, what is your stock? Just check this out. 14,650. So is that going to be 14,650? Come on, yes or no? Yes, sir. What about your debtors? Debtors, can I say there is total cash cost? 158,850. But out of that, how much percentage is your credit? How much is that? 80%. 80% na? So only 80% of it. Give me 80% figure. 1 lakh? 080. This is 127,080. So now I will take for debtors 127,080 into what? How much is the time period? The time period is 2 months. So I will take into 2 divided by 12. Sorry? 21,180. Hey, you all are calculating this now. Hello? 21,180. Cash is already 8,000. They have told you all the other expenses are prepaid. So wages, manufacturing, all these things you will add it into 1 divided by 12. That will be your prepaid. Now that is something which you all know. Okay. Now what is advance tax paid? See, do you have provision for tax in the question which is given to you? Yes, sir. Just check what's the provision for tax which is given to you in the question. The provision for tax which is given to you in the question is what? 10,000. That is your provision for tax. Can you please tell me how much percentage is advance tax? 70% is advance tax. So can I say 7,000 is going to be your advance tax? But that is paid in how many installments? Quarterly installment. So 7,000 divided by 4. What is 7,000 divided by 4? Everyone. 1,750. Got it? So this will be your total working capital. And then from that we have to subtract your current liabilities. So provision for tax, it's nothing but what? They have told you advance tax is 70% is advance tax. So what is your balance? 30%. That is your provision for tax. So that's how they have taken 3,000. But ideally this is not correct. But we'll not discuss that right now. But they will just go by what ICAI says. What is the provision for tax? 10,000. 70% was paid in advance. So we took that 7,000 divided by 4. But then what is the balance provision which is there? 3,000. So that 3,000 which is remaining, that is your provision for tax. Okay. 70% was paid in advance. So 30% is remaining. So that's why it should be 3,000 here. Okay. But this is not correct. No, you're wrong. Why? Because when we are paying the advance tax and provision for tax, I'll tell you what happens is, whatever advance tax you paid now, whether you pay it on quarterly installment, monthly installment, or daily basis, your entire amount of advance tax should be your current assets. So actually, entire 7,000 should be your advance tax, and your provision should be 10,000. So that's how it should be. 7,000 should be advance tax and provision for tax should be 10,000. Whether even if you pay it on quarterly basis then also the settlement of advance tax happens with provision for tax in the next year. So on the balance sheet asset side, it should be the entire advance tax which should be coming as your current assets. That is actually the correct answer. But let's not do that. We will take into consideration this what ICAI has done. Okay, because we don't want to play even with one single mark, because you know he got 99. So that is why it is better that we should take completely full. Okay, beta, don't worry. Okay, he will come. Okay, she's missing him very badly. Okay, so this will be your current liability. Okay, Gavni. So this will be CA, this will be CL. What will this be, beta? Working capital. And then to this working capital, what we have to do, beta? Add unforeseen circumstances. So then we'll be getting the net working capital. Superb. Solu yaar. So with this, we complete now your which question, beta? This is your practical problem 4th. Yeah, all it should be cash cost. Hello. Okay. Say my hi to Rajashekar. Okay. So please tell me, everyone in one voice, please tell me. Acha, she was asking total cost, cash cost. We should always use which method, beta? Cash cost method. So everywhere depreciation should be excluded. But in this question only, which we are going to solve, that is question number 5, they have instead have solved on what basis, beta? They have solved on the basis of total cost method. So this they have assumed as total cost method. Now when there is total cost method, na beta, can I say debtors will be valued at what? Sales, and your depreciation will be included in your income statement. Come on, yes or no? Yes, sir. So even in examination, when you get this kind of a question in which we have to prepare P&L as well as working capital. Again, I am repeating, in examination you get a question in which there is P&L as well as your working capital. And if depreciation is there, will we include that depreciation in the part of your this income statement? Come on, yes or no? Yes, sir. And we can value the debtors at sales and then do that accordingly. Okay. So in this question, you will see that. Okay. See, first, what is given to you? Ma is commencing a new project. Oh, Baba, which project? New project. Acha, by the way, earlier question also it was a new project. Now in new project, now remember, how do you calculate your creditors? I'll just explain you that. In a new project now, see, creditors, for that we always use raw materials consumed in usual circumstances. Because in existing company, can I say that raw materials consumed is nothing but what? Opening stock plus purchase minus closing stock. Solo yaar. So opening closing is same. So your raw material consumed is nothing but your purchases. But in a newly formed company na, your creditors has to be calculated on your purchases. For a newly formed company, you will calculate your creditors on what, beta? Purchases. So what is your purchases? Do you know? RMC is equal to opening stock plus purchase minus closing stock. You will be having RMC 96,600. I think you got 96,600 as RMC, right? What is your opening stock? 0. Let the purchase be X. And what's the closing stock of raw material? Your closing stock of raw material you have calculated, that is coming as how much? 16,100. So we have to now take 16,100 and then calculate your purchases. And based on that, the creditors will be calculated. So wherever you see a newly formed company, you will always calculate your creditors at dash. RMC or purchases? Purchases. Can you please tell me what is your purchases, beta? What is your purchases? Do the calculation, na? This will go here. What's your purchases? 1 lakh 12,000 1,12,700. Is this your purchases? Solu yaar. What's your credit period? What's your, in the earlier question, what was your credit period for your current liabilities? Can you just check? It is 1.5 months. Solu yaar. 1.5 months. So you take this, multiply that by 1.5, divide that by 12. 1,12,700 into 1.5 divided by 12. Huh? 1,12,700 into 1.5 divided by 12. What is it? 14,087. Now just check here. You should be getting your creditors as 14,088. 14,088. You got it? So whenever it comes to creditors in a newly formed company, will you value it at RMC or will you value it at purchases? Purchases. Got it? Chalo. Continuing to this particular question. Now we have, they have told you that the following cost information has to be ascertained for the annual production, which is nothing but how much number of units, beta? 12,000 units, which is your full capacity. Acha, is it necessary we should always operate at our full capacity? No. See, here they have told you materials. This is always your raw material consumed. We have direct labor and variable expenses. We have fixed manufacturing. We have depreciation. Guys, this depreciation is always your factory depreciation until unless specifically mentioned. This is your fixed admin. We'll be getting this as 80. Selling price is what? 96. And selling expenses is what? 5. 80% of which is variable. So out of 5, how much is variable beta? 4. So what is your going to be your fixed? 1. Okay. And please tell me, what about your fixed expenses? Your fixed expenses, will it change with the change in the output? So what is your fixed expense? Just check. See, if there are 12,000 units, I can multiply this 6 by 12,000 units. If I multiply this 6 by 12,000 units, then what is going to be your fixed manufacturing expenses? 72,000. Depreciation, it is 10 into 12,000 units. How much is this going to be? 1,20,000. Admin, 4 into what was the capacity? 12,000 units. So this is what? 48,000. Selling expenses, 20% is what? Fixed. So multiply that by 12,000. How much is your fixed selling? 12,000. Now, whatever you produced, are these figures going to change? Whatever, how much quantity you produce, will this fixed overhead going to change? Come on, yes or no? No, it's not going to change. What will change is just your variable cost. Your fixed is not going to change. Your fixed is always going to remain what? Same. So, for example, the classroom capacity is 100 and we are paying rent per capacity. Suppose per student, we are paying rent of 100 rupees. So can I say 100 into 100, 10,000 is the rent, right? Based on capacity, because there are 100 seats. So the landlord will always charge us based on how much is the capacity. So he says that 100 students can sit here. 100 students can sit here and 100 is the cost per unit. So can I say 10,000 is the rent of this premises? Now whether 5 students come, 10 come, 20 come or 500 come, will this rent change? No. So similar to that, can we say we can multiply this by the capacity to get the total cost? Solu, yes or no? Yes, sir. And this will not change with the change in the quantity. Are you guys understanding this? Okay. So in the first 2 years of operation, in the very first year, can you please tell me what was your quantity produced? How much have you sold? What is your closing stock? In the second year, how much are we producing? What is your sales? Can you give me closing stock? 1,500. Because this closing will become opening for the next year. So this should be 1,500. Got it? So this will be 1,500. So can I say this will be nothing but your closing stock, yaar? Will this be your closing stock? Come on, yes or no? Yes, sir. Then stock of materials. Can I say this is CA? Work in progress is nil. Debtors, CA. Cash, CA. Creditors, CL. And it should be calculated on your purchases because it's a newly formed company. In this question, RMC is not equal to your purchase. Okay? Then expenses. All expenses are on credit, CL. We are required to prepare P&L statement. Guys, please tell me in P&L statement, don't you think everything will come? In P&L statement, will depreciation be also part of it? I am asking you, yes or no? Yes, sir. So see, your sales is 96 multiplied by what was your quantity sold, guys? Your quantity sold was nothing but, just check, it was 5,000 units. So everyone on your calc is fast. 5,000 into 96. Did you get your sales 4,80,000? Materials, can I say it will always be on units produced into 40. How much units are we producing, guys? 6,000. So 6,000 into cost, which is given to us 40. How much is that? 2,40,000. Right? Direct labor, also it is variable cost. It is on quantity which I am producing. Can you please tell me how much is that going to be? 6,000 into 20. 1,20,000. Solu yaar. 1,20,000. Then please tell me fixed. Will it change with the change in the output? So this is 72. So this also has to be 72. Then can I say depreciation? Same. 1,20,000, 1,20,000. Oi. Then also at the same time, what is your fixed admin? Same. 48. Then what about your total cost of production? 6 lakh and 7,80,000. Opening stock of finished goods is nil. Now closing stock of finished goods. How will you calculate closing stock of finished goods? Please tell me that total cost of production is what? 6 lakhs. I explained to you when I was doing working capital. Your total cost of production is 6 lakh. Take on your calci 6 lakhs. How much units are we producing? Divide that by 6,000. multiplied by what are the number of units which are there in closing stock? 1000. In first year it is 1000. Multiply that by 1000. Can I say this is 1 lakh? Solu yaar. This 1 lakh will now become what? Opening stock for the next year. Come on, yes or no? Yes, sir. Are you guys trying to understand this? Okay. Now for next year, how will you do it? So closing stock for year 2 is nothing but what? Can I say 1500? Take on your calcis 7 lakh 80. Right? Divide that by what was the quantity produced? How much? 9000. Divide by 9000 first and multiplied by 1500. 1 lakh 30. 30 now. So you know why this difference is coming, because they have taken they have not taken FIFO method for the purpose of calculation. So they have taken some different method for the purpose of valuation of stock. So that's why this figure is not matching. But can you definitely take FIFO and do it accordingly? Come on, yes or no? Yes, sir. So that is absolutely fine. You can do it on that basis. So they have done it differently. So they might have taken like this. I think here, have they shown any working for the same? See, closing stock is valued at average cost of goods sold available for sale. So they are valuing this at 8 lakh 80. So just check 8 lakh 80 divide by what? 9000 and multiply that with what? 1500. कितना है? हाँ, तो कितना आएगा? 8 lakh 80 divide that by what? 10,000 into what? 1500. तो उन लोग ने कैसे किया है? 8 lakh 80 divide that with what? 10,000. Because 9,000 was quantity produced plus opening stock is what? 1,000. So they have divided that by 10,000. And then they have multiplied that by your closing stock. So they have used this average method. But we can also use what? Your FIFO method and do that accordingly. That is weighted average method. We can use FIFO method. Whatever method is suitable, you can do that. Okay. Then we'll be getting COGS. At selling variable. Can I say fixed is always going to remain the same? Cost of sales, profit loss, you'll be getting it. Okay. Now, same. We are also required to estimate the working capital. Please tell me, my dear students, now in this particular case, as I told you, we are going to use which method for the estimation of working capital, beta? Total cost. Now, whenever there is income statement and working capital, both needs to be done now. Then you can use total cost method. Now, what is total cost method? Will depreciation be forming part of it? Come on, yes or no? Yes, sir. And even debtors will be valued at what? Sales. So you can do that accordingly. So just check. This is 1 lakh and this is 1,32,000. So that can be forming part of your stock. Just check. 1 lakh and 1,30,000. Can I say this also includes depreciation? Come on, yes or no? Yes, sir. And can you just check? They have also calculated this including your profit margin. So that is 40,000 and 68,000. Okay. Then total cash cost, etc. Then all the things are same only. The only difference is debtors and finished goods. Finished goods will be valued at what? Will it be valued including the depreciation figure? Come on, yes or no? Yes, sir. And when we are calculating debtors, will be valued at cost or will value it at sales? Sales. Sales. Under total cost method, will value it at sales. And when to use total cost method? When there is income statement, balance sheet, income statement and working capital, both is required to be calculated, then we can value it on total cost basis and do it accordingly. Got it? Yeah, please. You have to tell him. Yeah, I know. Okay, go. So can I say this is going to be what? Your working capital. Okay. Got it, everyone? And then they have also shown on cash cost basis, but we don't have time to do your total cost as well as cash cost. Okay, so if you can do it on total cost basis, absolutely fine. You guys got this? Are solo yaar. Now, question number 6, Aneja Limited. Let's do this particular question. Aneja. When institute gives you 2 options, na, always follow the easier one. So easier one is what? When the income statement and working capital is to be prepared, and in income statement we can include depreciation. We have to include depreciation. and we calculate debtors, we calculate the amount of the sales, then in that particular case, when they have asked you to prepare the working capital, how will you do it? On the basis of cash cost or on the basis of total cost basis? On the basis of total cost basis. Because already all the figures are there in the income statement. Just substitute that and get the values. Got it? Okay. Chalo. Now let's start with what? You are very tired? You want to go? No, na? Okay. Better. Question number 6. Let's do this. Come on, yaar. Okay, very good. Aneja is a newly formed company. Again, the word is dash. If it is newly formed, everyone please tell me, will you value the credit as a dash? Purchases. And purchases we have to calculate by taking RMC is equal to opening plus purchase minus closing, where the opening is going to be 0 and closing stock of raw materials needs to be taken into consideration. Then what is given to you? It's go to the bank for the first time and we are required to estimate the working capital. What is the estimated level of activity? 1,04,000 completed units plus 4,000 is work in progress. And based on this, we have raw materials consumed. We have direct wages, overheads exclusive of depreciation. That's a good thing for you. Okay. Total cost, selling price, raw materials, average 4 weeks. Everyone, CACL. I am asking you, raw material, CACL. Your work in progress, CACL. And they have told you 50% in respect of conversion cost and materials used at the start of the processing. So raw material is 100% and baki labor and overhead is going to be what? 50%. Finished goods in stock, CACL. Credit allowed by supplier, CACL. Credit allowed to debtor, CACL. Lag in payment of wages, CACL. Cash bank, CACL, CA. Annual production is evenly spread out. All sales are on credit basis. Okay. Now see, this statement is given. Wages and overheads accrue similarly. But there is only lag in payment of wages. Does it imply there is lag in payment of overheads also? Then the answer is no. See, accrual can be on the same date. What is accrual? Accrual means how do we record the entries in our books of accounts. So it is possible that if I am giving salary to Shri and if I am giving salary to Sujal, I am giving Shri and Sujal both salaries is getting accrual on the same day. But to Shri, I am making upfront payment. But there can be a possibility that there can be lag in payment only in case of Sujal. So can I say my current liability will be both the things or current liability will only be Sujal? Only be Sujal. So that is why they have told you it is accruing similarly. But this is of no use. We just have to only take what? Lag in payment of wages. Overheads lag is not going to come. Got it? Okay. Now, what is the format of the income statement? How are we going to start with this question? Come on. Question number 6. First step is always what? Breakup. Whose breakup? Breakup of cost. Now, please tell me, will there be any finished goods? Then, will there be any WIP? Solu yaar. Will that give you total? Finished goods, how many units are we producing? 1,04,000 na yaar. Finished goods is 1,04,000. And 4,000 is what? WIP. Right? Can you please tell me raw material consumed? What is finished goods raw material consumed? 80 into 1,04,000. Now I want answers faster. 80 into 1,04,000. 83 lakh 20,000. What about your WIP? How much is it? 80 into what? 4,000. And can I say 80 into 4,000 and raw material is what? 100%. So can I say this is going to be 3 lakh 20. So can you please tell me this will be what? 86 lakh 40,000. What about direct wages? Everyone please tell me direct wages. How much is it? 30. 30 into what? 1,04,000. Everyone finished goods direct wages. 31 lakh 20,000. And what about your WIP? So it is going to be what, beta? Can I say it will be 30 into what? 4,000. But how much percent is it complete? They have told you that it is 50%. So I'll take 50%. How much is this? 60,000. Total solo 31 lakh 80,000. What's the next item, guys? Factory overheads. Can you please tell me factory overheads? How much is it? 60. So can I say 60 into 1,04,000? 62 lakh 40,000. Plus, what about this? Can I say it is going to be what, beta? 60 into what? 4,000 into how much percent? 50%. Can you give me this? 1,20,000. Can you please give me the total of this? 62 lakh 40. Sorry? 60,000. Are you all comfortable with this? What's the total now of all these things? 1 crore 81 lakh. Superb. And what is your WIP, guys? The total of this 180, 325 lakhs. So what is this going to be? 1 crore 76 lakh 80,000. Can I say this is called as factory cost or works cost? Can I call this as COP? No. Why? Because this is a newly formed company. So add opening less closing WIP. So opening WIP is what? Nil. What is closing WIP? 5 lakhs. So can you please tell me what's your COP going to be? 1 crore 76 lakh 80,000. To this, what do you add? Opening finished goods. What do you subtract? Closing finished goods. What do you get? COGS. This is nothing but total cash cost, because there is no admin, no selling. Opening is 0. What about closing fixed cost? Closing, my dear students, how much they have told you, beta? 8,000 units. Can you please tell me 1 crore 76 lakh 80,000 you are spending for manufacturing how much number of units? You are spending that for manufacturing 1,04,000 units. Can you give me per unit cost? 170. And how many number of units are there in closing stock? 8,000. How much is this going to be? 13 lakh 60,000. So this is going to be 13 lakh 60. Can you please give me COGS? 1 crore 76 lakh 80 minus 1 crore 30,000. 20,000. This is your COGS. Oof. This is the breakup of cost. For which question? 6th question. Then if they ask you, chalo, calculate stock of raw materials, give me the value. At what value will you value stock of raw materials? Tell me, at what will you value your stock of raw materials? Look here and tell me 8320, 3 lakh 20 or 8640. We have to value our stock of raw materials at what price? Raw material consumed. Raw material consumed, na? Stock of raw material should be always valued at raw material consumed. So that is 8640. Solu yaar. So when I am calculating my stock of raw materials, it should be valued at what price, beta? 86 lakh 40. Can you please give me what's the time period for that? What's the time period for your stock of raw materials? What's the time period for your stock of raw materials? 4 weeks. Everyone take on your calcies. Everyone take on your calcies. 86 lakh 40. How many weeks in a year? Divide by 52. And how many is going to be for stock? 4 weeks. Multiplied by 4. 6 lakh 64 615. Purinjida. Then work in progress. 5 lakhs. Solu yaar. 5 lakhs. Same. Okay. This to everyone would have got. Okay. Then about finished goods. Finished goods. Finished goods. 13 lakh 60,000. Just check. 13 lakh 60,000. Debtors. What's your debtors? Debtors will be valued at what? 1 crore 63 lakh 20. Have they told you that there are any cash sales or something like that? No, all sales are on credit. What's the time period? 8 weeks. How will you do that? Divide that by 52. Multiply that by 8. 29 lakh. Is he right? Oh wow. 25 lakh 10,760. Shri, last, he's very energetic. And then after, morning 11 to 1 is sleeping. Towards the last, I don't know what happens. Cash bank, 25,000. And then this is your gross working capital. From that, you have to subtract your creditors. Now creditors, everyone in one voice, creditors. Are we going to value it at RMC or will value it at purchases? Everyone, formula for RMC. Opening stock of raw materials plus purchases minus closing stock of raw material. Do you have RMC in the question? Solu yaar, 86 lakh 40. Do you have opening stock of raw materials? Do you have purchases? X. What is the closing stock of raw material? We just now calculated that was 664,615. 664,615. Give me purchases. Give me purchases. 93 lakh 4,615. Now this is your purchases. But you have to check creditors is for how much time period. Just check creditors. Creditors is for how much time period? 4 weeks. So what will I do? Into 4. Divide by 52. 15,000. 730. 740. 740. 740. Solu yaar. Then this to you know creditors etc. Then finally working capital. Purinjida? Purinjida? Sure? Confident? Very good. Are you all ready? Are you all ready or you all are tired? These questions are a little bit lengthy. Little bit? Or it is too much, right? Very much lengthy. But answer is small. See, we have to do it here. You want to do this or no? Tell me. Arey, he is already leaving Nepal. Carefully, carefully. But all these questions are lengthy. But you never know. What if this comes in the examination? It's okay na yaar for you to sit. It's okay yaar. You tell him 7:30. 7:30. What is wrong in this yaar? It is for your own benefit. I am not going to appear. I am already a chartered accountant. And already a company secretary also. Do you all know that? CACS. So now I am done. Now it's up to you. You also have to make it na. She is so sleepy. She is looking at me, but she is thinking something else. I don't know what are you thinking. You looking? Well, what is the answer? Blank. You saw na? And then I had to tell her, hey, look here. Tell him. Are no, tell him. Everyone is receiving call at 6:30. You also tell. Everyone tell, okay? Shri is also telling. See, very good. Shri, tell your Shrimati. Huh? What? Okay. We are solving. What are you doing? Fast. Go fast and come, okay? We have to do this. Let's start. Okay. Question number 7. Now this is slightly lengthy, okay? But I want you all to focus properly. The management of trucks is planning to expand its business and consults you to prepare the estimated working capital statement. The records of the company reveals the following information. What are the records of the company which is given to you? Sales. Domestic 1 month credit. Can you please tell me that if it is 1 month credit, what does it mean, beta? Can I say this is nothing but your current assets? Come on, yes or no? Yes, sir. So, see, if we sit today, tomorrow you don't have to come. Okay. So tomorrow anyway it was planned na for you. But tomorrow you don't have to come. Today only sit little bit extra and it is done. Or you want to come tomorrow? No, he wants to come to, he travels 6 hours daily to come for my lecture. How can he come for 6 hours and then only for 2 hours lecture he cannot come? For 1 hour, remaining 1 hour. So it's better that you sit now only. It's okay. I thought it's okay. He is okay with it. What is the problem with you? He said I am okay. He will sleep here only. You want to sleep here? No? Okay. He is only concerned about dinner. He only wants dinner. Dinner, yeah, yes, I am fresh. I will do all the calculations. You give cake also, I will solve also on the food. So hungry he is. Okay. Chalo. Now next, what is given to you? Export at 3 months credit. Can I say this is also your CA? Come on fast. Yes or no? Yes, sir. Materials used. Suppliers extend 2 months credit. Everyone, CACL. Suppliers extend 2 months credit. CACL. CL. Lag in payment of wages. CACL. Lag in payment of manufacturing expenses. CL. CL. This is advance. What CL? This is nothing but your CA. You tell properly CA, CL, or else your CA is at problem. So this is nothing but payable quarterly in advance. Everyone, hello. If it is payable quarterly in advance, what is this? CA or CL? CA. Income tax payable for in quarters. What is this? CL. Rate of gross profit is 20%. Ignore work in progress and depreciation. So in this question, is there any WIP? Come on. There is no WIP. Is there any depreciation? No depreciation. The company keeps 1 month stock of raw materials and finished goods. What is this? CA. And there is a cash which is available of 2,50,000, which includes an overdraft limit of 75,000, which is not yet utilized. So 75,000 is nothing but your current liabilities. The management wants to make 10% margin. You are required to estimate the working capital. Now in this question, the important part, I'm solving it. Please tell me that what's your sales domestic? Come on, yaar. So your sales, which is domestic, that is nothing but 18 lakhs. Okay. What's your GP, guys? What's your GP? 20%. Can you please tell me if 20% is my GP, what's your COGS? 18 lakhs minus 20%. Give me, come on, fast. 14 lakhs, 40,000. Can I say this is COGS for domestic? Solo, yaar. But for overseas customers, now you all guys can just check that sale price is 10% below the domestic market price. So what does that mean? I am selling to my overseas customers goods at 100 rupees, or I am selling it at 10% discount. 10% discount. See, if I would have sold for 100, if this is 20, this would have become 80. But I am selling it at 10% discount. So can I say this will now be what? 90. This is 80. So this has to be 10. Because I am selling it at 10% discount, na yaar. So this has to be what? 90. 90, 80, 10. Now can you please give me what is the sales for domestic customer, export customers? 8 lakh 10. So if this is 8 lakh 10, can you please give me my COGS here? 8 lakh 10 into 80 divided by 90. 7 lakh 20. What is 7 lakh 20? I want my COGS. 8 lakh 10 into 80 divided by 90. How much is it? 7 lakh 29. Arey, hungry people. What is your COGS here? 7 lakh 20, sure. Finally, we have got it at 7 lakh 20. Thank you. 7 lakh 20 na yaar. So now I have COGS for domestic also. 14 lakh 40. I have COGS for overseas also. 7 lakh 20. Okay. Now please tell me, is there any admin expenses? What is your admin expenses? 1 lakh 80. But that 1 lakh 80,000 of admin expenses, I have to bifurcate that in domestic as well as overseas. Also at the same time, this 1,12,500, I have to bifurcate into your domestic and overseas. Can you please give me this total amount? 1 lakh 80 plus 1,12,500. Acha, give me 1,80,000 first. Chalo, give me 1,80,000. 1,80,000, can I say I have to bifurcate that in domestic and overseas? In which ratio will I bifurcate it? See, this is your quantity. So I'll bifurcate that. 1 lakh. Acha, in this particular case, I'll tell you what is happening. See, give me COGS total here. 14 lakh 40 plus 7 lakh 20. Give me COGS total. 21 lakh 60,000. This is my COGS. Everyone got the COGS, which is 21 lakh 60. Okay, now pay attention. Now pay attention. Okay. Hey, coffee, chocolate. Okay, pay attention. This is important. Okay. What's your good name, sir? Huh? Vamsi. Vamsi, you tell me one thing. Vamsi, sales minus GP gives you what? COGS. So we have already calculated COGS. Okay. But also at the same time, if I take raw materials consumed, I add direct wages. Then also at the same time, if I add manufacturing expenses, which is factory overheads, can I say the total should be coming as my factory cost or works cost? But if this is an existing company, bacha, if this is an existing company, can I say this is your COP, which is also your COGS? Now please tell me what is the COGS which you have got? 21 lakh 60. What is your raw material consumed which you have? Your raw material consumed is 6 lakh 75,000. What's your direct wages which is given to you? 5 lakh 40,000. What's the factory overheads which you have it with you? You have 7 lakh 65,000. Now can you please tell me what's the balancing figure left here? What's the balancing figure? Because this total is not coming as 21 lakh 60. What's the balancing figure which is coming as? What is the balancing figure which is coming as? Now this 1 lakh 80, you know what we have to assume? This is administrative overheads which is related to your factory. Related to production. So this is administrative overheads related to production. So you know earlier in that question which we did, your COGS was not matching. You told me that COGS is not matching. What did we treat that difference 1,20,000 as? What did we treat that difference amount as? We treated that as depreciation. But please tell me, here they have specifically mentioned that we have to ignore depreciation. So here the difference amount of 1,80,000, I cannot treat it as depreciation. What will I treat it as? Administrative overheads. Did you realize this? So this is your dash hidden adjustment. What is this? This solo hidden adjustment. That this 1,80,000 is nothing but your depreciation. Your administrative overheads. So earlier what was happening, bacha? Sales minus GP was coming as what? COGS. So that COGS should actually match the total of all the expenses. If that was not matching, we were treating that as depreciation. But here, my dear students, they have specifically told us to dash. Ignore depreciation. So then the difference amount, can I treat it as depreciation or I have to treat it as administrative overheads? Administrative overheads, because this exactly matches 1,80,000. Purinjida? Okay. So now please tell me, this is 21 lakh 60. Okay. Now this 21 lakh 60 was actually what? Can I say 14 lakh 40,000 was pertaining to your domestic and 7 lakh 20 was pertaining to your overseas. What we need to do is, to this now we have to add selling and selling expenses, because admin is already part of your factory related, production related administrative overheads. So now we just have to adjust your selling. Can you please give me what's your selling expenses, everyone? What's your selling expenses? 1,12,500. Now this has to be divided in this ratio, sales ratio. So please take 1,12,500. Divide that by, what's the total amount, beta? 18 lakh plus 8 lakh 10. 26 lakh 10. So take 26 lakh 10 and then multiply that by, what is this, beta? 18 lakhs. So multiply this by 18 lakhs. Can you please give me what is the final answer which is coming? 1,12,500 divided by 26 lakh 10 into 18 lakhs. How much is this coming? 77586. And obviously then the balancing part will be what? Can I say 34914? So now what is the total cash cost? And why have I calculated two cash cost? Because I have to value two debtors. This is my cash cost. I have to value domestic debtors at this cost, and I will have to value my this particular part at what? 7,54,914. You guys are trying to understand this? Okay, so I'll value it at 7,54,914. Now please tell me, my dear students, what is the time period which they have given to you? Domestic is what? 1 month, and this is what? 3 months. So if you want to calculate your debtors, which is domestic, what will you do? 15,17,586. You will multiply that with what? 1 divided by 12. How much is this coming? 1517 586. Divide that by 12. How much is that coming? 1,26,465. This is your debtors domestic. It is somewhere here. This is 7th question, na? Your debtors. 1,26,466. And for your overseas, see, because we have to value debtors at what? Total cash cost. So total cash cost, we have to distribute the selling expenses. And we will distribute the selling expenses based on what? On your sales. So based on that, we have to do that. So this is what? 754,914. Hello? So this is 754,914 into what? 3 divided by 12. 754,914 into 3 divided by 12. So how much is that coming? 1,88,729. So this is 1,88,729. Rest all the things are same. So like materials, you have to take it on RMC, finished goods at COGS, which is 21,60,000. Rest all the things are same. Selling expenses, etc. Everything is same. Cash bank overdraft, take it like this. Income tax payable. Can you please tell me what was your income tax payable, beta? 1,68,000. So we have to take 1,68,000 and divide that by 4, because 1 quarter is liability. So take 1,68,000 and divide that by 4. How much is that? 42,000. Then you add working cap. You have to add your 10% to it. So finally you will be getting your total working capital. But did you realize in this particular question, the only crux was what? That we have to calculate your debtors on your total cash cost. So for that we have to take COGS and add what? We have to add your selling expenses. But for that you have to understand that the difference amount of COGS, like the difference amount of COGS which was coming, can I say we have to treat that as your depreciation, or should you treat that as your fixed factory administrative overheads? Then the answer is factory administrative overheads, and accordingly we have to solve it. Okay, so this was the question. Nice question. Fine. Question number 8. I'll do one thing only. For these questions now, I already have recordings. I will give the recordings in the playlist. Don't worry about it. So this, how many questions are left now? You have 8, 9, 10, 11, 12. It is going to take time for these questions to solve. So I'll give you the recording for the same. Is that okay? Will you see that? Will you see these questions in the recording part, beta? Sure? So you see that on the recording part. I'll upload it in first week of April. Okay? Not 1st April, first week of April. Or probably by April 10th or something. I'll upload it. Okay? So at that time you just watch it. These many videos. 5, 6 videos which are there. Because this cannot be done at a very faster pace. So these are long videos. See, this is very much manageable. Question number 13, 14, all these things are manageable. But these questions which are there now, see question number 8. Chalo, ek kaam karte. We'll do this fast. I'll just revise it. Then if you have any doubts in this now, then you tell me. Then if you want longer videos, I'll provide it to you. Okay. We'll quickly revise what is given to you. Okay. No dinner for you. Okay. So what is given to you? Let's do this. Chalo. The following information relates to what? Zeta publishing company. What's the selling price, beta? 15. Come on, yaar. What's the selling price? 15. Variable cost is what? 5. Material, labor 4, and overheads 2. The sales manager of the company, they have told you November, December, Jan, Feb, March, April, May, June, July, August. These are the number of books. And they have told you that customers are expected to pay as follows. 1 month after the day of sale is 40% and 2 months after the sale is 60%. The company produces the books 2 months before they are sold and creditors are paid 2 months after the production. Variable overheads are paid